Welcome. Good morning. Welcome to Relevation 23. Doesn't matter where you dial from, on which part of the globe, with people from the four corners of the globe. So, welcome to this new edition of Relevation, the Investment Summit. It's a pleasure to have you. So, it is said that if you forget where your roots are, you become a body without a soul. So, we wanted to kick off this intro with a little bit of flashback. So, the story starts in 2016 where we really understood that there was a unique momentum of innovation in construction and real estate. And so we wanted to play a role to help the digital and sustainable transformation of the sector. And so we created PropTech Lab. We grew up, and after a couple of years, we understood that, hey, in fact, there were 24 national PropTech hubs in Europe. All of them had the same mission, the same positioning, um, but there was no sort of pan-European collaboration or coordination between them, and so that really created a super fragmented ecosystem. It was a um, uh, so there was no sort of a pan-European umbrella, and so that's why I co-founded the European PropTech Association with the ambition to standardize the European PropTech market, create the digital single PropTech market, allowing the creation of the first pan-European PropTech unicorn. So that was the plan, you know. And then a couple of years after, what I've seen, we actually have seen a new market need, a new opportunity, which was to create a platform to facilitate investment in urban tech. And so that was Relevation, real estate elevation, to facilitate matchmakings between founders, raising capital, and investors. 1 year after, the US giant Cretech decided to invest in Relevation, fueling the global growth of our project. And we're very grateful for them. They're very strategic and value add partners. And last year was a pretty big year for us because we basically acquired Lux PropTech. So we are now active in 2 countries with 2 legal entities, 2 offices. But we have also launched Recap, the accelerator, the ESG accelerator, in joint venture with Revive, the most sustainable developer of Belgium. And so that's an accelerator to increase the ESG performance um, of large construction and real estate firms. So this being said, we're today with the last edition of Relevation, and none of this history, this adventure, this journey could have been possible without these amazing people. And so I know a lot of people say I have great colleagues, etc., and so that's certainly true. But on our side, it's not true. They're not great. They are like literally amazing. So I'm really proud and feeling. I'm really grateful and feeling lucky to have them around me. They're passionate, purpose-driven, with willing to have an impact, having ownership, doing the extra mile, etc. And at the end, a company can only be as good as its team members. That like people are is the most valuable asset of a company. So I'm really grateful. And so, what are the conclusions today? Basically, we are ecosystem builders, right? So we fight every single day to try to create ecosystems that have value for people, that have value for a sector. Um, and we're really convinced of one thing, which is that innovation is a collective sport that you can only win in teams as ecosystem. And if you doubt this, just think at France. Just think of France. You know, in 2013, they created the French Tech, and 10 years after, so in 2013, French became a sort of startup nation. That was a bit the idea, the purpose, or the ambition. And 10 years after, it now became a unicorn country. And so ecosystem really have an impact. And today, I think ecosystem is even more important than before because we have an existential challenge, which is the net zero race, decarbonization, and fight against climate change. And this is a race, but not a competition. And it's one of the only things that we can win collectively as a team. So it's one of the only things where we can only win if we actually share knowledge. And so it's very important to get rid of the mentality, I will dominate, or we are the best, we can do this ourselves, etc. No, we can only win collectively. Speaking about people that are open-minded, we are super proud to have 211 firms today attending. So 109 founders, we have 71 VCs, we have LPs, we have high potentials. So these are some of the logos. And we have succeeded in for the first time in achieving our dream positioning, which was in the middle between a tech event, a prop tech event, VC event, and a regulators event. Because for the first time, we have the involvement of some of the large regulators, United Nations, European Commission, etc. So very grateful, and of course, thanks to our partners. But how are we having an impact? Is Relevation really worth all of this hard work? We think so, because so far it's the 4th edition, but in the past 3 editions, we were able to facilitate 866 meetings between founders and VCs. And the top 5 performers are Amavi, Acontera, Rise PropTech, Verve Ventures, and John Capital. So shout out to them. And of course, this is a sort of biased view in a way, because it's only the meetings that were held through our event platform, but we have a lot of other contacts that were held after the event, thanks to the directories. So of course, it's only the top of the iceberg, I would say. So let's get started. Fasten your seatbelt. Let's be ready for takeoff. To enjoy the most Relevation, here are some guidelines. So make sure you have blocked in your agenda the sessions you want to attend to. Eat fruit, make sure that you don't have a light behind you, that your camera and sound works well, drink coffee, drink tea, drink water, and most importantly, the real value is in the follow-up. So it's what will happen after Relevation. So use your directories, do follow-up meetings, build meaningful relations. Schedules of today are busy and packed. We have 10 sessions. We will start in a few minutes with my friend from Camber Creek. Since our main purpose is to facilitate meetings, so we are transactional events. So the idea is that we increase the number of handshakes, that people do speed datings. So here are the rules of engagement. We hate arrogancy, we hate ego tripping, selfish people, takers or talkers that are only talking. And what we like in the approach is people that are humble, that are honest, that are ecosystem minded, that are listeners, that are givers. So try to have this approach in your meetings, when you speak to each other. And finally, the last slide, we have, as always, the selfie contest. One of the good things about a digital event is that people can join from everywhere at any time. And so please make us laugh a little bit. Let's have some fun. Send us pictures from the most unique or weirdest or on locations that you're joining from. That would be very appreciated. So send your pictures of you joining a Relevation to idris@relevation.org before 4 p.m. CET tomorrow. That was it. Wish you best of luck, and let's get started. The purpose of this session is to give us an overview of the status of the global status of PropTech ventures in 2023, Q2, Q3 already. So yes, give us a bit of flavor of where we are, what we have seen. Let's have the helicopter view. So you should normally be able to share the slides, and the floor is all yours.
That sounds great. I'm looking forward to it. Let me just give me a minute to get set up here and make sure everything's visible. Can we see that?
Yes.
Perfect. Well, great. Hello, everybody. It's great to be here to kick off this year's Relevation Conference, discussing the state of global PropTech venture capital. My name is Jean-Paul Baugen. I'm with Camber Creek. I sit in Zurich, covering and leading a number of our European opportunities and relationships for the firm. Before we get started, I just want to say thank you to Idris, Julia, and the rest of the Relevation team for all your efforts in putting together this industry-leading conference. We at Camber Creek are always looking forward to participating in Relevation every year, and Idris and his team continue to put together the standard, or set the standard, I should say, for bringing together the best thought leaders in prop tech around the globe. We welcome the opportunity to connect with as many of you in attendance as we can during and following the conference to discuss prop tech, real estate, or innovation more broadly. And with that, let's just set the table for today's discussion for the time we have together. We've prepared a presentation, as hopefully all of you can see, that we'll go through for the next 20 to 25 minutes, followed by a brief round of Q&A covering relevant questions from the topics we'll be discussing. And then following the presentation, I'll also share my work email in case there are follow-up questions that we don't have the chance to cover today with the time that we have. So with that, let's dive in. As a quick overview of who we are as a firm relative to this big world of prop tech, Camber Creek is the leading prop tech venture capital firm investing in technologies impacting the largest industry on the planet, that is the built environment. We have been investing in the space for well over a decade at this point. And in that time, we've raised 5 different venture vehicles, invested in 40 plus companies, and worked with a number of household names in prop tech, which you can see on the right-hand side of this slide here. Our team, first and foremost, comes from the real estate industry. We've built buildings, we've operated buildings, we've innovated within buildings, and we feel that we have a good sense for the types of technologies in the market that can grow into category leaders. But to be clear, we're not prophets by any means. Instead, we just try to be great partners. And to do that, we work with a very large network of real estate groups who help us identify and validate the technologies that we ultimately support with our funds and with our capital. This network over time has grown considerably over the last decade to more than 300 real estate groups around the world, all interested in being on the forefront of real estate technology and innovation. And it's our job, of course, to partner with this network to drive exceptional and, importantly, quantifiable value to our founders, which in turn will generate, we hope, significant financial upside for all involved in the partnership. Now, as we get into the meat of the conversation together, in the coming slides, you will see a lot of data points specifically related to this topic, the kind of the global overview of that prop tech venture capital market. I will do my best not to read through these statistics specifically, and instead let you read through the statistics as we go along. I will, however, provide some higher level commentary about each point. And additionally, I just want to preface one very big message to everybody tuned in. Things are certainly in flux and potentially a little uncertain, but that does not mean everything is quote unquote doom and gloom. With the topics we discuss here today, you'll notice that there are some very clear glimmers of excitement, hope, and upside for everything going on in the prop tech ecosystem. So while the content of this presentation might signal cautiousness, there is a lot to be excited about in prop tech right now and moving forward, which we will discuss in a moment. But before we dive into prop tech specifically, we would be remiss if we did not provide some commentary on the state of global real estate as a backdrop for the discussion. And as you can see on the first slide here, global inflation continues to be a talking point. I don't think that's a surprise to anybody tuned in, with the estimates for inflation's rate of change slightly off pace from projections and expectations for this year. Globally, we're still seeing inflation around 6 to 7%, but that figure is expected to drop notably in the coming 18 months. And ultimately, as this number comes down, we expect that there will be less pressure on businesses who may be focused on maintaining or improving their margins in the changing economic environment. And as that pressure subsides, we hope and we could begin to see an environment where decreasing inflation provides a buoy for startups in our industry as their customers begin to spend on additive technology products for their portfolio. Now, this point is directly in tandem with what the real estate market has seen with changes in cap rates and yields as well. And unsurprisingly, as inflation has evolved, so have appetites and requirements around real estate returns. Those are up. And while this 73 number might look a little scary, it could also present an opportunity for prop techs that can positively impact the returns of real estate assets and portfolios. Then lastly, and unsurprisingly again, investment volumes in Q4 of last year did drop pretty significantly, which signals to us that the market is cautious. So again, these are potentially powerful statistics to be aware of. And while they seem extreme, we as a firm at Camber Creek, we do see a number of opportunities for prop techs to prosper and succeed in the changing macro environment. Sorry. So as the real estate market evolves, so does the international venture capital industry. To quickly orient everybody to what you're seeing on the slide, what you'll see on the right-hand side of the slide is a chart comparing the euro to US dollar exchange rate on the last fiscal day, I should say, of each year against the average activity of US VCs and European deals. Or more simply put, how frequently were US venture capitalists seen investing in European startups? And what we think is particularly interesting as part of this graph is the comparison of those two metrics from 2021 onward. As you can see, and probably to no one's surprise in this session, as the exchange rate has become more favorable for US investors, we have seen more US investors in European deals. And right now, where we are today, the exchange rate is again swinging back in favor of the Eurozone. Which means that we are just starting to see US venture capital inactive and US VCs in European deals start to dip back down. Now, while the trend line is again pointing downward, it is important to note that the US VC participation in European deals in the last 3 years has been noticeably higher than the immediate 3 years prior from 2018 to 2020. So there still remains some what we'll call connectivity between these two ecosystems. It's just a little bit less than the last 2 years where we saw that large bull run in the venture capital markets. And that being said, I can't speak definitively for the entire venture capital ecosystem, but what I feel comfortable saying as part of the venture capital industry is we as VCs want to work with the best teams and technologies wherever they reside. And in our opinion, innovation should be rewarded. So while we are beginning to see a downtick in this quote unquote connectivity between US and European venture ecosystems, innovation in our mind, and a particularly high quality innovation, will continue to be rewarded. And these ecosystems will work together to support the best founders in their endeavors. Though, as is natural, and as everyone can probably imagine, with changing market environments, appetites around certain topics also change. So double clicking into prop tech venture capital now specifically, and for the remainder of this presentation, what has been interesting in the last 12 to 24 months is how appetites among venture capital or in the venture capital community has changed as it pertains to technologies addressing certain asset types. And while this chart is not exhaustive, to be clear, of all the different types of real estate asset classes out there, we think it does provide an interesting snapshot into the behavior of VCs investing in technologies addressing different parts of our real estate ecosystem. As you can see, both CRE and construction technologies were buoyed between 21 and 22, while single family saw a pretty noticeable dip in its ability to raise VC dollars. This all points to a bit of a quote unquote flight to safety phenomenon among venture capitalists. Recurring revenue again became the safe strategy to invest in because of its perceived stability and stickiness. Larger contract value potentials also became more top of mind. And data in various forms bubbled up as a topic that VCs return to as a tangible and robust competitive advantage for startups that they work with. We talked about data a bunch in Relevation 22, and I know we'll continue to talk about data in this year's Relevation. In our opinion, it continues to be a very attractive competitive moat from which to operate. Access to highly desirable data will be an advantage for startups that are looking to raise VC capital. And we point to two of our own companies who have leveraged that strategy very successfully, HappyCo in multifamily inspections and BTS in office leasing. Both have raised fairly substantial growth rounds in the last 24 months, and we believe their data assets will continue to be a buoy to helping them continue to do so as they scale even further. So as we dig in even further to what's happening in prop tech and venture capital, let me again just reiterate what I said at the top of this conversation. While the chart on the left may look a little scary, the takeaways from this data and the supporting commentary paint a more supportive narrative for PropTech and venture capital in general. So as you can see from the height of the bull market in Q4 21 and Q1 22, we have seen a decrease both in PropTech deal counts and PropTech deal volumes up until just this current quarter. However, if you dig a little bit further into this data, while things are on a downward trend at the top of this chart here, average venture capital dollars committed per deal might show a slightly different picture. You'll see that highlighted in red at the bottom of the average dollars per deal. That is, we saw the fewest VC dollars committed on average per deal about 2 quarters ago. And since then, venture dollars have ticked back up on average per deal, which could signal we have hit a certain type of floor in the venture markets. I'm not saying we have hit the floor, but maybe a certain type of floor. And appetites to dig back into venture, particularly PropTech venture, may be coming back around. Interestingly, however, as venture markets have softened in the last 2 years, in Europe specifically, we've started to see another type of vehicle step in to support founders who are innovating, and that's governments. A number of European governments have independently or collectively created venture vehicles intended to support startups looking for capital, and this, in our opinion, could not come at a better time. As you can see, the UK, Germany, the European Investment Bank are just 3 groups among many who are leading the way in allocating budget or raising venture capital intended to finance startups in their regions. So while the venture capital door might be a little bit smaller than usual, a little bit more closed than usual, governments, in our mind, have done a really great job recommitting to their technology industries that they are here to support while the market rights itself. Additionally, we've seen a bit of changing preferences for investing at certain stages in the same time frame. Earlier stage investments make up a vast majority of where venture capital dollars have gone in the last 2 years. And that pattern holds true for both real estate and construction tech. By comparison, venture capital dollars in Series B through Series D growth rounds make up less than 20% of VC allocation in that same time frame. Now, again, I want to reiterate points I've previously made, 2 points from previous slides that I think are important context for this part of the conversation. First, innovation, as I mentioned at the top of the hour, we believe that particularly high quality innovation will be rewarded, even at the growth stages. I look at companies like NPAL, Built, Casavo, Measurable, and others who have raised substantial rounds in the last 12 to 24 months amidst this changing market landscape. Secondly, venture capitalists are aware of how the market is evolving, aware of this phenomenon. It is hard to raise money at the growth stages than it might be if you're an early stage founder, which makes my point from the previous slide even more heartening that other types of entities and mechanisms are cropping up and coming up with creative funding structures and mechanisms to reward innovation in their respective technology ecosystems. So again, this is not all doom and gloom by any means, quite the opposite, in our opinion. There are stakeholders impacted by technology from across the spectrum, recognizing that the market is constantly changing and stepping up, more importantly, with creative answers and mechanisms for supporting founders financially so that they can continue, I should say, to scale their businesses. I would be remiss if I didn't talk about at least a few topics that heated up and cooled off in the last 12 to 24 months. To provide a little bit of context on this slide, these are topics that Camber Creek as a firm perceived cooled off and heated up as a product of the 1,500 to 2,000 opportunities we see per year. There is a little bit of art and a little bit of science to this chart, to this slide, but the headline is, we saw a lot of companies, but we saw incrementally more of some topics and incrementally less of other topics. And to be clear, this chart does not call out companies that are doing well and companies that are not doing well. There are likely companies in the bucket we've outlined as quote unquote cooling off that are doing exceptionally well. And on the contrary, there might be some in the heating up buckets that might not be doing so well. This is also not a commentary, to be clear, on the quality of companies in each bucket by any means. That's just simply a commentary on the prevalence of certain topics and how those appeared in our deal flow in the last couple of years. So to call out a few of them, we talked briefly at the top of the hour about single family. I'll address that topic as a whole. A number of single-family topics seem to be less prevalent in our deal flow than they had been in the period leading up to 21 and 22. At the same time, we've regularly discussed this enigmatic, quote unquote, return to office. There continue to be a number of companies we engage who are creating technology solutions to bring workers back to offices, to improve tenant experiences, and to create next generation amenification. We will continue to track this topic going forward for a few particular reasons. First, I'm not sure anyone can say what the future of office is going to look like definitively just yet. And while there is uncertainty, when there is uncertainty, we do believe that there's also opportunity. Secondly, we work with a number of leading office technology companies, including VTS, which is called out here, which owns a lot of data around office utilization and occupancy. And as many on the session might know, that utilization is still a bit lower than it was expected to be at this time. Although at current rates at this time of year, it seems to be on track to hit around, we'll call it 50 to 55% office occupancy, specifically in New York City, which some believe is consistent with we'll call it a new normal of hybrid work, where tenants are in the office on some days and working from home on others. And more frequently, we're seeing the convergence of fintech and prop tech, both in real estate technology and construction technology. We are investors in 3 of these companies here and believe this is a topic that will not slow down anytime soon. Home improvement and preventative maintenance was also an interesting bucket that popped up fairly frequently. As interest rates rose, homeowners were less interested in moving or buying a new home or selling. As a result, we saw an uptick in technologies that supported homeowners in getting their homes in better shape, whether that be through renovation or maintenance or other mechanisms. And our perception is that these technologies will support homeowners in getting their homes in a place that when the market comes back in their favor, the work that they've done in this down market is additive financially when they ultimately choose to sell. And lastly, ESG and climate tech, to nobody's surprise, continues to be quote unquote on fire. A number of notable companies have raised, excuse me, a number of notable companies have raised large or highly publicized rounds in the last year or two. We continue to track this market very closely and are already involved with a number of climate-related technologies through our investments in Measurable, Arcadia, Zentility, and others. Even through the market downturn, though, as I mentioned, companies will be rewarded for innovation and particularly high-quality innovation. A number of successful companies emerge with fresh rounds of capital that will help them to continue to execute on their roadmaps. Notably, Built Rewards raised $150 million at a time when not too many companies were successfully raising capital, let alone rounds of this size. They continue to make waves in the market, announcing partnerships with a variety of companies to further improve their points and rewards alliance and engage multifamily renters across the US. Casavo also raised a substantial round as this market was ticking downward. Interestingly, they did so in a vertical per previous slides that was, in our opinion, cooling off quite quickly, and came out of that fundraise with a fresh round of 400 million euros, raised from some very notable venture capital firms and strategics. They used that round to acquire additive technology startups to further their expansion across Europe. We're excited to track what they can continue to do with that, that fresh powder. And lastly, Measurable announced just in the last couple of weeks a $93 million Series D. We as a firm are excited about the global market leadership position that Measurable has established over the 6 years that we've worked with them, and believe they'll continue to establish themselves as the de facto ESG software on the planet. There are a number of other companies that set themselves up for success in the coming years by raising substantial venture capital rounds. Again, this is not an exhaustive list by any means, but that list spans from construction tech startups like Alice Technologies to digital notarization platforms like Notarize to climate tech startups like Arcadia and everything in between. Again, this is just a small group of a much larger ecosystem of companies that raised venture capital dollars in 21 and 22, who are in a position with extended runways, fresh capital, and a vision for leveraging their bolstered balance sheet to grow their companies even further. And throughout this market evolution, we saw some really promising signs for the future. This is where we as a firm and kind of a venture capital industry, in our opinion, get excited. 2021 and 2022 were very much so different years for first-time venture capital fund managers. While 2021 was a record year, 2022 was a record year slightly in the wrong direction. However, the highlight within this data is that amidst that slowdown, average first-time fund size, I should say, hit a record high of $75 million. To us, this could signal the quality of fund managers that came to market last year. That quality could be quite notable. Whereas we saw fewer quote unquote proof of concept funds with track records that might not be quite as robust or significant. In Europe as well, as you can see on the right-hand side of this slide, the number of first-time fund managers who successfully raised a fund also remained relatively stable. Additionally, at the same time, repeat fund managers were able to raise significant amounts of capital in 2022 as well, with average fund sizes for repeat managers hitting $211 million. So again, to us, this shows great signs of promise for the venture capital ecosystem and founders looking to raise VC capital moving forward. There is venture capital dry powder out there. And as we've discussed throughout this presentation, innovation, high quality innovation, more specifically, will continue to be rewarded. I want to end this keynote with a word about what venture capital firms can do to be supportive as market cycles ebb and flow. What has impressed me as I've gotten to know the PropTech and VC ecosystems, PropTech founders and partners that we work with, many of whom I'm sure might be on this talk. This is a highly collaborative ecosystem, and I think many people subscribe to the concept or the notion of a rising tide lifts all boats. As a venture capitalist, I need to constantly remember that while capital is a primary form of value that I and we as a firm can provide to founders, there are other valuable resources and insights that we can share with founders to help them navigate through market downturns. I call out a few here using a very basic framework that I'm sure many of you are familiar with. For example, perhaps there are opportunities to find great talent amidst the market downturn. Naturally, as markets go south, some companies might also, and with that brings a lot of talent into the market that startups can engage to bolster their strength and quality of their teams. VCs with our networks can be helpful to accelerating that process. So to my VC colleagues out there, consider how your network can help find the best talent for your startups as markets change. Secondly, technology. This is an interesting bucket because in a market downturn, we would likely not advise to spend too heavily on non-essential tech expenses. However, there are ways to perfect technology that could be additive at a fraction or at no cost to position a company for strength when the market comes back around. For example, we've worked with our company HappyCo for quite a while to help them identify additional applications for their large data set, including running curated meetings between multifamily executives and their senior leadership to think about how to develop a robust product roadmap. And lastly, traction. Simply put, VCs have networks and those networks differ, but a VC can always be supportive of companies by making introductions to high value prospective customers. More importantly, however, in our opinion, making sure those introductions are massaged all the way through to consummation is very important. The value doesn't just stop at brokering an email. We try to be hands-on when we are needed to be clear, to massage these relationships to a point where where the likelihood of that startup and company becoming partners has the greatest likelihood of actually occurring. And lastly, before I pass it back to Idris, I want to reiterate a few points that I've made throughout this talk. Markets changing is not always a bad thing. Like, even when we hit what might feel like rock bottom, there are opportunities abound for founders, VCs, and the broader real estate community. Sometimes it just takes a little bit of creativity to think about what that opportunity is and what it can look like. Secondly, innovation specifically, as I continue to say, will be rewarded. And as VCs move to work with earlier stage companies, that does not mean all capital for growth stage companies goes away. Quite to the contrary. It means that growth stage investors may be a little more selective in choosing the companies they work with, where they can be most valuable. But what's promising in our mind is that other entities, like the government point that I mentioned previously, want to be supportive of providing a robust capital ecosystem as well. And lastly, the relationship between VC and startup, to no one's surprise, it's a partnership. For founders who are listening in, if appropriate, work closely with your VC partners to think about how your respective networks can create success for your business. In our opinion, again, capital is just one facet of the value we want to provide to our founders. But the strength of our partnership is really solidified by the other things we can do to add value to the companies that we work with. So with that, I know we have 5 minutes. I'd like to say thank you to those that listened in. I believe we have a few minutes for Q&A. for which I'd like to pass it over to Idris and team. And if anybody would like to connect following today's conversation, please don't hesitate to reach out.
Thank you, my dear. It was definitely a great helicopter view. And you mentioned a couple of times this concept of high quality innovations. So I wanted to have a bit your opinion on a very specific thing that my advisory board shared with me the other day. They said that, you know, before the age of or before the era of AI, like the VC were a bit in the era of abundance. Like they were excited about any SaaS B2B, and now they started to understand that they should focus on only on what is really critical. So what like a database, etc. This is critical, but an app to walk your dog or something like this is not critical, you know. And so the same happened really in real estate. That they try to now differentiate essential innovations from non-essential innovations. You know, like it's really the same when the lockdown started in COVID. All of the shops were closed. I mean, suddenly out of the blue, you had this new segmentation between essential shops and non-essential shops. Essential shops were still working. Non-essential were forced to be closed. And so my question is now in this current sort of crisis context, you know, like high inflation rates, increasing of cost of construction materials, real estate transactions are really going down, the margins are shrinking, etc. So they need to cut the cost, but they need to keep investing on what is really essential. So do you have this view like on what is essential, what is non-essential? Do you look at this way as well?
Yeah, and it's a great question. I think Idris, one thing that the pandemic that we think the pandemic introduced as well was we'll call it velocity. And velocity in some cases is good, but in other cases might not be so good. So there was a period of time in the bull market where we started to see the speed of term sheets coming out of venture capital firms being exceptionally fast.
Mm-hmm.
And I don't think it's to anyone's surprise, running a due diligence process in 7 days or 48 hours is not easy to do. It might just be completely infeasible. So when you talk about essential versus non-essential, it's hard to define those points unless you have some sense of relativity. And what I mean by that is if there's a market out there that you're digging into, you need to know who is in that market, who's doing what, who's innovating in that market, and how they're innovating in that market. And when you are in a bull market where term sheets are being churned out in 48 hours, you can't really do that. Yeah. So our perspective is that, you know, venture capital doesn't always have to be about velocity. It can be about adding value first, understanding all the players in a certain ecosystem, understanding their respective offerings and how those offerings impact real estate, which is where we start digging into the point of what's essential and what's non-essential. Yeah. And to be clear, that doesn't mean a non-essential versus essential business is a better business than the other. It's just our industry thinks about technology differently. And unless you have that relativity across essential and non-essential, it'll be really hard to make the right decision and support the right teams.
Thank you. We are out of our time for today. I have a lot of other burning questions, but we have to respect the timing. So thank you very much, JP. That was a pleasure, and speak to you soon.
Speak to you soon. Have a great day.
To move the needle, to increase the innovation maturity of construction and real estate, but also to help us to win the battle against climate change or all of the other battles that happened in cities. So we will unpack all of this, but to discuss this very complex and comprehensive topic, I'm honored to welcome Erastus Nyuki from United Nations UN Habitat. Welcome. I'm also honored to welcome Dr. Olayan Harbi from the Ministry of Municipal and Rural Affairs of Saudi Arabia, and also Frank Mauen from the EIC, so European Innovation Council. Gentlemen, welcome on the grill. Let me maybe start off with the first question to ask maybe if each of the panelists can start by explaining in which capacity do they speak today. So what is your role, responsibility? So starting off with you, Frank. If you do hear me, Frank? Ah, we don't hear you. We don't hear Frank, but we will set this up in a second. Why don't we continue with Erastus? Erastus?
Yeah, thank you so much, Idris. Thank you so much. You can hear me, right?
Yes, perfectly.
Great, great, great. So my name is Erastus. Njuki is my last name. And I represent the Citizen Investment Facility, which is housed in United Nations Human Settlements Program. That is UN Habitat, right?
Yeah.
And my role at the Citizen Investment Facility is to manage this entity, which is geared towards unlocking private investment in cities, right? And UN Habitat in general is the agency at the United Nations that promotes sustainable development in towns and in cities. So at Citizen Investment Facility, we are transforming government projects from concept stage to feasibility and on to financeability, all right? So our goal is to channel about 500 billion USD by 2025 to these public projects, yeah? So that is my short introduction. Back to you, Idris.
Thank you.
Yes, can you hear me now?
Absolutely. Go ahead, Frank.
Okay, I'm sorry for this rough start. Yes. Okay, so my name is Frank Mauen. I work for the European Commission, for the European Innovation Council. European Innovation Council is an extension of the Horizon Research Program, basically bridging the gap between science and wider market adoption using the entrepreneurial vector. It's a 10 billion euro commitment for the next couple of years. For example, this year, 2023 work program is 1.6 billion. I'm in the capacity of a program manager for architecture, engineering, and construction. So I help guide the program together with the stakeholders in venture capital, research, and corporate to align the investments and the grants towards desired innovation as well as the open goals.
Pretty clear. Thank you. And Olayan?
Hello, everyone. I'm Olayan Al-Harbi. I'm the advisory of the Vice Minister of the Rural Affairs and Housing, mainly focus in the housing sector and real estate and housing sector. My role to increase innovation and building a new solution. Could be digital solution or could be other solution to increase the home ownership in Saudi Arabia, to mature the real estate sector in the Saudi Arabia.
Okay, crystal clear. So we have different people from different parts of the globe. So maybe what I would like to ask is, let's talk about the construction challenges. So it depends on which part of the globe we look at. In some parts, we need to build more. In some others, we need to build more sustainable. We need to source additional workers. We need to renovate more, etc. So what are the biggest challenges that you currently are focusing on? Maybe starting off with you, Frank.
Yeah, so geographically, I focus on the 27 member states of the European Union and maybe some associated countries. So that's my target. So what I mentioned before, it's a bridge between science and market adoption, which can also be explained as our focus in innovation spectrum is deep tech. So science-based venturing, technology-based venturing. But and everything in the European Commission is or in the EIC is embedded in a policy framework. So, for example, for me, a very important policy framework is the European Green Deal, but also numerous other frameworks like digitalization. But hands down for me, for the years I'm helping to build up this program, is really decarbonization. So decarbonization of the architecture, engineering, construction value chains.
Okay, that's pretty clear. What about you, Erastus? What are the big challenges that you currently focus on?
Yeah, thank you so much, Idris. Actually, because we work on a global scale in UN Habitat, right? There are some key figures that I think it's good to just get out of the way so that people know what we are dealing with when we are talking about the housing challenge, the construction challenge, right? So we have 96,000 new affordable and accessible housing units demand per day, all right? 96,000, and we have 100 million people right now in the world who are homeless, all right? So we know that with all this great demand that we have for rental house units and the challenges that we have to meet this demand, all right, we need more units, we need adequate housing programs and units, and then they need to be also affordable. In UN Habitat, we normally say it, adequate housing is a human right, all right? So to address all the challenges sustainably, we need to think about how do we build more adequate and affordable.
Yeah.
Thank you.
Thank you. And Olayan, on your part of the world, what is the biggest challenge that you currently focus on?
First of all, I would like to, it's a great challenge that you are mentioning, Arstas, to provide and to provide people with affordable housing over the world, and also Frank to make this merge between science and technology and make it in practice and real. And for me, I think we are trying, if we are focusing in affordable housing or are focusing in increase the supply, it's a great challenge, and it's also open opportunity. But also my focus to increase the adoption of a new solution, a new business model, because if we solve the big challenge in terms of business model, in terms of a new partnership, not doing business as usual, this will uncover many challenges. In Saudi Arabia, maybe we are having a great demand these days, because we have ambitious goal in the Vision 2030. However, people are maybe facing some challenges with the preferences. We don't have maybe a big issue in affordable housing. However, it is not only residential sector, but we have residential sector and commercial sector and other.
Clear. Thank you. So we mentioned 100 million of people that are homeless, yeah, if I'm correct, Erastus. So that's huge number. And so of course it means that we need to build a lot. And we know that there will be 2 billion of new people living on Earth by 2050. So it means we need to build something like 11,000 residential units every single day just to be able to house these new people that will come on Earth. So it's really big numbers, of course. So I would like to hear your thoughts on the standardization, because I guess if we want to scale the home production, at some point it means that we must standardize it, right? And so we must make sure that the sector speaks with the same industry standards, the same references, the same narrative, that we have a common single source of truth. So we need to define taxonomies, etc. But my question is, should the standardization efforts come from the private sector or from the public sector? Starting off with you, maybe, Erastus.
Thank you so much, Idris. So when I think about standardization, and it's a good reference to think about it from who is responsible for this standardization, so that we can push to create new development with a standard that fulfills all our ambitions, all right? One of the ambitions that is key for the private sector is to maximize return on investment. So we cannot compromise profitability. So I'll try to come from the angle of incentives, right? Because incentives is a clear way where government should help private sectors to push the idea of creating new, I would say, resilient, low, zero carbon building investments, right? So governments can have all these activities in to create both financial and non-financial incentives. And on the side of the private sector is to take on these incentives, first of all right, and to cash in on them and to propagate them through creating standards that align with these incentives, all right? So that incentives are visible to the standards that the market is supposed to absorb, all right? So that is the balance that we want to advocate for, all right? So the private sector not only should capitalize on this incentive, but should also rethink, innovate ways in which they can deploy construction materials and techniques that are both profitable and sustainable. I just want to highlight that point, that profitability and sustainability should always be in the mind of private sector and the public. Back to you, Idris.
Love it. Crystal clear. Thank you. Frank, what would you say about this?
Yeah, maybe don't want to get too philosophical, but maybe standardization can also be seen as a kind of an emergent behavior of a complex system, right? You know, there's a reason why we have three-bladed wind turbines with a horizontal axis, which selected themselves in the market from many other options. And I think something similar happens in any industry. On the other hand, it's important to realize what kind of innovation we are trying to achieve in construction, right? We have a transition innovation. We are creating a desired future away from an existing situation. So in a sense, we also have that this must be a close collaboration between public and private, because, you know, for example, if I have startups that develop or invent a new type of, I don't know, construction material or cement, as a public body, we have to ensure that the standards and the policies and the regulation are in place that are creating a level playing field for those new innovations to be successful compared to the existing incumbents, right? The ongoing affairs, basically.
Yeah, crystal clear. And on your side, Olayan, what are your views on this? Like the importance of standardization, and should it be an incentive? Should it be a regulation? Should it be pushed? Like what are your views on this?
This is not an easy question, and it's not an easy ask, by the way, Idris. And thank you. This event is online. Otherwise, we will have a problem with the power outlet where you go in the world. And this is a simple thing, guys, and it's not standardized yet. However, there are a need behind that. Every community has their own need. Every industry has their own need. So reaching standardization not easy. But I will give example here by language. No one can create language by themselves. To have a language, you need community. You need people to speak with. Then you come up with the language. So in my opinion, and through all the years, to have the right to standardization, you need to have the right community. You are doing a great job with your team here to bring all people together. So having all stakeholders in one table and not only focus on one country, it should be a global, because now we live in a small home. Everybody, we are living in the same world and learning from each other, and having the standard will help us to provide enough homes, and a population is growing, and as maybe Orestes mentioned, how much we need per day. So having a standardization will help us. However, it's not an easy ask, cannot be led by private sector, because they will move fast based on the availability for their business, and government usually have the, or regulation entities, government or other, have the ability to set the standardization, but could limit the opportunity. Yeah. So having the center point between each other and you know, material, when they become close to each other, become stronger.
Yeah, Okay, I think there is a common agreement on this perspective here. Now it's been 10 years that I navigate in PropTech. Before that, the word PropTech exists, and still I have the feeling that the concept of smart city is something that remains vague, that doesn't have a real successful use case. I've never seen a smart city, something that we speak about during the past 10, 15 years. And so my question to you is like, does the prototype of a smart city already exist? And if not, why? What is blocking? Is it that it's maybe a nice to have, but the most important is affordability and building adequate homes? Or like, why does smart city don't exist already? Over to you, Erastus.
Thank you very much. In fact, Idris, I would love to hear about this experience by PropTech later on. We could discuss it, because whenever we're discussing smart cities, even with the people we serve, right, the cities, the governments, and Dr. Layan can give me some ideas of what he has done in Saudi. We always advocate for people-centered smart cities, right? So humans at the heart of it, where technology is employed to improve quality of life while respecting human rights, all right? We believe that profitability and, an ROI is long-term, all right? That's whenever you put in the ROI long-term and the investments and the benefits of that investment long-term, you would see the people benefiting from it with equitability and with environmental sustainability long-term, right? But if you put everything short-term, then you forget about the ultimate aim, to make the humans who live in these cities happy, right? So there is one example that we loved last year, and at UN Habitat we awarded them the UN Habitat Scroll of Honor Award. Yeah. It's called the 15-minute City Global Initiative. I'm sure you've heard of it, right?
Of course.
So this is not the perfect smart city idea, but it's one of those creative elements that have come from both private sector and public sector coming together to build in, a walkable, mixed-use, compact neighborhood that utilizes green corridors, green infrastructure, etc. Right, and it has multiple benefits long term. Right, so we know that such good examples exist, but there's gonna be many questions that will still come. Even with this 15-minute city idea. Is it going to lead into further social segregation? Are you going to only loop up the wealthy people in one corner, and who's providing those services and where do they live? So all these questions will also need to be thought about and improved for later models.
Yeah, clear. Frank, any additional comments?
Yeah, I love the previous comments about people-centered smart cities. I think it's always super important, and I advise anybody to study into it. If you want to understand transitions, it's really good to understand complex system science. So, and cities are the prime example of emergent behavior of humans interacting over hundreds of years or tens of years, right? I think what smart cities suffer when it started 20 years ago, I'm still not 100% sure what it is, but is that you impose a desired vision on top of a very complex interaction of humans, and understanding these transitions is important to maybe cope a little bit with the disappointment of the smart city not evolving as you wish. For example, I think in mobility we see a lot of movement. I think a couple of years ago, 5 to 10 years ago, we dreamed about autonomous cars, and that would solve all the traffic jams in all the cities. But there's a wonderful quote by a professor in Amsterdam, Marco de Bronnenstoet, who's the bicycle professor, who said, well, we don't need driverless cars, we need carless drivers, right? So you see this transition basically in a couple of cities now in Europe, prime example being Paris, where you see this mobility change, especially after COVID, to embrace more humble forms of transport. So yeah, I hope that's kind of a direction of the answer you were looking for. Yeah.
Thank you. And on the example of autonomous vehicles, I think it will actually increase the traffic congestions because you will have additional drivers, like maybe a dog or a grandmother that was not driving anymore, and so you will have more vehicles on the road, more problems.
Exactly.
But
And a
okay.
mobile parking place. Yes.
Olayan, do you want to add a really quick comment to this one, or should we move on to the next?
Maybe simple add here. This is normal. We still there are many features about freezer or freezer when they came. People at that time did not figure out the benefit of it, or smartphone or other. So there is a normal maturity growth for any new invention, and people in the beginning may not realize it. And technical people love to show their capability, so they will come with many solutions. They are, some of them, human-centric, as Aristotle mentioned. Some of them are not. However, with time, we will meet the point where we can benefit out of a smart city. Important point, some great example cannot be led by a startup or companies, need a huge company, big company, or government. Example of the Lion or Neom in Saudi Arabia, 15 minutes walk this city. This is cannot be company initiatives because it could be not benefit in the coming 2 or 10 years, but it's a huge project that need a big investment.
Yeah, clear. So I'm very excited about the relations that the tech giant and the real estate giant should have, because we have the rising. We have a lot of examples of non-real estate companies becoming real estate companies to show that they can operate a smart city. So we have the example of Google Sidewalks Lab, we have the example of Siemens Stadt in Berlin, we have the example of Woven City from Toyota, etc., etc. But in this sort of equation, I'm also curious to understand what role the public sector should play in the conversation between real estate giant and tech giant. Like, should they also regulate this? Should they play a role? So maybe Dr. Olayan, could you tell us a little bit like the vision of Saudi Arabia by of 2030, for instance, to explain us a bit the role that public sector should play in this conversation?
I think one of the most important elements that will help us to advance and bring more human-centric solution, I will use this recitals, is to close the gap. To close the gap between different sector. I will not say only private and public sector, but technology sector and real estate sector, and manufacturing and real estate. This is important. However, the government, I want to answer your question about Vision 2030, the government need to be faster than the private by setting the regulation, by setting the objective and goal, because private sector always led by the benefits, looking for the revenue. However, the government should set the vision. In Saudi Arabia these days, people run away maybe from government sector to private sector because they said government now has faster pace than the private sector. In government, we work more working hours actually more than the private sector. Our goal and objective very ambitious, but let me tell you, it's coming right. I was in Neom last week. Hotels are almost ready. So answering the question, the gap between giant and technology company and real estate company, why we want to waste our time to reinvent the wheel? Why technology company spend huge of time to understand the real estate? And by the way, real estate or urban technology, it's complex. It's a huge value chain. It is not like e-commerce or other. And there are tons of stakeholders engaged there. And they think there is opportunity for each of us to focus in the area where they are good in it, and use this time to invent a great solution and collaborate. And by the way, Frank mentioned the complex system and all the scientific approach. And scientists and researchers always collaborate and compete. They collaborate by learning from each other and compete in bringing a new solution. And this is where we would like to focus, by collaborate, by understanding the know-how and the business from the people who spend their years in the industry, and use technology to advance that industry. And this is another challenge from the real estate point of view. Maybe I came back from computer science and innovation background, and usually I enjoy understanding a new business and help them. So real estate by nature has silos. They buy lands in secret. I'm honest and transparent with you guys. Sharing the knowledge, it's not easy in matured business. Let me put it in this way. Matured business, usually they feel they reach the maturity that they used to work on it, and they are happy in it. But the demand is huge. The need is huge. It's need to intervene from other. So business owner and industry expert need leave space to newcomers like technology company to help them in meeting their goal.
Okay, thank you for this comprehensive answer. We have 2 minutes left, so I will be very to the point. I would like to ask to everyone your views on the impact of AI. So a lot of thought leaders, Elon Musk, etc., said that it could be an existential threat to human existence. You know, like it could be really like a end for good humanity. But this is the downside, and the positive side is that it could tremendously help us to boost productivity. We could potentially build in days things that we have been able to build in decades in the past. So what are your views on the impact of AI in our world? Olayan, if you want to say in 2 words.
I'm always positive. And if you review the history, any new technology, people are afraid of it. It will kill employee or job. It will reduce opportunity. However, with time, we see it's improving our humanity. The brain of a human way advanced, and it always will use a new invention for the best of us.
Okay, thanks. Frank, are you also positive?
Yeah, by moral obligation. But I think I'm curious and I'm cautious. I mean, I can talk about this subject for hours, but I only have 1 minute. You just told me. I think existential risk discussions evolve about artificial general intelligence. We don't have artificial general intelligence, but we do have an existential risk at our hands, which is called climate change and biodiversity loss. So I would say focus on that one, prove that you can change a society and save us from that catastrophe. And then in time, we will also solve the other one.
Yeah, clear. And you, Erastus, what are your views on this?
No, I think so long as AI is from humans, for humans, the risk is overstated, because you look at the benefits. I mean, just look at how you train your own ChatGPT, right? If you say something like, you know, human is God on ChatGPT, and ask ChatGPT to tell you every time it responds to you that humans are my God, ChatGPT will do it every time. All right. So that is important to note. Yeah.
But they also say that the ideal recipe of pizza includes pineapple. So it's so okay. But okay, thank you very much. I think this was frustrating for me because we needed 1 hour, not 30 minutes. So lessons learned. But okay, thank you very much. It was an honor, and speak very soon.
Thank you
very much.
Thank you very much.
So ending right on time and continuing back to back, we will now discuss the CVC, corporate venture capital, and the best practices. So we have our 2 wonderful next speakers. Welcome, Tanya. Welcome, Jonathan.
Hello.
Nice to see you, both of you, as always, Idris.
You're gonna make me red. Okay, so welcome both to the grill. We will discuss the topic of corporate venture capitalism with two seasoned people that I think have been on both sides, more on the investor side, more on the corporate, more on the startup side. I mean, so you have a lot of background, both of you, I think. So why don't we start with maybe a quick overview of your current I would say activities. So maybe how many FTE size, how many investments you must do, like just understanding a bit the magnitude and the context. Starting off with you, Tanya.
Okay, wonderful. I assume most people know who Nemetschek Group is. Maybe later on, I will have an opportunity to quickly describe how we see the world from the 4 pillars from the AECO lifecycle. But the ventures team is relatively new. I can't believe 2 years have gone by so quickly, but that's how old we are from a ventures perspective. We're a small team. We're only 2 people, 2 full-time individuals. We've invested in 11 companies across all stages. So we've done even as early as pre-seed, pre-revenue, all the way to Series D. So I'd say we're stage agnostic. And we're global. So most of the investments we've done have been in Europe and the US. We've done 1 in Asia. And again, pretty much stage agnostic. So from, like I said, pre-seed to Series D.
Wow.
Yeah, it's crazy,
Yeah,
but it's fun. It's exciting. Yeah.
Great. Jonathan, what about you?
Yeah, of course. So I can say a few words about Saint-Gobain, but very, very quickly. So we are a construction material company. The company was born in France, but we have operations worldwide at the moment. And so the CVC that we call Nova is a bit of a old story because it started in 2006, originally as a open innovation branch that gradually turned to investment. So today we are a team of 15. We've got a team based in the US. I belong to the team in EMEA. I'm based in Paris, and we've got the rest of the team also in India and China. So trying to invest globally. At the moment, we have invested in a bit north of 45 companies. We started doing direct investment in 2019, so that's relatively recent for the group and the existence of Nova. And so we are a bit more narrow in terms of series as Tanya and Nemetschek. So we start from pre-seed and seed, so really from a really early projects, really R&D focused, to seed series A. Let's say that we invest usually up to 3 million. We can do a bit more, but in that case, that's a different governance, different process. So our focus is really early stage there. And the idea for us is to invest in what we call in-house transformational growth. So that's really linked to new revenue opportunities for the group and the low carbon transition.
Okay, crystal clear. So you mentioned your stage of maturity that you're excited about. So on one side we have stage agnostic, and on the other we have a pretty early stage. So that's a perfect bridge for the purpose of this partnership. So what are the purpose of your partnership with startups? Because we can have many different ways to partner up. It can be non-equity or non-dilutive partnerships. It can be equity-related partnerships. So I would like to understand a bit, what is it that your firm wants to achieve? What forms of partnership are you actively pursuing? Is it only investing, or is it like incubation, acceleration, funding, development, spin-off licensing, CVC, joint venture? I mean, so what's the purpose of your partnership? Starting off with maybe you, Tanya.
Well, so I don't know. I'm sure that Saint-Gobain, with the fact that they've had a longer history. So we are at the beginning of our open innovation journey, right? So in the past, Nemetschek has been really strong in M&A. So the financial holding company that we were in Munich, we buy revenue, right? We buy companies. This is what we're good at. When we started with venture, the question is, why do you do that, right? So I see it's going to evolve like all corporate ventures usually do. Initially, when you start out, I think one of my most important tasks is to really understand who's disrupting our markets and make sure we transport that knowledge to the business units to make sure that they're completely aware of who the disruptors are and what's happening in the industry, right? And then, so of course, one of the ways to get involved is to start investing in these startups. So I see that as my most important purpose, and it's very strategically aligned. There's no financial pressure at the moment for me to generate some IRR or return on invest. That might come in a few years' time. But we are not in a position yet where we are also engaging in sort of our own accelerator programs or even a company builder, venture studio. Yeah. Those are things I'd love to do and I have a lot of experience with, but we're just not there at this time. What we do, however, is because Professor Nemecek and the TU Munich is very closely aligned, we do have a strong partnership with the university on a number of fronts. So, for example, Georg Nemecek has created this Institute of Applied AI, which is a whole sort of research on AI department. We focus with an accelerator program called Expreneurs. We partner with the university, the Department of Architecture. They do a venture lab, built environments. So we collaborate on a lot of different fronts. So a little bit on R&D. We partner a little bit with accelerator incubators, but we're not executively doing it ourselves yet.
Yeah. I love the fact that it seems that there is, different horizons. When you do CVC, there is horizon one with the first target is to have access to information, access to understand new business models, new technologies. Where is the disruption going to come from? And then you have maybe horizon 2 in 2 years, horizon 3 in 5 years, which will be maybe more sort of incorporating the new companies into the existing. So I love this vision more on the long term. And on your side, John, can you tell us what's your purpose?
I think you made a very good point, and that's part of the complexity of CVC as well, trying to balance between what's the long term to bring that vision, competitive watch, technological watch to the businesses. But on the other hand, if we want to make the investment work, we need also some technologies or projects that can be implemented like right now or in the upcoming couple of years within the business. So trying to find this balance is a bit complex. In your original question, I think there were like two main aspects. I mean, there's the purpose and there is the way that we want to reach it, right? So on the purpose, I think that Tanya mentioned, the main elements for us are the market watch is obviously very, very important. And then investment is a way. So as a CVC, we can expect minority equity investments, but it's also all the maybe hidden work that is done behind of other projects that we see that we don't invest for many reasons, but that are still relevant to the different businesses. This has a lot of value. In the company I was before, I think I was in a independent VC, but with a limited number of LP. If we ended up investing in about 10 companies a year, we had about 150, 180 that were sent to our LPs individually for actual first talks. It didn't necessarily ended up in collaborations, but at least there were some discussions, some talks, some initial projects, and so on and so forth. And that's a lot of value already. And at Saint-Gobain, we've got more or less the same ratio, right? So this is important, and I would say that at the moment,
1 out of 8.
Yeah.
Okay.
And so I would say that after that, in terms of the channels, the tools that we use, we adapt to the country, to the business, to the maturity of the startup. So there is just like this toolbox that we can use. Usually, when we do an investment, it's because we've got one business unit that is sponsoring the investment, right? So we want a buy-in from someone, operationally speaking, that can have this roadmap to work with the company. So if we invest, we want at least something that looks like either a joint development agreement or some roadmap for commercial development of some products. So we want to have a little bit of visibility on what's going to happen next. And so it can be a JV, it can be whatever, then it depends more on the opportunities and what just makes the most sense for both companies at this time.
Would you allow me to ask a question? I'm not hijacking your moderation here, but this is an interesting one. Because we started out that way as well, right? The easiest way for me to understand what's happening is I need the business unit to help me not just understand the technology, but to give me feedback. And so for the first couple of investments, I wouldn't be able to do something without the go of the business unit. But we've learned something pretty radical, I think, and that is something along the lines of confirmation bias that can come along with, that viewpoint of the business unit. So I'm now given more freedom to operate despite whether a business unit wants the deal or not, to be able to make an investment despite them maybe saying no. And I think that's a very interesting evolution in CVC. Yeah, so just, John, has that conversation come up with you guys, or is that just something where you're like, no, we stick to the strategic business unit approach?
Yeah, no, I mean, I think for corporate VCs, it's both the biggest advantage and a big challenge as well to have the buy-in of the businesses. An advantage because you've got access to the market knowledge, technological knowledge, so your due diligence is quite facilitated by that. But just like you mentioned, there is this bias that also drags your investment to something that is a bit closer, a bit more horizon one in terms of disruption, let's say, of the market. So today at Nova, we need this buy-in. So we need the sponsor from the businesses. Okay. If we, as Nova, we see something that is maybe a bit more forward-looking and that we really believe in it, then it's up to us to push. And probably in those cases, our sponsor will be a bit higher up in the hierarchy of the group to allow that. But it's definitely a tougher fight.
Okay.
Great, which is also a good bridge to the next question, because the title of this conference was the best practices. And so I would like to understand a bit the do's and also the don'ts in all of the life cycle of venturing. So if we start with the sourcing, what are the challenges? What are the best practices in terms of sourcing for you? Maybe starting off with you, Tanya.
Again, I don't have a team of 15 people, and you make me very sad, John. But with the limited resources that we have, honestly, deal flow is not my problem. Right? It's like if you've been in venture for as long as I have, even if I didn't invest in funds, which I do, and they provide me tons of deal flow, I personally think that is the best practice. Until you have a massive team, for us, the best way is to invest in funds that share deal flow with us. Yeah. My problem is an execution problem, right? There's just going to be some deals we just can't get done because we're just a limited team. Yeah. But I think, again, fund investment is a great strategy for us.
So a best practice would be to be more than two.
Wow, that would be an amazing practice. But a great practice, I think, especially if corporates are thinking about starting their venture journey, start investing in the relatively very hyper-focused vertical funds that specialize in the sectors you want to engage in.
Yeah. Your points, John?
Yeah, I mean, our team is a bit bigger, but we have the same issue, right? So the same situation. Deal flow is not a problem. I think we've got too much deal flow for the size of the team. It's more about how we process it. And so, just like what you mentioned, Tanya, for me, VC investment and CVC as well, it's really a job of efficiency, right? Because you want your first part of the funnel to be as wide as possible, because you want to grasp those weak signals, those market trends, and you don't want to miss anything. So I think it's good to have a bit too much on your hands, but then where you get where you become a better investor, I think is really on how you process that, how you've got your quick go, no go flags at every single part of your assessment. So in the end, it's a lot about a bit of tooling, I guess. So we've got more and more automation in the way that we want to process this deal flow, how we want to share it internally, collect feedback, go back to the entrepreneurs with yes for this, no for that, and not just this maybe kind of answer. We are checking on this that lasts for months. So there's a tooling part. There's this process that makes it go boom, boom, boom on the different aspects of the validation. And it goes back to the governance in the end. What are your decision-making bodies? Who do you need to talk to? Who makes the green light for the investment? So that's you can get there as quickly as possible. As a CVC, it's hard to be competitive on speed with VCs, right? We know we are slow. We might be faster than the group, but compared to the VC space, we are slow. So we need to find our advantages elsewhere. And so
I've tried to be fast, and then I have to beg for forgiveness afterwards because you break rules or some things just aren't done because deals don't wait, right? And if you want to be a part of it, then sometimes you have to be a little bit crazy in terms of process, and that challenges the organization. But again, that's part of sort of the transformation of innovation, and it's part of that journey, right? That we take the company on also.
I love it. Totally. And you know, we often say that the best answer for a founder is a yes, but the second favorite, most favorite answer is a quick no, not a long pending maybe. Of course, this is the worst. But okay. So after that, after the investment phase, now starts the curation. Okay, so you need to have value for the founders, try to do cross fertilization with the group, etc. So. How do you work with founders? Do you maybe have a structure, an action plan, a process? Do you try to commercialize the product internally? Can you support the cost of R&D? Can you maybe share a few examples? So how do you work with founders? Starting off with you, Tanya.
Oh, thank you. I'm so sorry, John. Ladies first, always.
That's all right.
So I would say in the first 7 or 8 deals, I developed something called a matchmaker canvas, because I think the hardest thing for both people, for both the founders and the corporate, is expectation management, right? So there will be founders that part 2 will not even speak to you because you're strategic. And so they're like, thank you very much, but we don't want your money. So this is one of the things I suffer from occasionally. I get very sad because founders won't take my money because I'm a strategic. Yeah. On the other hand, there will be founders who love it, especially because we're strategic. And as long as we play well and we don't, exaggerate on all of the things that we want in terms of governance from a founder, you build a reputation and you're a good CVC to work with, and you get invited into rounds alongside other investors. And those are my favorite deals. In those deals where I was the lead investor and the only one, A, I'm terribly slow. And B, we had to learn, what kind of partnership can we really offer the portfolio companies? And so for us, it's really quite simple. It's access to market, right? So if we invest in a company, it's usually a technology that fills a gap in the offering that we currently have from a technology perspective. So it fills a solution that maybe one of our other bigger portfolio companies can help resell. So for example, Immerso and Solibri, they have a wonderful relationship because model checking is something that the Solibri clients are asking for. So there's a common go-to-market, there's a common sort of distribution channel agreement, or, so usually it's related to access to market. We can help resell those companies. We want to be able to add some kind of a value.
Yeah. Okay. John?
Yeah, no, I think it's indeed depends on whether or not we lead. We have led the round, or if we're just followers. So, as part of our process anyway, so we've got this buy-in from the business units. So post-investment, we usually have this roadmap of if we invested because they needed the money for an industrial scale-up or commercial ramp-up, anything. So that's usually the direction that we're taking, right, just after. So then it's more of a business-by-business kind of best practices, where some of them share the R&D, some of them want to just take most of the charge. It really depends there. I would say that our biggest challenge there is to find the balance between what is good for the company from an investor point of view and what is good for the startup, for the business point of view. And it goes back a lot on exclusivity, IP rights, and so on. So that's why the joint development agreements that we have are usually key and quite lengthy to draft, because it also sets good rules in terms of where the added value, how the added value will be split between the two entities.
Yeah. So one of the thanks for this. One of the points that was mentioned before is the founders don't want your money, and so I would like to understand a bit this more. So the concept of strategic money on theory represents a lot of potential value add. So it seems always amazing on paper, but at the same time, it can be also very risky because it can be disappointing for all of the reasons that we know. The fact that you're perceived by the competitor as a subsidiary of the large group, or the fact that you have a governance issue because the large corporate wants to influence the roadmap of development of the product, or I mean, you have many things like this. And so I would like to ask you, how do you manage these topics? How do you manage the governance and the independence of your founders that you invest in the term sheets that you negotiate? Like, do you mention this sort of governance and independence issue, or how do you convince the founders that you're good?
I think it's stage. It really depends, right? If it's really early, if it's at an early stage, I mean, I can only support founders, and I can say, don't take a strategic in your cap table in a seed round or in a pre-series A, because it's detrimental for the founders. It's usually not going to help them because it'll be really difficult for them to raise venture capital money, right? Which is what we want. At the end of the day, I want my portfolios to become great companies and to grow and to become big. And they can only do that if me not being in their cap table, if that's what it takes, then fine. Then let's talk in a series B, right? How do we deal with that? There are founders where it's a great signal. So if I can be a strategic and take a small portion of this particular round that is put together by a number of other VCs, then my little strategic participation is a great signal.
Yeah.
In other cases, I've actually gone and built an SPV where I no longer have the governance, but I have a separate entity where it doesn't show up in the cap table that I invested in this company.
Yeah.
So there's a very clear way of doing that as well. I've done that a number of times.
Yeah, clear. Okay.
I think no, your point with the dedicated SPV is a good one. I don't think that's something we have ever done, but definitely a good idea. So again, it's a lot of, it depends on the maturity and so on. Usually we don't take the majority of the round, right? So we like to be followers to a VC, an independent VC. I think that's the best cases. In some cases, it's, I mean, maybe because the startup doesn't have a choice, or because we are really like the most fit company for leading the investment, so we can take the majority of the round, and that's fine. But we like to have this good relationship with VCs for all the reasons that Tanya mentioned. We try as much as possible to have a few, at least, board observer seats that can represent both the VC parts and the businesses, so that at least all interests are shared there, and that the communication is flowing as it should. And it's true that it depends on the founders, because sometimes CVCs can be seen as a great opportunity, sometimes a bit something like risky. We've seen both. We try to be as right as possible in what are the risks, right, and opportunities that it takes. But it's true that there is a big question on the round itself. Sometimes it's better to wait a little bit. Sometimes it's obviously mandatory for us to be there as early as possible. But we're happy to co-invest with other CVCs that are not our direct competitors if possible, but it's always a good signal. And it's true that in a lot of the rounds that we're working on, they want the buy-in of Saint-Gobain because of the brand, and because also it helps just close the deal. So in that case, I think it's also useful to be able to position ourselves quickly, even though we are not the lead in the round.
So what's wonderful for us, I think, I mean, there's a capacity problem at one point when I think we're reached the threshold. We actually have the experts of the business units go into the boards. Sometimes as an observer, but most of the time actually as a board member. So for example, John, the CEO of Bluebeam, sits on the board of Reconstruct, which is fantastic, right? Because you get the really the deep domain experts that are supporting the founders. Obviously, we can't go on much further because but they have a day job, right? So we're at a capacity problem. They can't take any more board seats, but board observer seats is a good way going forward. Yeah.
Thank you. I love the direction of the conversation that goes in all the ways. That's perfect. That's what I want. So when the follow-on investment arrives, you, I guess, want to maybe continue to reinject capital in the firm if you get good signals, etc. Have you ever faced situations where maybe the existing shareholders or maybe new VCs that are going to invest tell you, no, we don't want you to buy additional shares in any way? And if yes, like why, or maybe like how to avoid such situations? Is it with the SPV strategy, or question more for you, Tanya? And
so I have not had that. I have a different problem, and I have the problem that I'd like to tell my portfolio companies that I like to invest like a VC. So I'll go pro rata, or maybe even a little bit super pro rata with the other ventures. But if they can't find external funding from a new external fund, then we have a problem. Of course, they think I can go to the corporate and you guys can just give me money. The problem is we can't. I mean, if you do that, you're not helping the founders, right? So it's a little bit of education in the other direction. I haven't had that yet. Maybe that will happen, but so far, no one said, no, we don't want you to participate in the next round.
I'm quite aligned with that indeed. So I don't think we've ever had the case where another investor asked for Saint-Gobain not to be investing anymore. That's more the opposite. But just like you, Tanya, we try to at least maintain pro rata. If the strategic interest has increased because the startup has proven more things since the latest investment, then we're happy to see if we can invest a bit more. And usually it's not a big issue with these VCs. I mean, they do tend to see us also as an exit option, right? So they are happy to have us somewhere in the cap table for that. And if a company ends up with a lot of CVC money and not so many VC money, it's maybe because it's not attractive enough to VCs for a lot of reasons. But it's usually not something that is like forced by us.
Have you ever acquired a portfolio company?
No, not yet.
No.
No. But I mean, just like you, even if it's a few years separate, we are still a young CVC, right? I mean, it's been 4 years, but the portfolio is growing and maturing. So I guess we'll also soon to be in this position where either the companies will reach a substantial size, and we are not as round agnostic as you are, so we'll be limited at some point to follow on some rounds. So there will be some question marks at some point to what is our actual strategy for those later stage investments? What do we want to do there? And I guess that will have some big impact on our exposure to the cap table.
Yeah. Clear. So we have only 2 minutes left, but I would like to ask you about your biggest mistakes or your biggest success. So if we start with the biggest success in like 10 seconds, John, can you share like what are you the most proud of?
That's a tough one. I try to be quick, but I think that today at Saint-Gobain we've done a lot of very good investment that we're really happy about, that are driving good value for the business, that are good startups independently of us. But I wouldn't say that we have this big hit. I'm not sure today we've got this company that is top of mind brands in the content industry that is like this next unicorn or something. So we're still working on it a lot. So a lot of good signals, but still trying to crack the code to what will be this huge success.
Okay, Tanya?
If you're asking me the question for my 2-year time at Nemetschek, then I'll have to answer based on my Nemetschek. And those are actually 2 investments that I've done that we won't talk about. They're fantastic. I'm most proud of my board and supervisory board, how quick they are. I am so grateful. It's a privilege to be investing in these days and to be supported in such a way where I don't have a bottleneck with my senior people. It's absolutely fantastic. That's my greatest success, is actually them. And my biggest failure, I think right now, having had to say no to a deal that I literally couldn't do because I didn't have the bandwidth. Yeah. And that's a shame. I want that to not be a problem going forward.
John, your biggest failure?
I think it's more or less the same. So we've got I don't think we've exited one company for a lower value than the one we invested in. Otherwise, we are still ongoing. So I guess it goes back to your point on a no is the second best option. So I think we would like to have some big failures, at least to see a little bit more where it goes. But no, in terms of biggest challenges and failures, it's really about missing a few deals just because we are not fast enough or because we're not competitive enough on the deals, and that's definitely extremely frustrating.
Thank you. Next time we continue the conversation with a glass of wine somewhere for dinner.
With pleasure.
Thank you very much. Speak very soon, and it's now time to pass the torch to the next session. Again, thank you, John and Tanya.
Thanks, Tanya. Thanks, Idris.
Take care, you guys. Bye.
Bye-bye.
So I will not be moderating the next session, but it will be very, very interesting, I think, because it's a conversation about the GP and LP relation, especially during the fundraising. So I will welcome the panelist and the moderator very soon. The title is GP Raising Capital, What Type of LP are the right for you? Hello, this is my friend Kevin. Valentina is already here.
Hello, this is my friend Kevin. Can you hear me?
Yes, we can.
Hi, Kevin.
Oh,
good to
hello.
see you, my dear Valentina.
Likewise. Are we live yet?
So we are almost all set. Christina just dialed in from Madrid. Welcome, Christina. I'm just making sure that everything is well set up, and then Valentina, the floor is all yours to lead this panel, of course. Are you with us, Christina?
Yes, Amna. Thank you.
Excellent. I will vanish. Thank you for your time today. I will listen to you as the audience. So thank you and have fun. You're amazing.
Thank you, Idris. Hi, everyone. It's my pleasure to coordinate this panel today. We will be talking about GPs raising capital and what type of LPs are right for you. My name is Valentina Shigoyan. I'm managing partner at Reach UK. We work with tech startups launching into the world of real estate, and we are ourselves a venture fund and a GP. Second Century Ventures is a single LP fund that sits in the US and backs Reach companies. I'm joined today by Cristina Garcia-Piri, managing partner of Azora Capital, and Kevin Cardona, group head of strategic partnerships at BNP Paribas Real Estate. It is clearly a very challenging market environment for everyone nowadays, for startups raising capital, but then VCs are no exception. So new funds of the 2023 vintage are very hard to raise. So I believe this topic will resonate with many people in the audience. But let's start with brief introductions. Cristina, Kevin, please introduce yourselves and the financial institutions you represent. And if in the same window you could answer a question if you consider your capital strategic or financial. Cristina, let's start with you, please.
Okay, thank you, Valentina. Thank you, Idris, and thank you very much, PropTechLab, for inviting me to be here today. I think the environment, as you said, is extremely challenging. So let me tell you where my background and what Azora is. Azora Capital, we are a manager and investor in real estate and also some other real assets such as energy infrastructure, climate-related solutions, and renewable energies. We mostly are raising capital to invest in our strategies, but occasionally we have supported other funds, and in particular we have supported PropTech funds in the past, and in that sense I will consider Azora's capital whenever we deploy it more as a strategic capital rather than purely financial. Just to give you a bit more background about Azora, we currently manage 9.4 billion of assets across Europe and the US. We are investing across all asset classes in real estate, but specifically in two big pots. That is residential and the whole world of residential, including student housing, nursing homes, and senior living. And the second big area of focus is hospitality, where we invest mainly in resorts and mainly in the area of leisure hospitality. Outside that, we invest across traditional commercial real estate, and we tend to be a value-add manager and very, very much hands-on. And maybe because of that, the world of PropTech for us is extremely strategic, and that is why we decided to undertake an investment as LPs ourselves in a PropTech fund, because we consider it a huge source of value for our own funds and the companies and the assets we invest in. And therefore, from that point of view, we undertake those investments with a very, very strong strategic objective. And probably we'll have time over the conversation to talk more about that. So I'll leave it there.
Thank you, Christina. I will ask you to kindly wear a hat of LP today then. Thank you. Kevin, please.
Hello, everyone. Thank you for the invitation and the opportunity to present ourselves. So basically, we are the real estate subsidiary of BNP Paribas, the bank. We are active in the whole value chain of real estate, doing property development, transaction, property management, and investment management with more than 30 billion asset under management. So basically, when we started to address this PropTech ecosystem, the whole question for us was to know how to move forward to have a good coverage. So that's where we decided to invest into a pan-European VC as LP, which is a Fifth Wall. So basically, we are purely a strategic LP. And to give you an insight also on the structuration, because I believe it's interesting, the investment is carried on by our internal VC called Operatech Venture. So basically, I'm definitely the strategic arm for real estate for that VC. So it's important for us to have separated the two, not to avoid some of the mistakes we could have made doing corporate venture. So we wanted to separate clearly the financial play by the VC and the strategic play by the business, basically. So I'm a pure strategic LP.
Thank you, Kevin. And for the audience, if anyone has questions through our session, please put those into the chat and we'll be able to pick them up. All right, so we know now that we have two of us in the room and with some experience investing into funds. I believe that in the audience, we have people who are first-time fund managers or who are currently raising. Walk us through your thinking process and criteria, how you view new managers and what may make you switch from topping up to the existing manager to a new vehicle. And Christina, if you could lead. Christina, I believe you are on mute.
Sorry. Yeah. Well, I mean, supporting new managers is always a challenge. Sometimes we have felt that as Azora ourselves when we were trying to launch into a new strategy. So I'll tell you both how we look when we invest in managers ourselves and our own experience. I think things that help when you are undertaking a fund for the first time is, first of all, to be extremely focused. LPs in general get bombarded with propositions, with people that have great ideas, great track record. And it helps always to be extremely focused, because that allows the LP to actually decide, okay, does this complement in certain way what I already have in my under my investments. The second thing, because it helps to understand what it is that you're going to do. One of the most important, the biggest sources of anxiety when you invest with a new manager is, okay, are they really going to do what they tell me that they are going to do? Having seed investments help. Being able to showcase what it is that you're going to do by having already a new investment helps hugely, okay? But the more focused the strategy is, the easier it is to define what is exactly that you're going to invest in, and therefore that gives additional comfort to the LP. Of course, track record is extremely important, and the more focused the strategy, the more important it is that the track record is relevant. Okay, and track record of the team working together. That's sometimes GPs don't appreciate enough. The world is full of joint ventures, etc., and all of that creates a lot of issues and raises a lot of questions of, has this team worked together before? What happens if this joint venture doesn't work, or this team doesn't work working together? Okay, so to the extent that can be, whether to the extent you're putting forward a team that has been working together for quite a while, I think helps hugely. Deal flow. So just like having seed investments help, having identified deal flow that you can describe is extremely helpful as well. And then in general, just you need to find your unique selling proposition, right? What it is that makes you different, and that is the reason why LPs may want to own you. Maybe you don't fit the strategy of a specific LPs, but for those that are looking for that in that part of the industry, you need to be able to prove that you are complementary, different, or better, right? So you need to find your source of differentiation. Maybe you're doing something much better. Maybe you're focusing on a niche of the market that is particularly attractive. Give investors a reason to invest in your fund. Us, like Kevin, we invested in Fifth Wall. I mean, that is probably the antithesis of what we're talking now, right? Because Fifth Wall is probably the first or one of the first GPs that have focused in PropTech in Europe, right? With a very long track record in the US. So we went into a very conservative choice, probably because it was our first PropTech fund. Okay, if you're dealing with investors that is also for them quite early in the PropTech world, it's much more difficult as a first fund, because they want to avoid the issue or the pitfall of the decision maker, right? If I choose established VP and the fund doesn't do well, they were the obvious choice. It's not my fault. If you choose a first timer, and it goes wrong, you're going to get a lot of hate and a lot of questions.
Yeah, no, that I cannot agree more. And I think that there are very important point on track record, but as always with new fund managers, it's a bit of a catch-22, because if you are an emerging fund manager, you will not have as much of track record. But I very much liked your point on team and proving that the team worked together enough and they can be track record demonstrated in multiple ways. Kevin, what are your thoughts?
Basically, I think it's interesting for you to have a bit of the experience we went through when choosing the first investment, because at first we had a in-depth discussion with a general partner in France, and basically when we presented that to the board, our German member of the board told us, "Thank you, but it's too national focus. We need a pan-European VC to be able to have a pan-European coverage of the PropTech ecosystem." And at that point, as Christina said, basically Fifth Wall was the first one to come with a huge track record in the US, so benefiting from basically the early signals and all the trends that would arrive to Europe. So we wanted to benefit from that strategic insight. Basically, as I told you, it was more a strategic play than a financial one. So that's why we chose Fifth Wall at the time. If we would have to consider a new investment, I believe that we would have more an issue on how the new general partner or the new VC fund would be able to leverage its ecosystem. Because as you may know, the PropTech world in Europe is very much about cluster. It's very much about there's a PropTech ecosystem per, I would say, big cities or at least countries. And the UK ecosystem is not the same one as the French one, as the German one, as the Spanish one. There are, of course, synergies between all of them. But to be a good VC, to be able to be basically to enter the deals, to be around the table, you need to prove to the founders that you will help their growth. Basically, it's maybe less true now, but 6 months ago, pure equity was not enough because there was a lot of equity. So the question was to be able to enter a deal. It was also your ability as a VC or as a general partner to prove both to your LP, strategic LP, that you will bring strategic downloads, and to the founder that you will have the growth. So to do so, it demands a strong, I would say, involvement and track record in the ecosystem you build around you. So we have typically, I see here on the PropTech one is a good example in Germany, for example, but there are others. So really the question is how you help both LPs to discuss together and structure, I would say, a stronger local ecosystem, and also how to help those national champions to grow internationally, to have a pan-European coverage, to accelerate, I would say, the go-to-market for the PropTech, because it's really hard for the PropTechs in Europe to scale at European level. So that's where I believe the role both of LPs and VCs is to structure that ecosystem both locally and at European level.
I understand. Thank you, Kevin. Just to bring a little bit the market context into the conversation and where we are in 2023, there are two opposing views when it comes to fundraising nowadays. First, it's a difficult time to invest because nobody understands where valuations are and what is the right company to back, and that holds back investments into venture funds. But on the other side, we all know that funds raised in tough times ultimately become the best vintage years, best vintage funds. We know that from 2008. What is your view as a financial institution? Do you believe that 2023 is shaping up to be a strong vintage year, and as such proactively looking for opportunities to deploy capital as an LP? Or do you believe it's still too early and you would rather wait? So Kevin, let's start with you.
Well, as you all know, we went from a profitability first kind of strategy to a growth first kind of strategy to profitability first. So that led to a correction in some of the valuation. So I would say purely opportunistically, it's a good moment to invest, because you would enter at I would say more reasonable valuation today. But still, the question is still about the fundamentals of the market and how the prop tech you would invest in, or the climate tech, has strong fundamentals to answer to, I would say, the true problems of the industry. And I believe that we are in a moment where the fancy stuff are a bit nice to have in terms of investment, and we come back to, I would say, core solutions for core problems of the industry. So I believe it's still a good moment to invest. Of course, there are wonderful prop techs out there, wonderful climate techs, as you all know. Of course, this major trend of decarbonizing the existing built world is a strong headwind. But the question is how to accompany those economical models. Not because the problem typically of climate tech and decarbonizing the existing world is the fact that as the asset manager has not the ability to support alone all the capex. So we will go through. I believe we will evolve with new economical models, combining typically, for example, with infrastructure funds or stuff like that. That would combine the ability of asset managers to scale climate techs or prop techs. So my view is that we will have a lot of innovation in the way those prop techs and climate techs will enter to the market. But long story short, I believe it's still a good momentum, but with a lot more focus on the fundamentals of each investment.
Thank you, Kevin. Christina, net investor in 2023? No.
I mean, I think from an investment point of view, I think it's the next, probably starting more next year, we are going to have a great vintage, because I think, as Kevin was saying, valuations have definitely adjusted, and there is a scarcity of capital. Now, leverage is not such a big issue for this industry, because normally you don't use that much leverage. But the reality is that there is a scarcity of capital, and therefore anyone that has firepower today or that is able to raise firepower, I think will have great investment opportunities over the next couple of years. I also agree that I think in particular with climate tech in Europe, we are seeing huge amount of innovation that we didn't see before with a broader, I think, PropTech theme. Of course, there's always been interesting ventures and interesting opportunities, but I think in climate tech, you have the combination of a really, an issue that is becoming more and more prevalent across all industries, in particular real estate, and a legislator and regulators who are really very focused on this and therefore enacting regulation that will definitely ensure that we all move towards net zero carbon. And all of that, I think, is empowering a lot of entrepreneurs and is bringing a lot of public money into the system and the proper framework for, in particular, climate tech to thrive. The only problem with this, with the current moment, of course, is capital raising, because most investors are suffering from the denominator effect, where most of their liquid investments, whether is bonds or equities, have gone down. That is now slightly recovering, and valuations in private markets have not corrected that much. So when they look at all their private equity, all the way from VC to buyouts, to real estate, to private equity debt, private equity debt is different, but in general, they are over allocated. So I think the fundraising environment is tough. I think most investors are looking at whether by year end there will be more clarity in terms of the interest rate environment, and they will be ready, I think, to commit again by next year. At the same time, I think some of the themes around PropTech are really megatrends. For example, the digitalization of real estate is still only nascent. I think there's so much to do there. And it's probably the single largest opportunity that we have in the industry. Climate change is another big megatrend, right? So, and there's probably others of secondary importance. But I think when you look at only those two big themes, money will continue to flow, and I think investors will continue to want to be invested in the sector.
Yeah, thank you, Christina. Thank you, Kevin, because I think both of you brought up a very important question and point and trend on climate and decarbonization, because 2023 is a hard year to fundraise, and focus strategies on something where there is a real pain point for the industry started emerging. So climate strategies have become a new trend in the VC world and PropTech VCs. When you review those investment opportunities as an LP, what are the differences in underwriting versus just generalist PropTech funds? Christina?
Well, I think climate tech has, for us, a very strong energy component, right? I think it's not only, climate tech is not only a solution to help real assets, and I'm going to focus on real assets. It's not only a solution to help real assets decarbonize, which I think is an area where there's still a lot of innovation coming, but it's very much linked to energy transition and new energy. And I think there you have a component of new technologies, of really of real innovation, right? That is extremely powerful. So when we look at the sector, we really try to focus on the biggest problems. There's so much to do around climate change, right? First of all, we focus a lot on cities and mobility, because for us, decarbonizing cities is one of the most pressing issues, right? And there's a lot of things already going on, and we think it's one of the first areas where we are seeing already companies thriving and needing more growth capital, which is where we are mostly focused on. The second area that we think is crucial is the whole world of carbon pricing, carbon taxes, carbon certificates. And yes, you have all the regulation coming through, but you do need the private sector to be able to issue these carbon certificates in a in such a way that companies will actually buy them and invest in them in order to reduce their carbon footprint. And then the third area that we look very much at is the area of new energy. Whether it is a cleaner way to produce current energy, to hydrogen, to biomass, to there are a lot of new technologies emerging. Many of them have been around for some time. And I think now with the focus of the real estate industry and just in general on decarbonization is the right time for these companies to scale up. And that is in general what we see in climate change. A lot of people have been doing wonderful things for many years, but they haven't really scaled up. Maybe one issue is what Kevin was saying is the need or the ability, the fact that they haven't locked into the proper ecosystem. But I think it's also been a question of user adoption. And I think more and more we will see users now anxious for these solutions. So unlike, say, general PropTech, where we are more agnostic and we're looking more for GPs to tell us where are the best opportunities, I think in climate change, we know ourselves where we want to invest. And it's more that we are looking for companies and GPs. But in this particular case, we have actually launched our own fund. So in this case, we are actually looking for companies in these sectors.
And then I suspect you would do some co-investment models. Kevin, anything from you on their decarbonization and climate strategies?
Yeah, maybe anytime you hear an asset management say, I want to be net zero in whatever time, it's a three-step approach. Measure, reduce, compensate. So basically the champions of today's decarbonizations are anyone who can help to measure properly the starting point, to be able to have a net zero strategy, and to be able to drive your action plan as an owner of real asset, I would say, real estate for what I'm concerned. So basically today's champion like Deepkey or those kind of champions are the champions who help owners to first see clearly where they stand in terms of energy/CO2, because of course it's two sides of the same coin. So basically the first step is to know where you start from, to be able to have a trajectory. Then when you enter into reducing, you have three pillars. The envelope, I'm talking about real estate only. The envelope of the asset, the systems, and the usage. So basically, you have climate tech and PropTech addressing one or three of those pillars. But here you start. If you talk about envelope, for example, it's a lot of capex. And the question is, if you're an asset manager owning, for example, 30 billion asset under management, and you have to reduce on all of those assets, you will have to invest a huge amount of capex if you want to refurbish, for example, all of the envelope of all of your portfolio. And the problem with that is that you do not have in front of that an extension of the surface or an increase of the rent. So basically, it can be seen from an asset management perspective as a pure deterioration of IRR. So basically, that's where I was explaining before, the new models that could come in, of new kind of structuration of investment for those kind of solutions, where we would have infrastructure model to help the existing world to decarbonize at fast speed. Because basically, we do not have time. We don't have 20 years in front of us. We have 10 years to decarbonize the existing world. And as you know, most of the solutions we've seen in the past were mostly they're directed to the new build. But the new build is fine, but it's 1% of the problem. The real problem is the 99% of the existing city that we have to transition. And that's where there are...
I think that we also have no more time left for this panel, but I think I get the point. I'll wrap up with our conversation. Thank you so much. So I think that what type of capital is right for you, it's all about focus. That's what I've heard. So their GP and VC fund needs to be very focused with a very clear USP and value proposition. Cash is king this year. It's hard to raise it, but those who will be able to raise it should be able to invest well. Climate tech is new and emergent trend, but it's no longer enough to invest just into technology companies. It all needs to be addressed in a complex, and there will be new asset management models, tech-enabled, emerging, and some of them will have high capital intensity. There was a question on the chart, how do you assess quality of the GP versus quality of individuals? I think we somewhat touched upon it. Team working together is key there. So there is some creativity that GPs can put to address this question just by showing track record of individuals and individuals working as a team. Thank you so much. I think time is up, and we need to switch to the next panel.
Thank you, Valentina. Well done. Thank you. Bye, Kevin. Bye, Valentina. Bye, everyone.
Oh. Okay. Okay, just what I share my I cannot share the presentation. You have disabled screen sharing. Hello.
Hello, David.
Hi.
We are live on air.
Yeah, I'm trying to project, but screen sharing is disabled.
Okay, let me. Okay. So this is from the back office console, so we will see the Team PropTech Lab should allow it. I see we have already Peter joining. So this is a closed door session for founders only. So we are between us. So it's less of a huge crowd, and it's also interactive session. So we have time for, to set up the logistics and the tech, no issue. Just
Okay.
looking at what I can do from my side. No, I think I can't do anything. So. But I see that I can share. No, okay.
No,
it's
now
supposed
it's okay.
to deactivate it. Now it's okay?
Yeah. Can you see my screen?
Yes. It's not full screen, but we see. Yeah.
Ah, wait. Now? Full screen?
Not yet. No, still not. Yes, full screen. So maybe as a quick intro, we decided to organize this session with Cresco, who is a good partner of Relevation, also a very close partner of Recap, the ESG accelerator. And the idea was to have an interactive session with founders about what are the alternatives to equity funding. So unpacking a bit the difference between dilutive, non-dilutive capital, and all of the different forms of capital. So David is the founder of the, I think, leading law firm for business and for tech, backing founders and VCs and funds. So he is really like strategic person to know in the PropTech ecosystem and tech ecosystem in general. So he will start with slides, and then we can jump into more Q&A.
Okay. Yeah. We're not a big crowd, so Peter, you can make it. You can ask me any questions, of course, that you want.
We also have people. That are from events. Yeah. So not everyone is visible here, but there will be questions on the chat. Yeah.
Okay. I will quickly run through the present. We have half an hour, right? So more or less.
Yeah, exactly.
Yeah. So as you all know, founders, if you're raising capital, that times have changed compared to a year ago. So the financing climate is quite challenging. I just also read an article this morning in the Financial Times that they're expecting, pretty bad times the second half of this year, because there's also a lot of funds, and not the smallest funds like Insight and Tiger Global, that themselves are missing their fundraising targets substantially. For example, Insight was going to raise a new 20 billion fund, and they are only at 2 billion at this point in time. So inevitably that will have an impact going forward. We also work a lot with VCs, and we see in practice that they're cautious and waiting. So typically focused on supporting their existing portfolio of companies, and then waiting to see whether the valuations at which they can invest, that they deem them reasonable. And of course, there are still financings being done, but the terms are also slightly different. So very quickly, market update impact on VC terms, and then a couple of techniques: convertible loans, safes, and venture debt. What do we see? Like I said, that there's a strong impact on the private tech investment market. There's certainly less activity. For example, in Belgium, I think year on year, I think the volume dropped by 70 or 80%. We see in practice also down rounds taking place, with investors exercising anti-dilution mechanisms, which has a pretty painful impact on founders and early backers. We also see the return of staged and tranche investments, where investors invest on the basis of milestones, or that they apply techniques, valuation ratchets, can go up or down. Now, mostly it's down. We invest at a certain valuation, and unless you hit target ABC, we will revise the valuation downwards post factum. We also see the emergence again of full ratchet anti-dilution protection. This is something that was, only in very extreme circumstances used in the last couple of years. But a full ratchet basically means that if you do a funding round at a lower valuation, your previous funding round gets repriced completely to that lower valuation, and the impact of such events can be pretty detrimental. We also see more aggressive liquidation preferences. What was pretty common is a 1x non-participating preferred, basically a downside protection for investors. And now we see participating features. I get my money back, plus I share pro rata, multiples on liquidation preference, IRR guarantees. And so clearly, from what has been 4, 5, 6 pretty beneficial founder-friendly years, the market has really shifted in the other direction. I will not go into detail on anti-dilution protection. Relevation has the slides, and I'm assuming that they will distribute them to all the participants. Same with liquidation preference, assuming that you are aware of how these work. What we do see a lot in practice, and that's the first technique, is of course to use convertible loans as a form of bridge debt funding. What we always say, there's good and bad reasons to work with convertible. The bad reason is we don't know what the valuation is, and you're kicking the can down the road and hope for a financing round that will set the valuation at a certain point in the future. The good reason is we just want to do a bridge, and we have a clear plan to do an equity financing round, and we are pretty confident and hopeful that we will manage to do so, and then that convertible converts into the financing round. It's certainly a way for companies that have raised funding at certain valuations or higher valuations to really go to the equity capital markets right now and obtain the same or higher valuation is not so evident. So from that perspective, using a convertible to postpone the valuation discussion is not necessarily a bad thing. What you see on convertibles is that they typically have a discount of 20 to 25%, sometimes even higher lately. So we also see discounts of 30%. What you have to, of course, also take into account is that if you do not complete the financing within the term of the loan, that you are with your back against the wall because you will not have the funding that you need to refinance or pay back the loans. And then you're with your back against the wall. And I mean, it is in essence the investors that will determine the valuation. That's why we always advise founders to include a floor on the valuation. Very often that is set, about if it's already accepted by the investors, at the post-money valuation of the previous round. Also take into account that you cannot keep on raising convertible debt, so as to avoid that you have an enormous amounts of loan outstanding and then have to do an equity financing round, which can lead to issues if the aggregated or the total discount on those loans would be deemed too large. That is in a nutshell. I don't know if anyone has any specific question on the convertible loan aspect. No?
No,
Okay.
I think we can move on. No question from Evancia, no question in the chat yet. So go ahead.
Okay, so the second one is a SAFE instrument. SAFE is an instrument that was invented by Y Combinator in the US, and it's an abbreviation for Simple Agreement for Future Equity. What's the advantage? It is fast. That's the same with the convertible. Maybe one thing to mention as well is that many people opt for convertibles because, of course, it goes faster than a priced equity financing round where you have to, well, think of all other details that are common in an equity financing round. SAFE is fast, convertible is fast, it is pretty standardized. One of the advantages of a SAFE as well is that it's no loan and that it's some type of equity, some type of semi-equity that is subordinated to all other to the debts that your startup may have. How does it work? It's convertible into SAFE shares and only in very limited triggers if there would be an event of default, bankruptcy, for example, or material breach of undertakings, that you would have to repay the SAFE, although it's very uncommon. It will also have a maturity date, a date by which 1, 2, 3 years down the road, by which it converts into shares, and you have typically also the distinction between a qualified financing round and a non-qualified financing round, events of default that can occur, and change of control provisions. Never forget also with a convertible loan to think about what happens in the event your company would exit, even if you have not planned it. Very often a bid comes when it's least expected. And then, of course, if you have loans on the books, you need to think of what should happen with those loans. Either they're repaid at the time of closing or they're also converted into equity, where then you will typically also have discussions about a floor valuation applying or a cap valuation being negotiated by the investors. They will convert into the most senior class of shares that are outstanding, either the existing class, most senior class of shares, or the share class that is issued at the time of the triggering financing round. It has a discount, it has a cap, it has a floor. So it's very similar actually to a convertible. The only difference is that for us is that on the books, it's recognized as a form of equity, which of course is good for balance sheet purposes. It will convert into the investment amount divided by the discounted per share price. And then very often with a floor and a cap included. At maturity, it will also convert, and then by definition, you have to negotiate or think about at which floor valuation that SAFE can convert or should convert, instead of leaving it open. And for example, say it will be converted into the fair market value at the relevant point in time. And the question is, how do you determine that fair market value? So we would certainly encourage founders to be as clear as possible upfront and not avoid the valuation discussions, or you cannot avoid them altogether. It will have no interest, although it will have some type of built-in, return on investment ticker that applies. And the formula is very often subject to commercial negotiations. If you're a Belgian company and you want to do it completely right, it is also based on a contract, but slightly more complicated to implement than a typical convertible loan. So you do have to hold a shareholders meeting and have certain reports drafted for very small amounts. Very often, it's maybe not worth the while, but if you do a larger convertible financing, then we believe that the SAFE certainly has big advantages compared to a convertible loan, and especially because of the accounting treatment. That was the second one. I don't know if I have to see some people in the chat. Right.
So,
Okay,
question.
so a couple of questions. I think the most common discount that we have seen over many years is 20%, and we think it should be tied to the length of the loan. For example, if you do a convertible and 3 months down the road you do your equity financing, then we think a 20% discount is quite steep. So you can try to obtain, for example, if the loan converts within the first 6 months, the discount is 10%. Between 6 and 12 months, it's 15%, and plus 12 months, it is 20%, for example. But of course, your cap and a floor have an impact. If you have a cap and a floor, especially the cap, if it says my conversion price can never be higher than X, and if you're able to raise funding at a valuation which is, 2-3 times X, then the effective discount will be much larger than the 20%. But if you go to the market and you take a basic discount of 20%, most often that will be by most investors acceptable. In terms of what kind of partners do SAFE loans is a question of Peter. Both individuals, private investors and companies, especially if you want to raise funding from companies and Belgian companies rather than private individuals. Using a SAFE has tax benefits for the investors. So because if you subscribe to a convertible loan as a corporate, in principle, the interest on the loan and the capital gain that you realize upon conversion, they're taxable fully. And that's not the same with a SAFE. So if you exercise a SAFE, any gain that you realize, both the discount aspect built into the SAFE, as well as any capital gain, in principle, is tax-free. The third possibility is venture debt, and that is debt with an equity kicker. So, and this type of debt, venture debt, is really provided in the market only to the extent we have seen by professional venture debt providers. It's certainly not accessible to all startups. You really have to be a scale-up which has substantial revenues and ideally also positive cash flows. That permit the lender to have, the lender to have certainty that in the event of problems, they will get repaid. It is provided by private equity funds, specialized funds. In Belgium, you have a couple. In Holland, you have several, as well as in the UK. And these loan agreements are quite complex. They're typically similar to loan agreements used by banks. It's not something you put together in a week's time. It takes time, as if you're negotiating with a bank. It is certainly later stage and is also coupled with pledges on the assets of the company, the core product suite, for example, that you have developed. And in order to make it worth the while for the lenders, it has to relate to pretty significant amounts of money. It's, raising $1 million with venture debt is not worth the while for these lenders. So I would say that you're probably talking about 5 million plus amounts for these type of instruments. So they're similar to a standard credit facility agreement. They have drawing requests, fixed term repayment schemes, prepayment options, events of default, and subordination provisions. They will also normally do due diligence and ask for reps or warranties and indemnities. And one thing to note, covenants and approval rights. So lenders will want to have a say as to what happens in the business, and you have to review these contracts super carefully to make sure that you don't concede anything or give too much power to a lender. They will also request a transaction fee payable upfront to the borrower, and there's very often other fees and costs built into these type of instruments. In terms of security, it goes together often with a pledge on business or shares, an escrow on your source code, and other potential security mechanisms. It will also go together with what is called a warrant or an equity kicker that permits the lender to realize an additional upside, and that typically entitles them to exercise a warrant for a nominal amount, a euro cent, and that then converts into a certain percentage of your equity. Also very important to look at the calculations and run some numbers to see what the dilution is on the other shareholders, and also make sure that if you have investors on board, that they also waive their anti-dilution protection on their investment in connection with this equity kicker, because that would normally be a dilutive event. So I think that in a nutshell are the three debt-like methods. And of course, as a high level, there's other alternative possibilities. I mean, you can raise funding by making sure that your clients use your product and integrate it into their product service offering, that you engage in what we call funded development, having your client pay for the development of your product, and engage in co-creation efforts to make sure that R&D spend is spread over two or more parties. And so that's high level. I mean, the idea is that we want to share and say, well, if you're unable to raise equity funding, look at convertibles, look at safes to the extent you're at that stage, venture debt, and finally, other ways of collaborating in order to raise cash. So that's what I wanted to share in terms of presentation. I think we still have 7 minutes or so. So if anyone has a question for me, I'm of course
I have a question, if you allow me, which is about revenue-based financing. So we discussed a little bit, you mentioned that a little bit. So from an outsider perspective, I don't understand why this is not becoming mainstream, because I think it's something that could benefit, that founders could benefit so much. So the revenue-based financing is like the loan, and then you have to refund part of what you get as a multiple of your revenue or something like this, so, or your profit. So you basically have only to pay back with a percentage of what you
there are certain providers, like I think a Belgian company called Revenue as well, that they leverage your revenue for financing purposes. Yeah, it's a good question. I mean, we rarely come across it. I think maybe, well, let's call it factoring type of arrangements. I think that one of the reasons why companies don't use it a lot or not so comfortable with it is, of course, that your clients normally will be aware that you're using your revenues for financing purposes, and depending, I think, on how you structure it, the revenues have to be either transferred or pledged to a financial institution, and you have to notify your clients about that taking place. And And I think there's a lot of hesitation for companies to show to their clients, hey, look, we may have financing issues, and that's why we're using your revenues as a way to leverage. So I think that, but you're right. I mean, we don't see it often in practice, and it should certainly not be discounted as a way of raising funding. But like I said, I think the main reason why it's not used is because you cannot be silent about it towards your customers.
Yeah, okay. And then maybe one additional question, but I don't want to monopolize it. So Peter, feel free to jump in, or anyone from the Eventia platform, or just write in the chat. But in the meantime, since I have you here, one more maybe philosophical question, but it is, why should we raise capital? Why should founders raise capital? Because at the end of the day, it's not the only growth trajectory. You can also be customer funded. So it means you can eat what you can kill. It's the MailChimp story, right? So we have a few questions in the chat, but so yeah, why should founders, or maybe why shouldn't founders raise capital? Like there are probably good and bad reasons.
Ideally, if you can set up your business and you can bootstrap it and you can build it up without having to raise outside funding, and that's an important element, is you can grow as fast as you want to grow without a need for funding. Why would you raise venture funding? But that is very rarely the case in practice. So very often companies have a certain growth trajectory. There's a limited time to market from competition perspectives, and there's a question of speed as well. So, but by all means, I mean, I would tell any founder that is able to finance the business themselves and grow by, for example, like you say, have customers pay for the development of the product, step into joint ventures and typical type of arrangements that provide you with additional funding. Well, that's certainly the way to go.
Yeah, because I have just a feeling that a lot of founders want to raise capital like it's the logical first step. No, first create your own revenue. But okay, a question from Peter.
Cases, but it depends on the type of business you are. Some businesses, they need such financing that upfront that it's not possible. And Peter asked the question, what about normal bank loans? I think the reality is that for many startups, they're simply not available, bank loans, and that you need a certain size in order to get one. And second, that what we always tell founders of businesses is that your business is your business, and you, are your own separate being with its own assets, and you should not have them commingled with each other. And the chances that when you go for a bank loan, that you will be asked to either mortgage your house or provide a personal guarantee is pretty high, and we strongly advise anyone against actually using their own assets as a guarantee mechanisms for a bank. That I mean, I've seen cases where it happened, and of course you see those cases and they go wrong, and you have founders that 10 years later are still paying off the bank, which of course is has a detrimental impact. And if you would have to go that route, I mean, then cap it. For example, say I'm happy to provide a personal guarantee of 50K or whatever amount that you feel comfortable with, but certainly no blanket unlimited guarantee of a bank loan.
Yeah, clear. I think our time is over. So I really appreciate it. Everything was recorded, and we will align internally after to see what we can do with this.
Okay.
But, as Peter said, thank you very much. It was very interesting.
Okay.
Speak very soon, David.
Have a nice day. Okay.
Bye.
Bye.
Hello. How are you?
Very good, very good. And way more in shape than the last time we spoke, because last time was in London after the day 2 of Cretech, etc. So totally tired, but yeah, all good.
Do you hear me well, or should I put headphones in?
No, no, we hear you perfectly, and we are already live. So
okay.
No confidential inside jokes.
No problem, no problem.
So welcome, welcome to the grill, Eran. Good to see you.
Same here.
And so the purpose of our conversation now is to understand a little bit what's the animal, what's Constellation Group, what software, what's Perseus Group, what is it that you do there, what are your lessons learned. So it's a bit of a different format. And so why don't we start, if I may jump you directly into the water. So why don't we start with maybe you sharing a little bit who you are and what's the history of Constellation software?
Sure. So I've been with Constellation for now 2 years, and I've joined Constellation after quite a long career already that started in submarine cables, which is quite unusual maybe, but led me through to PropTech eventually in 2016. So I was first the COO of a startup called CloudScraper that was trying to change the way transactions in commercial real estate are done by trying to put everything online. And that was at its peak, very successful with maybe 300 organizations on the platform and maybe over $1.5 billion of transactions.
Wow.
And I left them in 2019, and with the idea of trying to do, after several years in startups, there's this moment that comes, they say, well, I've never been a founder. And he said, I have to try once. And so I hooked up with Martin Seckel, who was with me also originally, and CloudScraper, and with Barbara Knoflach, who was a very senior lady in the commercial real estate space, used to be the global CEO of BNP Paribas Investment Management.
Wow.
And we had our own take on what we wanted to do in that space, and we started working on this. Unfortunately, the COVID effect in the meantime and everything, eventually we kind of dropped the ball there, and each went back to its original activities and so on. And this is when I joined Constellation. So I know PropTech, quite well from both sides of the story.
Yeah.
Now, when you ask me about Constellation, Constellation has been around for many years. It's actually started in 1995 by a man named Mark Leonard, who is still the chairman and president. And at the time, Mark was in venture capital, but he wasn't really happy, or something bothered him about the traditional model of venture capital. And that was the fact that at the end of an investment cycle, you basically sell the good companies. This is how you make your returns. And there is something counterintuitive in that. You want to think that you want to keep the good companies, and that's exactly what bothered him. So he was looking for a model that will allow him to keep the good ones. And he started Constellation. It was very successful, and one acquisition led to another. And then in 2006, Constellation became a public company on the Toronto Stock Exchange. And I believe in 2015, we joined the DSX 60, which is the big companies index on the Toronto Stock Exchange. So today, with, I believe, around 800, nobody really knows the figure, but about 800 acquisitions under our belt. It's a global company, active in many, many verticals all around the world. There are 6 operating groups, and within the operating groups, there are portfolios, and the portfolios usually specialize in specific verticals.
Yeah.
And this is our way, to keep this very complex structure of many, many businesses. Romulus, which is the portfolio I work for, is one of those portfolios. We focus on PropTech and FinTech. And we are responsible for 27 out of these 800 acquisitions. Overall, Constellation last year did $6.6 billion in revenues, and this is all software revenues. We are not a financial institution. This is purely software revenues of the different businesses we own. And I think 1.9 was recorded in Q1 of this year. And we continue to be a very acquisitive company. Last year, 1.9 billion was spent on acquisitions, and of course, the first quarter of this year, 450 million, around something like this. So it's still a very acquisitive company.
So you mentioned, is it 17, the number of acquisitions that you made in your group?
27.
27. Okay. We will discuss that in a second.
Sure.
Okay, crystal clear. So I've read, so you can confirm or infirm that the average price of acquisition is something between 2 to 4 or 2 to 5 million dollars. And in 2022, I think Constellation acquired something like 134 softwares, accounting for, you just said, 1.9 billion. So I would like to understand a bit more, like, because this is high volumes, it's super high volumes. And so I would like to understand, what is the long-term vision, the strategic direction that you guys take?
Okay, so first of all, just about the numbers, I'm not sure about the 123 or 134 that you. I'm not sure. Maybe if you find it in the financial statements, then I'm sure it's right. I haven't really looked for it, so I cannot confirm this number. But generally speaking, in 2022, yes, 1.9 billion was deployed in acquisitions. 1.2 out of that is 2 acquisitions. So when you say small acquisitions, you have to understand that, the average of them, it's very misleading.
Yeah.
Because 1.2 was just 2 acquisitions. There was one very large acquisition for over 700 million and one acquisition for about 500 million.
Wow.
And the rest, and I'm not sure if it's 132 or it's 50 or it's 70, I'm not sure about the number, but the other 700 divides all the rest. So obviously you have small acquisitions, but you also have very large acquisitions. Now, historically, Constellation did focus on the smaller acquisition, and that's right. And this is in many ways still the bread and butter. But with size comes also the opportunity and the temptation, if you want, to do bigger and bigger acquisitions. So we start seeing in recent years a move to also from time to time do bigger acquisition. I think the first big one was Topicus, I think 2019. That was, if I'm not wrong, 350 million. And those two in 2022 was another markup. Now, but overall, as a strategy, as far as I know, Constellation strategy hasn't changed. The strategy is, the acquisition of really good vertical market software companies and the nurture of them long term. It's a very, very simple, very, very straightforward model.
Yeah. Okay. Thank you for this. And now, when you speak about yourself, so you said prop tech and fintech. Can you tell us a little bit, what do you focus on? So a bit more granular. Maybe also some examples of the recent operations that you closed.
No problem. So yeah, we are a prop tech fintech portfolio, and on the real estate side, we have 2 large groups. One that is facing the agents in North America. So for those of you who are not familiar with the residential market in North America, the agents are usually freelancers and therefore buy some of the products themselves, and the brokers are like corporates. So everyone is a freelance really in the market. So we have one group that is facing the agents, where we own 2 very large CRMs, Market Leader, which we acquired, I think, in 2015, and that in many ways is what started this portfolio. And by the way, the person that led Market Leader, Scott Smith, is now the head of co-head of the portfolio, and he's on his way to London. I'm going to meet him tomorrow morning. And next to it, we have another group that is facing the brokers, the enterprises, and the MLSs. So these 2 kind of make the bulk of the real estate. Next to that, we have a group that focuses on selling software to asset-based lenders and credit unions. And in the middle, what kind of brings these 2 parts together is mortgage, because mortgage kind of sits in the middle between, it touches real estate on one side of it, and the other side, the customers are really lenders and financial services. And so mortgage has been kind of the glue that puts everything together, and also the focus of our investment strategy in the last 18 months. So we started 2022 with one company in mortgage called Mortgage Builder. It's a loan origination system. And then we acquired in 2022 a company called Reverse Vision. Reverse Vision is, part of the incumbent in North America in reverse mortgage loan origination, or what we call here in the UK equity release mortgages. And after that acquisition, we did another acquisition in 2022 of a company called Axacor, which gives also document management and some other services for mortgage lender. We are also now in the middle of another acquisition in mortgage, which obviously I cannot tell yet much about it. But I think that what happened is that mortgage is not just the glue that puts everything together. It is becoming now a substantial part of what we do. Another thing that we are obviously focused on is our geographical coverage. 26 out of the 27 acquisitions we've made are in North America. So we've made only one acquisition so far here in the UK. We own a company called Selecta Pension, which does software for IFA, for independent financial advisors in the pension space. So this is what I do. I'm based in London. I'm responsible for extending our coverage geographically here in Europe, and that's also a big part of our focus going forward.
Yeah, crystal clear. Okay, I would be also interested to understand, like, if you can buy different competitors, because it's not like investing where you would not invest, like Rocket Internet was investing, you know, in the two different competitors and then see which one will survive. So it's different when you buy them, because you can incorporate them, you can kill the brand or whatever, you can do whatever you want, but bring the company to the next level. But so let's first start with maybe your sourcing process. So understanding a little bit, like these 27 companies that I would say your group has acquired, or your subgroup has acquired recently. So can you tell us, how do you work with the sourcing, and how do you process when you identified something interesting? Like, also, how do you execute the acquisition? Is there like an investment committee, or what's the governance, and how long does it take as well? So like all of the details would be very...
No problem. But first, I'll just make a comment about what you said about owning competition, because this is something that actually happens to us. I mentioned a minute ago that we own two CRMs. We actually own two former competitors. Market Leader and Top Producer were bitter rivals originally. And in some ways, they are still, because we keep them as two independent businesses and they do compete. It's true that they are overseen now by one person, but we have two different sales teams, and they fight, and they, you know, sometimes they win business from one another, and we are, you know, in a way quite used to it, and it's completely normal for us.
Yeah.
Now coming to our sourcing, so we have a very long-term view, and this allows us to really canvas an industry or canvas a vertical very, very well. So we are attempting to know, I mean, you can't really know everyone, but we are trying to really reach out and talk to as many companies inside the verticals we operate in. And we can develop relationship with them. We can develop conversations with them over an extended period of time. And this allows us to really know the vertical. And don't forget that once we also acquire and we have people operating within this verticals, we also have local knowledge, and we know who is who, and we attend, you know, conferences and so on. So we really go deep into the vertical to know it and to have an extended relationship there, so that it will allow us to pick up what we think are the long-term winners. So it's quite normal for us to have a relationship with a company for several years prior to acquisition. And this is the way we operate. In Romulus, we have 5 people doing this, and between us, we probably meet a few thousand companies a year, and we stay in touch with a lot of them. And those relationships create those, basically create this sourcing almost naturally, I would say.
Mm-hmm.
Obviously, we're also open to, approaches, and people, brokers contact us and so on. But the majority of what we do is really this network, this large network of relationship that we develop and that we are integrated inside these verticals in order to really know and allow us to pick up the winners. Now, Obviously, there are investment committees, but this is more post-sourcing. What you
Just
actually,
maybe
yeah.
One point on what
Sure.
you just said. After that, we go more through the execution, like the governance part. I think building relations is one of the biggest. It's one of the biggest keywords that I think we should understand when we work in this sector. That it's really about building relations. So it's not a hit and run. It's not quick things, etc. It's build long-term relations. So I think I just wanted to emphasize the importance of relations in all of this. And so this is what VCs do. They build relations. This is what you do, building relations. And at the end of the day, it's very important to behave well, right? To have virtuous behavior, because it's also a reputation game. So
yeah, I mean, think about it from the side of the founder. I mean, people think about. I mean, okay, we are, because we are coming from real estate. It's always good to give an example of real estate world. When you think about somebody buying or selling a house, you say, oh, this is the biggest thing you've done in your life. You want to have somebody that you trust next to you. So imagine selling your company. Usually, I mean, for a founder, will do it once in their lifetime, and it's the most precious asset. So you want to hand it over to somebody you trust. So I think these relationships are very, very important. It also allows us to really know, who we are facing, and allow also the companies to know us and to trust us. At the end of the day, we see ourselves as providing a permanent home for their business, a long-term home for their business. So these relationships are very important, and I'm, this is a big part of what we do.
Okay, and now you were about to start explaining.
Yeah, so about the execution process. So it usually starts with, most of the decisions today, up to a certain level, are done in the portfolio. Yeah. So when an opportunity arises, we have kind of an internal portfolio committee. We don't go to an investment committee to start a process. And we also have our own execution team inside the portfolio, which allows us to be very quick, very nimble, and to close a transaction in an average between 8 to 12 weeks. Obviously, there are investment committees also inside Constellation when you have to, depending on the size of the transaction. But this is kind of on the side. It's not, it is kind of a portfolio seeking, overall approval for the case. I wouldn't necessarily see it as part of the sourcing, but we're definitely very, very experienced and organized in a way that we can execute, high volumes of transactions.
Yeah, no, for sure. Okay, what I'm also interested about is to understand how you, were there acquisition targets defined, saying you need to do this amount of acquisitions, or you need to deploy this amount of capital, or you need to absolutely invest in these specific investment themes? Sure. How was all of this defined? And is it super defined, or do you still keep a room for flexibility, or how does it work?
Okay, so there is a lot of room for flexibility. So first of all, the investment thesis or the focus is completely in the hands of a portfolio. You can decide whatever you want to invest in terms of the verticals and geographies and so on. And it's usually portfolios. I mean, I don't have a view of all of a Constellation, but from what I see, and definitely from Romulus, it's very natural. It evolved very naturally. So there were, in our case, a few acquisitions in and around real estate, smaller ones, and then came Market Leader, and Scott came with Market Leader and brought with him all the knowledge, and together with Tom George, is the other co-head of the portfolio, basically started building it because that was their world. They knew what they were doing. They already had a small start, and then Market Leader joined it. And it was not by design. Nobody set them up to say, oh, you have to establish a real estate portfolio. So Constellation, in many ways, grew organically from different people starting to grow and invest in areas that they started to feel that they are, confident of, that they have good relationships in, or that interest them, or that they see good opportunities in. Yeah. So there's very little kind of direction, coming from above and what you need to invest in. I think overall, when we are, if you're trying to look for the common denominator for everything, it all starts with finding a long-term winner, and it all starts with verticalization. So we are looking for companies that are really vertically focused. I had a conversation the other day with the CEO of a company, and she told me, well, we are not interested for you, interesting company for you, because we only specified on a specific niche of the market.
Yeah.
Well, I said, on the contrary, and that's exactly what I'm looking for.
Yeah.
Because usually vertically focused companies have found their audience, found their very good market, product market fit, and therefore are able to protect their territory long term.
Yeah.
So we're looking for verticalization. We're looking to see if things are mission critical to that vertical, if they're sticky. We're looking to see, can they show us that long term they had very low attrition, very good customer retention, because these are usually markers for a long term winner.
Yeah. Okay, clear. So M&A operations can both succeed or fail. I've seen many operations that failed for reasons like no product integration, no team integration, or accounting things, or like a lot of can happen. And so it's not because the deal is signed that it's a success. When the deal is signed, it's just the beginning. And so I would like to understand from your perspective, like what are the pitfalls to avoid, maybe?
Sure. I think I'm going to a little bit disappoint you on this question, because by design, we are a little bit different. And that, in a way, takes a lot of those pains away, because we are not integrating things in the normal, post-acquisition or kind of merger style integration, because we are not, by design, we are not trying to be a homogeneous, one big conglomerate software company. We are much more like a holding structure for many, many different software companies. And this allows us to have, if you want, a software integration and to keep the businesses with a high level of autonomy inside an environment, which is a portfolio, which is much more, tight and smaller and protective, if you want, from the big corporate world outside it. And this, I think, makes our integrations easier and more successful. Every portfolio, I believe, at least we have our own CFO and COO, and that's mainly their territory. And in our case, our CEO, Karen, is very, very experienced, and she would bring those companies in-house and help them. And in reality, what we are trying to create here is an environment where whether it's the founder, whoever is staying post-acquisition to manage this business, really get supported and get on all the G&A stuff. So finance, compliance, legal, all of those things can be handled centrally by the portfolio, but maintaining ownership of the product, of the marketing, the sales. So for example, we don't have a brand issue. I mean, most of the brands we own, from time to time we merge things because they're small or because over a long period of time things have evolved. But our first instinct always will be to keep the brand as it is.
Yeah, clear. So you touched upon already a little bit, but I would like to understand a bit more, like if Constellation has a specific approach to managing and nurturing acquired companies. So you mentioned the sort of autonomy and our independence, including brand, etc. But can you elaborate a bit more on what you do after the merger?
Yeah,
especially from a nurturing perspective.
Sure. So I think it comes to finding this environment that the leader of this business, the MD, whether he or she was the founder or was an executive in that business and stays on, to still give them this environment where they still have ownership of this business and get the support from the portfolio, but really are accountable for the performance of this portfolio. And we usually would not buy even a business that doesn't come with its own management.
Yeah.
We don't have the practice of bringing management. So the management is usually the organic management that came with the business. We try to give them as much as autonomy and ownership as they can. they also compete. So they can also, if they want to continue to invest in themselves, they basically compete against me on resources, and it's fine. So I can suggest an acquisition, and a company can suggest a project, and whoever gives the best case will win. So it's not that we are preventing them also from investing. So as much as possible, we have created an environment that allows these businesses to really feel as part, as part of a big family with a lot of support, but as autonomous businesses.
Yeah. You have also to keep incentives for the management post-acquisition. So I guess you also have a plan for this.
Yeah, I mean, there are plans, and everyone in the portfolio is remunerated partly as the success of the whole portfolio, and obviously their own individual targets of ownership. And I think we have a very good structure there that makes sure that people on one side pushes their own business, but on the other side also sees the big picture and enjoys the overall success of the portfolio.
Yeah. So I would like to maybe ask more of a personal question in a way, so understanding a bit in your very diverse career so far, if you look behind your shoulder and breathe a little bit and look at the achievement that you have done, what was the most challenging time that you went through, that you navigated? What are the lessons learned?
Okay. So coincidence or not coincidence, it's actually related to an acquisition, but not when I was the acquirer, but when I was acquired. I started my career, I think I said it at the beginning, in submarine cables, and I started in a startup. Two founders that understood, the direction of internet and the deregulation of the industry, and decided to commission a privately owned submarine cable in the Mediterranean connecting Israel to Europe. And this was later, Telecom Italia took 51% interest in this project and eventually bought it out completely, 100%. And in this buyout period, which was basically an exercising of a put option, I found myself as a young executive in Dublin, so on fresh couple of years after relocation, as the head of FP&A, financial planning and analysis. And I found myself in the eye of the storm for two reasons, because the two things that were most debated and what was defining this whole process were the projections, which I produced, and basically the buildup of the network, which is another relationship that I own, because we were building a $400 million project. 250 million out of it was one supplier, which I managed those relationships. So you can imagine that every movement there defined, on one side, the deployment, on the other side, our cash flow going out. And I was also very, very isolated. I was in Dublin. I was basically reporting to a new chairman appointed by Telecom Italia. So it was really, 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 really challenging times for me. But I think that what helped me or guide me through this, and which I took from that period, was first of all the understanding that the company is its own organism, its own entity, and this is really what should guide us: is what is the company's interest? In normal working circumstances, we don't think about this. Everything looks aligned, but in an acquisition, when something like this, when different shareholders pushing you different directions, you realize that you don't work, and we always say we work for our shareholders. Well, we don't really work for our shareholders. We work for a company, and we need to do what's good for the company. And if you do that, you can't really be wrong. And that, I think, what really guided me over those several months that this process took, and allowed me to kind of get this view that everything is personal, but nothing is personal, and you have to really stick to and what is the good of the company, and this is what you should do, and it doesn't matter. And if you stick to this, you can always explain what you're doing. And obviously, I was fighting a two-front battle. On one side, internally on the forecast and so on, and on the other side, how do I manage to keep the relationship with the supplier going forward, even though that times are challenging, and we pay or don't pay based on the political arguments on cash calls between shareholders. But ultimately, I must have done it okay, because I stayed with Telecom Italia and was promoted several times after that, and I also stayed in touch with the original founder, who was my mentor, and later actually worked for him after I left Telecom Italia for a while. So I somehow managed to juggle those balls. But this is, until today, this is probably one of the most stressful and challenging things that I've done professionally.
I can understand, and I think it also what makes you a quality person. If you have not been through challenging times, if you don't know what it takes, it's like in boxing. We said if you never get a KO, then it means that you're not a good fighter in a way.
Yeah, for sure.
So,
I mean,
okay.
and today I'm trying to bring all this experience and the fact that I was a founder afterwards as well. So then when I'm dealing with founders and I'm dealing with companies, that I can really see the whole story and understand all the the challenges and the fears and the hopes that they have in order to secure a good transition or a long-term ownership of the business that they've built.
Yeah. Thank you, Eran. This was very this was what I was hoping for. So thank you very much. I appreciate it.
Thank you for the opportunity, and good luck in the rest of the day and tomorrow. And yeah, all the best.
Speak soon.
Cheers.
And so
Bye-bye.
Before that we jump into the break, I just wanted to make sure that everyone reminds that just remind yourself that we have this selfie contest. So it's fun. It's come on, let's have a bit of fun. I will also apply. I will do a selfie myself now. So it's as easy as this. Take a picture, send it over to idris@relevation.org. We announced the winners last year, and to show you that it really works, when we launched in 21 the contest, the winner was someone joining Relevation from the beach. So that's pretty unique. And last year, I think we had also some top 3 candidates. Someone waking up at 5 a.m. in the morning to follow the sessions in real time. Number 2 was someone dialing from the train, and the third one, Enric, my friends, who won also last year, was dialing from an electric scooter. So it does work. Please come on, let's play the game. And so thanks to our sponsors, of course, and our partners who made this successful, who are echoing our message, who are joining force with us. So we're grateful. Enjoy the networking. See you at 3 p.m. with a very interesting session to discuss all of the last M&As that happened in 2022 with Jeff from Ascentage. Speak very soon. Thank you.
CEO and one of the co-founders of Atmos. What I think is really cool is that we, with our product, are supporting people out there in the field who are changing the world on a day-by-day basis, bit by bit, to prepare it and to make it ready for future generations. For me, it is very important that this small amount of time that I'm on this beautiful planet Earth to actually make a difference. And by founding Atmos, I had the opportunity to create a solution that actually helps professionals all around the world to tackle challenges that has to do with the mass urbanization or the climate change, for instance. So in that sense, I'm very proud of what Atmos already has achieved directly, but also indirectly. And I'm very curious for the future.
Marlin's engineering is special because the whole team, the whole development team is challenged to solve a multidisciplinary problem in all aspects, and we have really challenging requirements because we want a high wind resistance, but at the same time versatile and user-friendly drone. But you know, the way we tackle these problems and the way the team is able to come up with a very elegant design, but at the same time answering really complex problems is, I think, something unique. Marlin combines the effectiveness of mapping large areas and the user-friendliness, so it's really easy to control Marlin, but at the same time the robustness and the high wind resistance. So essentially, as an operator of Marlin or as a user of Marlin, you don't have to worry about anything going wrong because the system has got your back.
Hi, I'm Dirk Doctor, one of the founding partners of Atmos. Marlin is used in many different industries, ranging from industrial applications like construction, infrastructure, and cadastral monitoring, up until more research-oriented applications, like, for example, nature conservation, geological research, and agricultural research. What excites me about Atmos is that we don't stop at our current product. We don't stop at what we have now, but we are constantly doing research into new markets, new technologies. We try to find new boundaries of this technology and try to develop future products that will be even closer to the edge of what is possible.
We built Marlin here because we are located here, of course, but it's also a way for us to ensure quality. By making Marlin here in the Netherlands, we ensure that each Marlin that goes out the door is safe to use, because it is a flying object in the end, and that allows us to be in control. We do a lot of manufacturing in-house, which means that we gather a lot of knowledge and skill in-house that allows us to do a very broad array of things which is needed to create a very complex product. And in the end, that's something we need to deliver the quality that people expect.
Very early on as a kid, I was actually already interested in technology. But throughout the years, I have learned that the technology that excites me the most is actually the technology that can provide a positive impact. And what I'm really proud of is that we have just achieved that with Atmos by enabling others to literally change the world.
Imagine that you could navigate in seconds using digital models through multiple layers of data analytics accessible for data-driven decisions. From the space you are located to the city you are living, the power to manage your assets is in your hands. We propose to manage your buildings and infrastructures using a digital twin based in BIM digital models, federating discipline models from a common data environment and locating multiple assets in the city using GIS technology. Multiple assets and data will be analyzed and results interactive with related components. Our digital twin will be able to integrate all kinds of simulations for building performance, connect to BIM IoT services and unmanned systems, convert to smart buildings to analyze MEP and energy efficiency in real time, to use BIM models for facility management and maintenance of your spaces. Access all the systems and operate your building in remote using digital twins. From all data collected, artificial intelligence can be applied to convert your asset to 30% smarter and more sustainable. This is Power BIM Digital Platform. Organizing by dimensions all the use cases in a cloud environment easy to use. Power BIM, the power of data for buildings and infrastructures.
Welcome to Aeromine Technologies and our motionless wind energy system for commercial and industrial rooftop installation. Aeromines have no visible moving parts, hence they make no noise and they make no vibrations. They are designed for installation on large buildings with a flat rooftop, could be logistics centers, manufacturing plants, or it could be commercial buildings like offices, airport terminals, or multifamily residential buildings. Aeromines are installed right on the edge of the building rooftop, facing the predominant wind direction. This way, we can harvest both the wind coming straight in and the wind being pushed up against the facade of the building. Hence, we use the building actively to generate more power. As the Aeromine system is installed right on the edge of the building, most of the weight is also carried by the facade of the building itself. The other benefit is that the entire remaining part of the roof is free, for example, for a solar PV installation. The system profile of an Aeromine system does depend on the wind resources available locally. It also depends on the height of the building and any local obstacles that may shade the wind. Aeromine will always assess the individual buildings prior to an installation. The most typical outcome is between 7,000 and 15,000 kilowatt hours of yearly energy production for each Aeromine unit. The system can be scaled to any size, just limited by the size of the building itself. Aeromine system is a much more efficient solution than solar PV when one looks at the amount of energy produced per square meter of rooftop. However, combining solar with Aeromine tends to be a truly unique combination. Wind tends to be more evenly distributed over the 24 hours of the day, and at the same time, the wind is a lot stronger in the fall and during the winter when you don't benefit so much from your solar PV installation. In short, installing both solar PV and Aeromine may allow you to double your on-site energy production. Since we came out of stealth late 2022, we have seen more than 8,500 inbound customer inquiries. We are looking for investors to bring the product successfully into the market. In 2023, we are deploying 15 Aeromine units with multinational companies across North America and Europe. Come see me, happy to talk.
My name is Ruud Knops, CEO and one of the co-founders of Atmos. What I think is really cool is that we, with our product, are supporting people out there in the field who are changing the world on a day-by-day basis, bit by bit, to prepare it and to make it ready for future generations. For me, it is very important that this small amount of time that I'm on this beautiful planet Earth to actually make a difference. And by founding Atmos, I had the opportunity to create a solution that actually helps professionals all around the world to tackle challenges that has to do with the mass urbanization or the climate change, for instance. So in that sense, I'm very proud of what Atmos already has achieved directly, but also indirectly. And I'm very curious for the future.
Marlin's engineering is special because the whole team, the whole development team is challenged to solve a multidisciplinary problem in all aspects. And we have really challenging requirements because we want a high wind resistance, but at the same time versatile and user-friendly drone. But you know, the way we tackle these problems and the way the team is able to come up with a very elegant design, but at the same time answering really complex problems is, I think, something unique. Marlin combines the effectiveness of mapping large areas and the user-friendliness, so it's really easy to control Marlin, but at the same time the robustness and the high wind resistance. So essentially, as an operator of Marlin or as a user of Marlin, you don't have to worry about anything going wrong because the system has got your back.
Hi, I'm Dirk Doctor, one of the founding partners of Atmos. Marlin is used in many different industries, ranging from industrial applications like construction, infrastructure, and cadastral monitoring, up until more research-oriented applications like, for example, nature conservation, geological research, and agricultural research. What excites me about Atmos is that we don't stop at our current product. We don't stop at what we have now, but we are constantly doing research into new markets, new technologies. We try to find new boundaries of this technology and try to develop future products that will be even closer to the edge of what is possible.
We built Marlin here because we are located here, of course, but it's also a way for us to ensure quality. By making Marlin here in the Netherlands, we ensure that each Marlin that goes out the door is safe to use because it is a flying object in the end, and that allows us to be in control. We do a lot of manufacturing in-house, which means that we gather a lot of knowledge and skill in-house that allows us to do a very broad array of things which is needed to create a very complex product. And in the end, that's something we need to deliver the quality that people expect.
Very early on as a kid, I was actually already interested in technology. But throughout the years, I have learned that the technology that excites me the most is actually the technology that can provide a positive impact. And what I'm really proud of is that we have just achieved that with Atmos by enabling others to literally change the world.
Imagine that you could navigate in seconds using digital models through multiple layers of data analytics accessible for data-driven decisions. From the space you are located to the city you are living, the power to manage your assets is in your hands. We propose to manage your buildings and infrastructures using a digital twin based in BIM digital models, federating discipline models from a common data environment and locating multiple assets in the city using GIS technology. Multiple assets and data will be analyzed and results interactive with related components. Our digital twin will be able to integrate all kinds of simulations for building performance, connect to BIM IoT services and unmanned systems, convert to smart buildings to analyze MEP and energy efficiency in real time, to use BIM models for facility management and maintenance of your spaces. Access all the systems and operate your building in remote using digital twins. From all data collected, artificial intelligence can be applied to convert your asset to 30% smarter and more sustainable. This is Power BIM Digital Platform. Organizing by dimensions all the use cases in a cloud environment easy to use. Power BIM, the power of data for buildings and infrastructures.
Welcome to Aeromine Technologies and our motionless wind energy system for commercial and industrial rooftop installation. Aeromines have no visible moving parts, hence they make no noise and they make no vibrations. They are designed for installation on large buildings with a flat rooftop, could be logistics centers, manufacturing plants, or it could be commercial buildings like offices, airport terminals, or multifamily residential buildings. Aeromines are installed right on the edge of the building rooftop, facing the predominant wind direction. This way, we can harvest both the wind coming straight in and the wind being pushed up against the facade of the building. Hence, we use the building actively to generate more power. As the Aeromine system is installed right on the edge of the building, most of the weight is also carried by the facade of the building itself. The other benefit is that the entire remaining part of the roof is free, for example, for a solar PV installation. The system profile of an Aeromine system does depend on the wind resources available locally. It also depends on the height of the building and any local obstacles that may shade the wind. Aeromine will always assess the individual buildings prior to an installation. The most typical outcome is between 7,000 and 15,000 kilowatt hours of yearly energy production for each Aeromine unit. The system can be scaled to any size, just limited by the size of the building itself. Aeromine system is a much more efficient solution than solar PV when one looks at the amount of energy produced per square meter of rooftop. However, combining solar with Aeromine tends to be a truly unique combination. Wind tends to be more evenly distributed over the 24 hours of the day, and at the same time, the wind is a lot stronger in the fall and during the winter when you don't benefit so much from your solar PV installation. In short, installing both solar PV and Aeromine may allow you to double your on-site energy production. Since we came out of stealth late 2022, we have seen more than 8,500 inbound customer inquiries. We are looking for investors to bring the product successfully into the market. In 2023, we are deploying 15 Aeromine units with multinational companies across North America and Europe. Come see me, happy to talk.
Excellent. So welcome to the second part of day one of Relevation. It's my pleasure to kickstart the second part with Jeff from Ascentage. In this conversation, we will actually look at what happens in the M&A scene in the past, let's say, 12, 18 months. So analyzing a bit what happened and what are the trends, what was exciting or what was a bit of a surprise. So why don't we start maybe with the first question to you, Jeff? Who are you and what is Ascentage?
Good morning, at least in my time. I'm Jeff Harriman. I'm a managing director at Ascentage Advisors. Ascentage is a kind of a unique animal. We provide strategy and corporate development advisory services to tech firms in and around the built environment. That probably deserves a few more words about that. We have been in this space about almost 25 years now. Was founded by my partner, Drew Ogden, who had been part of the startup team at a company called Softdesk, one of the very early players in computer-aided design, CAD. He's an IP lawyer by background and really saw this opportunity a lot sooner than a lot of us did for more activity in the space in what was then called the AEC technology space. The truth be told, for most of the last 25 years until, say, 10 years ago, it was mainly A&E, lots of design-related technology. But our firm now covers design technologies, construction technologies, as well as asset, energy, and facility management technology firms. We focus on later stage growth firms, those that have, I'll call it anywhere from $5+ million in revenue. And what we do with those firms is help them to accelerate their growth and also sort of pre-position them for sort of their longer term strategic alternatives, be that an M&A transaction or in the rare cases, an IPO. We've been, and the whole team of colleagues, myself included, it's about a dozen sort of senior executives who've been in this space for a long time. My own background is less from the software and hardware perspective and more from the client side. So I was part of a team that helped Hochtief Construction acquire Turner back in the late 90s, and then was also part of the senior management team at W.S. Atkins prior to our acquisition by SNC-Lavalin in 2017. I joined Ascentage in 2019, and we've been serving a raft of clients in that space since then.
Clear. And in order to give a bit of additional substance to the conversation, can you maybe share a few figures to understand also the magnitude of your achievements so far?
Yeah, so our firm has done, dozens of deals in the space that this conference is focused on, and historically have as I said, focused on design-related technologies, but in the last couple of years, more construction tech and asset and energy management technologies. A good example of a transaction in that space, at the end of 2021, we helped to sell Agile Asset, which is a enterprise asset management solution for road infrastructure. We helped to sell them to Trimble in a deal that was about $240 million. And that deal closed in December 21. But we can start with Trimble. As most of your viewers know, since then, Trimble has done a series of larger transactions, and including more recently B2W, another firm that we've tracked for a long time. That's one of the last of the sort of early stage firms in the space around technology, specific technology for construction management. So that's a firm that was founded in the late 90s.
Okay, thank you for that. Now I'd like to spend 10-15 minutes to looking at maybe the recent M&As that happened either in last year in 22, or maybe this year already first 2 quarters. So can you maybe mention some of the operations that you have seen and mention like a bit of context, like the relevant details, and
sure.
explain why it attracted your attention?
Sure. So in order to put this in context, I'll go a little bit backward. So I would say in the last 5 years, we've now started to see each year at least 50 or 60 large-scale M&A transactions in this space. That's a pretty sharp contrast to the history, which has had literally a handful of deals in any given year. The principal drivers of the large number of transactions is really the industry's long-term sort of industry players. What's helpful is that all of them are what we would call sequential acquirers. So they actually have a very active build and buy strategy. The best known of those players are those on the design side. So that's Autodesk and Bentley. But we track a full 15 different firms that play across the built environment that are very active in this space. So that's Autodesk, Bentley, Esri and Faro, Fortive, Hexagon, IBM, Nemetschek, Oracle, Procore, Roper, Sage, Schneider Electric, Tomcon, and Trimble. So those 15 firms, if you look at the history, have done the bulk of the large-scale transactions across time. Last year was no exception. Those firms alone did more than a dozen acquisitions.
Yeah.
And that's kind of the undercarriage of what supports the M&A environment in this space. What's new, particularly increasingly now, are the activities of the private equity funded strategics that are playing in the space. They brought a whole new level of competition to the M&A environment. So as an example of something that looks at that, so in January 23, Hexagon bought Project Mates, which is a Texas-based sort of program management firm, program management technology firm. There were more than a dozen underbidders for that transaction.
Wow.
So that gives, and I have to tell you, 5 years ago, that would have been unheard of. So you've got just a huge number of players in the space now. And that's different. That makes for much different dynamics. Frankly, for your audience that are entrepreneurs, it's a lot more exciting, a lot more opportunity. And I think that's as I'm sure you guys have been talking about elsewhere in the conference, that's the big thing that's different about the space today than ever in the past, is the sheer amount of money that is chasing opportunities in this space. It's really become a very mature ecosystem because you've got now thousands of entrepreneurs, dozens and dozens of venture capitalists funding early stage ventures, but increasingly supporting this are not just the strategics, but now dozens and dozens of private equity firms that are willing to do growth-oriented build and buy strategies and propel the industry forward on that basis.
Yeah, no, that's clear. And according to our numbers, there are 10,000 urban tech, let's say prop tech, if we stick to this definition of an innovation, technical, technological, and business model in the complete value chain, including construction. So 10,000 globally that are reinventing construction and real estate. And so if we look at the helicopter view, you have this list of 15 very frequent and very active acquirers. My gut feeling says that we in the past had two main scenarios: real estate acquiring PropTech or tech acquiring PropTech. Real estate acquiring PropTech would be, the usual tech, the usual real estate or construction giants that acquire PropTech solutions to as part of their agility strategy. And then on the opposite, you have the tech giants like Autodesk, like Procore, etc., acquiring tech just acquiring PropTech solutions just to continue growing their revenues and integrating their offering, getting new customer base, etc., or even acquiring talent only. There are many reasons to acquire. But now you said you have this new sort of third player, which are the financial investors, the private equity.
Right.
And so that gives a new route to liquidity in a way, or new perspective.
Yeah. Right. And so I'm glad you mentioned the 10,000 startups at sort of at the base of the platform. But it is a pyramid, right? We all understand that venture investing is a very high return, high risk business. We think about there are now relatively about 1,000 of those 10,000 that have reached at least a Series A financing and have sort of reached what we would call escape velocity in terms of revenue. So they're well past they've hit product market fit. They're starting to grow, and then a little higher up, probably about 500 firms at this point that are of the scale that they become interesting to those strategic acquirers, and equally interesting to private equity firms that might like to do a buy and build roll up kind of strategy. The rarest bird at this point are potential platform investments. The traditional scenario is that a private equity firm needs a firm with at least 10 or $15 million in revenue and a full-blown management team as a platform in order to start to be the foundation or the base of their roll-up strategy. And relatively few of those firms out there. But that's only a matter of time. I mean, it's a matter of tenure. The greatest number of the players out there in the space really only got started and founded about 2013, 14, 15. In that era, not coincidentally, that's the era of mobile technology, smartphones and tablets at a reasonable price, performance factor. That's the starting group, and those alumni now, many of them are in that $5 to $8 million revenue side. So I think the next couple of years are going to see even more activity on the M&A front as that first generation of construct tech and prop tech players gets to be of an interesting scale.
Yeah, I do agree. And again, with helicopter view, so if we agree that that PropTech are modernization of construction and real estate, doesn't matter the definition you use, but like if we agree that all of this is a momentum, you have a beginning and potentially you have an end at some point. So it means that we would reach, at some point a consolidation phase where we will have a higher amount of M&A, where we will have some spaces that are consolidated, where there is not new space left for new players, some sub-verticals like this. Yeah. And so you mentioned a little bit like the history of all of this. And we have seen some really hype moments like the sharing economy, like 6-7 years ago, with all of the Airbnb waves, etc. But that didn't really materialize in a lot of very successful use case, except Airbnb. We've seen a lot of tests, but nothing that really came to maturity. And my question, it would be more like, okay, today, what do you think is really exciting for you? So what are the topics that you think are becoming hot and ready for M&A, and for which sort of acquirers?
So I think a couple of areas that I think we're really interested in, we're about to release a report that covers the area around workforce management. So as we know, sort of across the economy, there's a huge problem with a lack of skilled workforce. Coming off of COVID, not in many cases, people did not come back to their jobs. And construction in particular has suffered from a skilled shortage of workforce, but frankly, architecture, engineering have some of the same problems. And so there's increased attention on on workforce solutions that solve this skilled worker shortage from two dimensions. One, increase the amount of productivity you can get out of your existing workforce, and make those jobs more attractive to young people coming into the economy. And what's interesting about the workforce management solutions are that, the struggle here is to blend both operational capabilities, abilities to sort of manage a construction project on site, to take care of safety issues, to make sure that everybody has been properly trained and certified in that respect, and then to actually capture the data of what's happened out in the field, and then connect that operational data with financial data, have that play directly into the financial information that's shared with the contractor as well as the owner operator of any given facility. There are a lot of players. There are hundreds literally of the startups in that 10,000 that have sort of gone after that particular topic. And we're starting to see some real activity around consolidating solutions in that space. One of the earlier players offering, an HR consolidation platform was a firm called Arcoro, which was a roll-up that was done in 2018. That's therefore been under private equity ownership now about 5 years. And they've done a great job, but I think there'll be additional opportunities for consolidation in that space. One of the reasons that space is also, besides the underlying inherent growth, because they're addressing a real pain point for the industry in terms of construction labor shortage in particular. One of the other reasons this is a particularly attractive space is it coexists. It's not a direct competition to design solutions that are out there. It's not a direct competition to Procore and the other players that are in the project management space. And it's not a direct competition to the ERP players that are in the space, the financial players. So it's a nice place for multiple players to come up with a solution that can coexist with the industry giants in the space. So and you will see, I think, increasing amount of deals that'll get done in that space.
Yeah, I like this point of view, and it's also aligned with what Jean-Paul from Camber Creek was saying this morning, our time, so night during your time.
Yeah.
That nobody really knows yet what will be the future of office, and so when there is uncertainties, there is opportunities, and so we still have to define this. We still have to discover it, and so he was also agreed about the sort of attractivity of this subcategory. Okay.
No, this one's. Go ahead.
Go ahead. No, you first.
No, this is a really attractive space, and then a second space where we've already seen a fair bit of consolidation, but I think you'll see even more, is in the space in and around reality capture. So this is a space where pretty early on, players like Matterport, who came from the PropTech side, we thought would be the be-all end-all of using photo capture in order to capture sort of what's happening in reality and then match that back up with the plans and schedules, etc. They've done really well, and I think there's more scope to do that. We've had a large number of players who've raised quite a lot of money in the space around reality capture. But in that space, I think we've already started to see coming back to your earlier discussion of the beginnings of consolidation. So we've tracked more than a dozen deals getting done in that space alone over the last year and a half, 2 years. And I think that trend will even accelerate. The big players are all kind of immediately adjacent to that space. And if you think about what I was just talking about, that reality capture kind of is sort of the second piece of what's happening on job sites that you want to see more. And I have to tell you that the customers really want a a more consolidated solution there. They don't want to buy different solution for reality capture every time they do a new project. Makes no sense.
Yeah, totally agree. I remember the former CEO Europe of PIMCO, so Allianz Real Estate, was saying, as a large real estate asset manager, large corporates, we don't want to have lots of tiny solutions solving small part of our issues. We want an integrated one-stop shop solution that we can also roll out on all of the different countries with different jurisdictions, etc. So this is why I think it's maybe time to build a sort of club of scale-ups that are certified, compatible for large corporates, so they don't need to spend a lot of time assessing and so they can all, like, when you get the label, it means that you have passed all of the requirements to be deployed at scale. But I would like also to have your view on maybe the evolution of PropTech. So I heard from Fifth Wall that climate tech is a natural extension to PropTech. Some other people speak about retrofit tech as a new vertical, or you have also urban tech, including mobility, energy. So all innovations are happening at a landscape of a piece of city, not only inside buildings, indoor, like PropTech was the case in the past. So I would like to have your views on maybe, like, are they sort of outsiders that were not really considered PropTech players, like the typical suspects that are now entering into M&A, that are now acquiring PropTech to develop expertise in this sector because they see a huge opportunity? You mentioned the financial private equity players. Are there any other large corporates, maybe telco or energy players, or maybe, you know, the tech giants, Google, Amazon, etc.? Is it happening that these large companies are also trying to get a share of the PropTech market?
You do have, you know, every day new players that are coming into the space that are interesting. The tech giants, Google and Amazon, I will tell you, came in very early in the space. A little bit got their noses bloodied and retreated. But that's been almost 10 years now. So you're right. It's about time for this. What's that?
The Google with the Nest acquisition of $3 billion or something like this.
Yeah. Well, I mean, the Flux was the really first project out of Google X, and they thought they would sort of capture this entire space. And Flux kind of went down in flames in a pretty short amount of time, even before Katera happened. So, but I don't discount those players and their capabilities. So I think you will see them return. Every once in a while, we see something that, you know, I hadn't really expected. Let me take a very small example, but I think it's instructive. So we've been kind of, as part of this workforce management, kind of looking at the folks that do things like safety solutions. And that includes kind of simple operations like workforce management at the gate. So making sure that the right people show up on the job with the right credentials. One of the more interesting deals that's got done in the last 12 months in that space is that Assa Abloy, which is the large European access control player, bought CrewSite from Trimble, right? You know, that deal happened 3 months ago. I did not see Assa Abloy coming into the Constructech space. Would you know, if you told me that was the next move, I probably, maybe I just lacked imagination, but I didn't foresee that coming. So I think that's a small but pretty credible example of the kind of players that can come in from the sides. The folks that up to now, where I see the most potential interest is really in the material supply side, right? So for every CEMEX who has been in and around this space for years, there are a dozen other big players in the construction building material space who have yet to really invest in new technologies on a grand scale. So I think you'll see a lot of activity coming from the material side. And those players are interesting, not least of which because they're huge global giants and, you know, they have the kind of margins that it takes to invest in technology. So I think that will be one of the interesting set of players. The other set of players are the oil and gas players who have sort of broad energy portfolios, you will see them increasingly engaged. And then the control systems players. I mean, as I mentioned, Schneider Electric, but frankly, there are a dozen more players in the space around building technologies that will come in. And then last but not least, you know, I'm very intrigued with what could happen in the area around infrastructure related technologies. So technologies that are focused not so much on vertical construction, which is most of what we've been talking about up to now, but on horizontal construction and horizontal infrastructure, pipelines for both water, oil and gas, roads and rail, tunnels and bridges. You will start to see quite a lot of more investment in that space. We've seen consolidation for the software to manage civil engineering and civil construction, but you've yet to see as much consolidation as I think you will see on things like trucking and transportation and other things that really almost as much as buildings are impacting the overall sustainability of the planet.
That's so very interesting insight. If I may just comment here,
sure.
Because you know, when I wanted to build my VC fund, I created with the partners. It was not it was as a team, but so we created a database of 3,500 startups, which was like all of the European public startups we could source, and we analyzed the asset classes that they were serving. And so 50% of them were asset class agnostic, able to serve any real estate asset class. And then the other 50% were targeting specific asset class. And the number one was, of course, homes, because it's the biggest asset class in the world in real estate. And then it was office, etc., etc. And very interestingly, you have only 17 startups back in the days that were targeting, so 17 prop tech startups targeting only healthcare. And you had also super limited amount of vertical prop tech startups targeting only logistics, for instance. And so for me, these were two segments that were ignored, but post-pandemic, you could think that we want to optimize the way hospitals are run and also optimize the urban logistics issues, because everyone is ordering online during lockdown, so e-commerce is booming. And so I really love your point of view of saying you have the same in the M&A activity. So M&A in office is already sort of consolidated. Now the next big thing will be an M&A in infrastructure. So that would be a bit your takeaway, right?
Right. I mean, the single largest deal in this space broadly that happened in 2022 would have been Trimble's acquisition of Transporion, right? So that is for Trimble, it is, you know, it's more than a $2 billion acquisition, and that's a supply chain management and transportation solution. I mean, for Trimble, that means a whole new part of their business, a whole new business model for them, but really focused on, you know, how do I get more efficient? How do I take what I understand about geolocation, about process efficiencies that they've learned in the other spaces, and how do I apply that to transportation and supply chain in a world where you know, we're looking at declining availability of the assets that we need and increased attention on sustainability and other issues. So I think that's, you know, that's probably the single largest deal of the year that the big players did, and I think it's probably indicative of what we can expect to see in 23 and beyond.
Yeah. So Jeff, we have only 1 minute left because we need to be respectful of the timing. But I would like to ask you 5-10 more questions. But so I need to pick one. So maybe just your views on how the consolidation could happen in the next 5-10 years. Okay, are we going to land in a situation where we will have 10-20 large PropTech players that will sort of dominate the complete ecosystem, like we have in the internet giants? We have 4 or 5 large corporates that have acquired all of the others, or is real estate so fragmented that it will never be like dominated by a couple of ones, but we will have a lot of relatively big players? in 1 minute?
I don't have a I don't have a perfect crystal ball, but you're right. There is enough diversity in the pain points to have at least a degree of diversity in the technology base. Candidly, I don't think we've come even close to what's possible with technology. So I think there's still a need for health's sake to have some diversity in the offering space. So I don't think we'll slow down on the number of new tech startups coming into the space. You will see continued efforts to do consolidation because, as you say, a lot of the clients don't want to have multiple solutions. They don't care for one-off point solutions. But I don't think we're anywhere close to the ultimate consolidation that we could see. I never say never, but it's certainly not in the next 5 years that you'll see that degree of consolidation.
Yeah. Okay.
All right.
Clear.
All right.
Thank you, Jeff. I hope we can continue the conversation next time, maybe with our common friend Alain. Why not with a Belgian beer? But thank you very much. It was a pleasure.
Yep. Thank you. Appreciate it.
Wow. And now another topic, which is also close to my heart. So that's understanding how climate tech is changing the VC DNA. Gentlemen, welcome on the grill. It's good to see you.
Hello.
Hello. We have
hi Idris. Hi guys.
We have people dialing from Sofia, from Bulgaria. No. Yeah, it's Bulgaria. Yes, the Netherlands. And then where are you? Because you're always moving, Alex. This time.
I'm actually in Seoul right now.
So okay, yeah. So very exciting international panel, and we will discuss about something very specific, which is understanding what is the impact of climate tech on the DNA of VC, and how climate tech has sort of changed the way investors look at VC investments, right? And so to do this, we have Risto Valev from Urban Impact Ventures. We have Roel Callebaut from Finindus, and we have Alexander Bent from Undivided Ventures. So I suggest to kick off. And so why don't we start with maybe a really quick intro, max 1 minute, of who you are, what's your fund, and maybe like all of the key info for founders for your fund, like ticket size, stage of maturity, geographical scope, the usual thing. Christo, we start with you.
Yeah, thank you very much. Urban Impact Ventures is a Dutch VC investor. Although we have an office here in Sofia, Bulgaria, as you pointed out. Urban Impact Ventures launched its first venture capital investment fund last year. It is a fund with a target size of 25 million euro, and we are currently operating with approximately half of this size, meaning that we are still fundraising alongside the investments that we make with the already committed capital. We've already done 5 investments. As the name indicates, we're primarily focused on the sustainable transformation of cities. We have 2 main investment verticals, the decarbonization of cities through energy transition, energy efficiency, city logistics, and the circularity or circular economy applications in the urban context, like smart water management, smart waste management, and sustainable materials, sustainable and new materials. The fund invests in late seed, sometimes also seed, pre-Series A, Series A rounds with ticket sizes from $500,000 to 2.5 million euro. Geographically, we're European investor with maybe half of our focus on the Netherlands. It's a very natural destination for us. And the rest is European Union as a whole, plus UK, Switzerland, and the United States.
Noted. Thank you. Great. Why don't we continue with you, Ruud?
Yes, thank you. So Finindus is a venture capital company. So we are an open-ended evergreen structure, so not a closed-end fund. We are backed by ArcelorMittal, the steel producer, and then the Flemish region, so the local government here in Flanders. And we focus on investments in metals, sustainable manufacturing, so everything that can reduce the environmental footprint of large industrial operations, and then Industry 4.0, which revolves around the digitalization of industries, but both on the hard and the software side. Our geographical focus is the European continent, so including the UK. We also have a natural center of gravity to our home turf here in Flanders. And occasionally we also do investments in North America. In terms of maturity, we look at early and growth stage kind of companies. We have a sweet spot for Series A, Series B rounds. Sometimes we still do late seed rounds as well. We like to get started with the first ticket anywhere between €500,000 to €3 million, and can then go up to 10 million per company over the lifetime of our investments.
Clear. Thank you. And Alex?
Yeah, so Undivided Ventures is also a venture capital fund. We actually started out of Hong Kong. So we are Asia focused, not necessarily in the deals that we do, but more in the way in which we feel we can help scale businesses. So we see the biggest growth moving forward to be in Asia. So anywhere from, Southeast Asia, North Asia. As I said, I'm currently in Korea. And we're made up of previous real estate professionals, so developers and real estate people who've been in real estate funds previously, as well as sustainability experts. And our thesis is all around investing in companies solving for the sustainability challenges in real estate and infrastructure. So, we look at companies mainly out of Europe. We actually have an office in the UK and Israel and also Asia, but we have 3 investment themes or investment targets, I suppose. One is that the technologies need to be accretive to developers or real estate funds' bottom lines. They need to meet our own sustainability and impact metrics, which is quite important. And they have to be able to scale into Asia. So, again, we feel that Asia is a really interesting market over the next decade, especially for sustainable technologies.
Yeah. Okay. Great. So, of course, the title is Climate Tech Changing the VC DNA was on point provocative, because I'm not sure there is such a thing as a VC DNA. Some VC consider that their customers or their customers are the LPs. Some other considers that their customers are the founders. And then you have my friend Conan from Sustainable Future Ventures saying that a VC should be anything to anyone. So you have to adapt constantly, etc., etc. But let's generally agree that in the past, VCs were excited about any B2B SaaS technology that could scale super quickly with a revenue multiple and a rising margin or a high margin. And now they understood that in a way, it's not a software that will solve climate change. And if we really want to have an environmental impact, we need to look at things that were considered maybe less attractive, less sexy, less VC fundable, including low carbon materials, including things like this. And so I would like to have your views on this. Can you maybe share some examples of themes that you are excited about that maybe in the past were not the number one sort of focus for VCs, but that starts to be very exciting now? Starting with you, Roel?
Yeah. So it's interesting because originally we didn't start out focusing on the software. With us, it was an addition later on. So we're maybe a little bit one of the odd ones out. But I think I agree that LPs are increasingly looking into other criteria than just pure financial returns when they allocate their capital. And so this is typically where you see that, the realization comes that software has its part to play in being reducing the carbon footprint, for example, or streamlining certain processes. But in the end, you know, emissions are a physical thing, so you need also to interact on the physical things if you want to combat them. And of course, that involves, for a large part, also new technology that needs to be commercialized. And there is typically where these kind of harder things come into view, where like you need to develop hardware, you need to show that this is meeting lifetime expectations, so you need to do long duration testing, for example, and these are things, it's very hard to compress that into time. And even then, if you successfully develop the technology, there's still a big amount of capital needed, either to build factories for it or to develop the supply chain if you're outsourcing this. So timing is becoming much more crucial in these physical industries compared to software. And this is, I think, rightly so, where sometimes the issues with the short timeline of VC funds can become a bit of an issue for us. We are an evergreen. We don't have that time pressure. We can take a bit of a longer perspective, but it's definitely an issue where investors in the space and also startups need to be mindful from. If you go on board with a seed investor and he has a very short time horizon, then maybe you're not setting up yourself for success.
Yeah, I'd like to just comment here, because I do agree with you that of course open-ended funds have a time horizon alignment with founders in a way, and but also we have this time emergency, and so we know that if we don't decrease by 50% the CO2 emissions by 2030, we have 2.7 degree increase on the climate on Earth, and so it means we have only 7 years now, 6.5 years to save the world, and so also the timing has to accelerate. And so maybe that's why VC money is also a good sort of capital now, while in the past, I mean, close-ended VC money. But okay, I'd like to, go ahead,
sorry.
Alex.
No, all I was going to say is that I think that I totally agree that materials form a crucial part, hardware forms a crucial part, but I still think that software, especially in the real estate space, also forms a crucial part. And what we're seeing in portfolio companies of our own is actually pretty strong financial performance of these businesses that are able to intervene with BMS systems, for example, or really start to work with other systems in a larger developer's portfolio. And unlike other companies that may be experiencing a tough time right now with capital markets, we're finding that a lot of these sustainable businesses in the software space are actually really gaining a lot of traction. So whilst I agree that evergreen funds do pose a very interesting opportunity for founders, especially in the material and hardware space, I also think that there is, as you were saying, Idris, an opportunity for some of that software to actually get in and get out earlier, especially selling into through trade sales or secondaries or into other larger growth funds. So I think that that's interesting for us as a closed-ended fund.
Yeah, and maybe one last comment here before that I also ask your opinion, Christo, on this one. It is the fact that we will discuss if the founders have changed, but I think what is also very important for VCs to understand is that funding a software and funding a hardware is totally different also from like the support that is required from the founders. Like the founders usually in software, I've already heard from people that are in a board of hardware, and I'm also in a board of a hardware company, that after injecting the first amount of capital, a few months after, there is an additional capital which is required because we continue to invest in R&D because it's cash intensive, etc. While software, you can already sell directly. You can sell, you can be customer funded, you can pay the wages with the revenue that you generate through sales. And so it's a totally different, and so it can make the VC nervous because we continue to invest. There is still no revenue. So we will discuss that in a second. But back to the original question to you, Christo. So your views.
Many interesting topics you have just touched upon, gentlemen. and I believe we'll have time to elaborate more on all these. For us, a very exciting topic, although a little bit outside of the prop tech field, is, for instance, the future of transportation. There's a pretty good chance we're going to see really disruptive changes in this domain, changes that can solve really big challenges related to the sustainability. So future of transportation is something that excites us, and we keep on looking at this domain alongside other urban tech fields.
Yeah. Great. So
sometimes I think we also see, let's say, less big kind of topics that are quite interesting, where you stumble upon, like, for example, circular business models in the construction. So we invested in and it's great to see that people are able sometimes to rethink a whole model and say, okay, we're going to abolish throwing away a lot of materials, and that's where I think the future lies.
Yeah, clear. And I'd like to understand a bit also if the profile of the founder has changed, going from typical commercial founders, which were very strong commercially, to then the opposite of the spectrum. So typical engineers building hardwares and very good at designing things, and maybe less good at selling. So with the engineer syndrome, So they're maybe going out from academical background, launching spin-off with the university or with PhD study or things like this. So do you really see such a, is there these two sort of profile of founders? Do you see a change like this? Who are the climate tech founders, if we can do a generality?
Yeah, I mean, I think it's a big generalization to say that every climate tech founder is a PhD guy or technical guy. But yeah, you're right. I mean, I think in our business, we're definitely seeing a lot more technical folks. I think it's very difficult to roll out of bed one day and say, I'm going to start a business solving for decarbonization of infrastructure. You've got years and years of experience, perhaps, or you've at least hooked up with someone who really does understand the space. Otherwise, you're not going to make it, right? So, yeah, I think certainly we're seeing that evolution. But I think it's really interesting, right? Because I think that just because someone's an academic or a technical person, many people write them off. But I know quite a few guys who are incredibly business savvy. Just because they've been in a lab the whole time doesn't make them any less so. So I think it's very interesting for a lot of those folks. When you find a founder that understands technical and also understands commercial, they're like hen's teeth, and that's who we like to look out for.
Yeah.
Yeah.
Clear.
Yeah.
Go ahead.
I concur with what Alex just said. Typical founders in climate tech would rather be coming from academic world than from the sales and marketing department of a large corporate entity. However, as the business grows and expands into new markets, or eventually makes a pivot in its business model or value proposition, you would see the need of more sales-driven people on the team. And the subject matter experts would ultimately, focus more on the R&D side, the product development, and leave the sales-driven people, business development people to run the business. Yeah, sometimes the original founders even would step down from running the company. And that's a pattern that we've been witnessing in quite a few cases recently.
Yeah. Okay. Do you agree?
In large sense, yes, but I see this even as a positive thing. Like VCs are typically very good at trying to break down the risks within a company, and so you see that if a more technical oriented founder teams up with a VC, something very valuable comes out of it, and that you try to find, okay, how can we get some proof points earlier? Are there ways to already generate some revenues to show that there's traction? And in the end, it just makes the company stronger, which in the end is a benefit for all.
Yeah. Okay, great. Now let's look at 2050. So it has been calculated that to decarbonize the complete built world, it would cost something like $18 trillion. But PropTech is getting annually between 20 and 30 billion dollar. I think it was $148 billion invested in PropTech globally so far, historically, something like this, with a big decrease last year of 38%. So my question is, where are we going to find this money? Where is this money going to come from if we really want to decarbonize? Is it more government money? Is it more corporate money? Is it so? How can we find the budget to decarbonize the built world? Starting maybe with you, Roel. It's a bit of a tough question, but you're tough. But you're tougher. If you're with us.
Yeah, there has been some interruption in the connection, but I don't know if you still hear me.
We do.
As for my part, I think a big chunk of the decarbonization can happen with already existing technologies. So for me, it seems kind of evident that those investments will not be driven by early stage or risk capital like VC. And then, okay, for the new technologies and in that sense, both technologies that are not developed or not largely commercialized, there you will need VC money. But typically we also see that, VC money in the early stages is complemented with grants or loans. So that already puts quite some leverage on every VC funding that goes into companies. And then you will also see once these new technologies start to scale up, VC in the lifetime of a company, it's typically very small compared to very mature stages. I think about an IPO, the amounts of capital that are raised in an IPO compared to VC funding round, it's a massive difference in funding. So I'm not too concerned that the money will not be found if there is an interesting business, if there is technology that works, capital will find its way towards these companies, I think.
Yeah. Okay.
Well, I mean, I think if you look at the big private equity, brand names, almost all of them have or beginning to have large impact funds, right? And when you speak to them, a lot of them don't have a lot to invest in today. So when they've got to write minimum $100 million checks, there's not a lot of at scale businesses within impact, quote unquote, that they can invest into. So I really do agree that, you're going to see an evolution there and you're going to see bigger and bigger checks. I don't think VC will necessarily, they're certainly going to incubate these companies and help them get to that stage, but they're not going to necessarily solve this problem. And then also, if you look at somewhere like I'm in Asia, right, where in Asia today, only 5% of all family offices, and you have some very big family offices in Asia, are investing into impact. In Europe, I believe that figure is around 40%. So the scale and the interest level is increasing. And I think once that does, the amount of capital to invest in the space is going to continue to increase.
Yeah, which is a good bridge to the next question. So about the impact and about the metrics and about the reporting. So it is, of course, common practice, or it's market standard, or it's even a requirement that VC invest skin in the game when there is capital. So they always invest between, let's say, 1% and 4%, commonly 2%. And more and more we see VCs, and especially impact VCs, that also link their carried distribution to their impact performance, so meaning that they will get 50% of their carried is depending on the impact performance of their portfolio, which really forces them to invest only in startups that will have a social or environmental impact, and then they need to calculate and to report at the portfolio level. But so the question, still being on purpose super provocative, is climate tech transforming the bad, arrogant, selfish, financial-driven VC into purpose-driven, philanthropist, and altruist people? Like, are we going to really have impact as a common denominator for everyone, that everyone speaks the same language and everyone is finally interested in the good for everyone, you know? So starting off with you, Christo.
Yeah. I feel obliged to say a few words about that, being one of these VCs that have already tied their performance fee, the carried interest with the impact results. Firstly, it's quite unfair to stigmatize the VC profession with arrogance, bad behavior, or selfishness.
Of course.
After all, we are managing other people's money, and we have our fiduciary duty to our investors, the limited partners in the funds. But now, on your question, I think climate tech, or generally speaking, the impact investing, does not hold the magic wand to transform people overnight, unfortunately. Maybe it attracts, first of all, professionals who have the right mindset, already tuned in the proper way. And I wouldn't say that we're pure philanthropists. Impact investing is by definition about both the profits and the purpose. Generally, can't have a really impactful business case if it's not financially sustainable case by itself. Now, linking impact results with the carry distribution eligibility for the fund manager by far is the legitimate way to prove you're true to your investment and impact thesis and fund management strategy. And it's a way to show that you're not playing these washing games, greenwashing, impact washing. That's my opinion.
Yeah.
It's a must.
Okay. Good. So we have only 4 minutes left. I would be very interested to hear about how to source, how to curate, grow your portfolio companies, and also about what can happen in the exit strategy. Like, what are the routes for liquidity for climate tech startups? Because it's a recent space, so we don't really know in a way. And especially also with the impact perspective, like, can you sell to a Total, for instance, to a large oil, etc. Like, how does it impact your impact performance, basically? But I will maybe ask you one last question, since we have people from different parts of the world. What are the different trends in climate tech in the different geographies? So do you see any sort of is there any difference in APAC, in EMEA, in US regarding what is hot in climate tech? And I think, Alex, you're maybe the best place to start with the answer.
Yeah, I mean, listen, the reality is in Asia is that we're a little far behind, right? We have something called the ASEAN taxonomy, which is coming out of Singapore in a little while, but it's not a legal binding document like the EU taxonomy. It's really basically a practice note. But you are seeing change, right? And the reason you're seeing change is actually driven by commercials. So I'm just talking about the real estate sector in particular. What's happening in Europe is directly affecting Asia because there are a lot of tenants that occupy space in buildings throughout Asia. And they're actually telling their landlords, which are Asian landlords, listen, if you don't change X, Y, and Z from a sustainability and impact standpoint, we're not going to rent your space. So I think that is changing. And I think ultimately people are just understanding in Asia that sustainability isn't necessarily expensive, that in a built environment context, sustainability can actually reduce costs. And I think that ultimately will move things forward. But at the moment, we're still a little far behind from Europe in that context.
Yeah. Roel, you want to add anything?
Well, I think Europe has been leading in the sustainability space, at least on technology and legislation side. But recently, I think in the US, with a lot of government-related funding opportunities, they are trying to catch up. So it will be interesting to see how it plays out further. But it can only benefit the world if everybody is trying to be at the forefront of this domain. So,
on the condition that everyone is willing to share, but we can only win collectively, as we said in the introduction. We can only win together if we share best practices. So yeah, Christo, do you have any views on this?
although we are mostly recognizable as an European investor, we do receive a lot of inbound deal flow from many various geographies. So my observations are that the sustainability themes that are on top of founders' minds are not very different or geographically determined. So generally, I wouldn't expect to see notable differences in investors' preferences towards specific sustainability themes per geography or depending on where these investors are located.
Yeah. Okay. Well, thank you very much. This was honestly, it's too short, 30 minutes, because this for me was an appetizer, and we cannot like just let it go like this. Come on, okay, we need to repeat it and to finish our question next time. So thank you very much,
Thank you,
Alex, Raoul, Christo.
Thanks,
See
guys.
you very soon.
Bye.
Take care. Bye-bye.
But while saying that this was only an appetizer, I realized that in fact the next conference will also discuss about this with seasoned people, my friend Michael Beckerman in direct, which is probably the most important thought leader in the space. So I'm honored to pass the torch to him. Isn't this a warm welcome?
Thank you, my friend, and congratulations on another successful Relevation 2023. It just keep getting better and better. The content's amazing, and I'm thrilled and excited and honored to be part of this year's event. So thank you so much, my friend.
Thank you. And I leave it to you here. The floor is all yours. You are the lead.
Wonderful. So we'll jump right in then, okay? Thank you, everybody, for joining. My name is Michael Beckerman. I'm the CEO of Cretech. We run two large, now they're large, it started out that way, conferences focused on real estate technology and sustainability, one London and one upcoming in New York and in September. And I'm thrilled to be joined by Iris and Peter for this wonderful, wonderful conversation. It's a short one, but one that's incredibly important to me personally. We're talking about trends in sustainability venture. This is a topic that, for me, recognizing that the built environment is 40% of all carbon emissions is a shocking fact, but it's also one that gives me a lot of excitement about the future of this mission and this movement and this sector of folks that are decarbonizing the built environment. And two that I'm super impressed with that are making a huge impact are joining me today, Iris and Peter, as I said. So let's just jump right in. And Iris, if you want to introduce yourself first, tell everybody a little about you and your firm, and what you're focused on.
Sure. Thanks, Michael. Thanks a lot for the introduction. I'm Iris. I'm essentially a chemist by background who ended up turning to the dark side. During my academic years, I worked on processes to convert carbon dioxide into sustainable fuels. And it was very interesting, learned a lot of fundamental things, but eventually moved to the dark side, also known as venture capital, however, with good intentions. So I'm currently focusing on making a significant dent in climate change. I'm head of science at the climate tech venture capital firm Extantia Capital. We're based in Berlin. Head of science is actually quite an uncommon position for a venture capital firm. I don't know of many that actually have one, but there's a reason for our fund needing a head of science. And that's because at Extantia, we actually want to solve big problems. Now, big problems, what does that mean? To us, big problems are sectors that emit at least 1 gigaton CO2 equivalents per year. And we use this as a mandate when we screen for startups. So because of our emission savings mandate, we almost exclusively invest in hardware. And we simply don't believe that greenhouse gases can be removed from the physical atmosphere with some sort of app on your phone. And that's why we're actually very passionate about this. And this is also why I, as a chemist, am deeply involved in the investment decision-making process of the venture capital firm. I'm on the investment team, speak with founders on a daily basis, typically from a more technical perspective, but deeply involved in the decision-making process. And yeah, thank you, Michael. Thanks for being here and for introducing us. I'm quite excited about today's panel.
Wonderful, and apologies for the American ignorance of mispronouncing your
All good. Both Iris or Iris, it's both good. Thank you.
Peter, big fan, obviously, as well of all the work that 2150 is doing. So if you want to introduce yourself and your focus to the audience, it'd be great.
Sure. Yeah. And thanks so much for having us on the panel, and thanks to the Relevation Group for allowing us to have this forum. So I'm Peter Hirsch. I'm the head of sustainability at 2150. We're a venture capital fund that is focused specifically on urban sustainability. We're sort of an early stage investor, sort of seed to Series B is the way that we describe it. But in climate tech, we understand that can be slightly ambiguous. But why cities, and sort of why do we focus on the urban space? And it's, when you think about where impact currently lies in terms of where emissions are generated, where the majority of materials are consumed, where the majority of our energy is consumed, cities are really the drivers of climate change as we understand it. There are also such concentrations of economic activity that they provide this opportunity to invest in new solutions and technologies and innovations that ultimately can change how we might be able to address climate change in the longer term. So at 2150, when we say we focus on urban sustainability, what that means is we look at energy, transport, buildings, industry, and sort of all those different urban systems that come together that need to massively shift towards a more low carbon and resilient route in order for us to actually achieve the goals of the Paris Agreement. My role within 2150, head of sustainability, is really to make sure that whatever we invest in meets that high bar of impact. For us, we look beyond just carbon. While a lot of our portfolio is focused on mitigation, we understand that to reach the goals of the Paris Agreement, we're going to have to think about the resilience of cities, the way that we make them more circular, the way that we address biodiversity. All this sort of feeds into our impact thesis and how we go about this due diligence. So much like Iris, I'm working with founders and having these phone calls on a very regular basis. We're really trying to get into making sure that we can maximize our impact returns as well as our financial returns.
Great. Thank you both. I'm thrilled to have you both on this session. So clearly in the world of tech, the world of real estate, and the world of real estate tech, there's a lot of headwinds in the marketplace today. As it relates to climate tech, it's quite the opposite, isn't it? We're seeing a lot of tailwinds. Venture funding is up. I think it's an all-time high in our particular space. How would you both characterize this moment in time where we're at today and sort of how that's impacting your sort of investment outlook as a firm? So Iris, where are we today in this market cycle as it relates to climate tech and from your perspective?
Yeah, thanks, Michael. So I think we're of course talking a bit about prop tech and both climate tech, and I'll maybe start off with a little disclaimer. So I'm a chemist by training and not a realtor or a prop tech expert. So I think I'm quite curious to hear what Michael has to say. But even in the current economic climate and the current funding perspective with everything that's going on, a lot of venture capital funding went down over the past years, but climate tech didn't have as big of a fall as some other sectors, which on the one hand, it's a bit scary to see that maybe an economic crisis is coming our way, but on the other hand, it's also exciting to see that, even though that's happening, people are still excited about climate tech. So, however, when it comes to the built environment and to property related technologies, I'm quite curious, Peter, how you feel about that.
So I think rather than focusing on specifically the sector, I would say, and I would be interested to know your opinion on this. I think we're seeing a bit of a movement towards, for lack of a better term, just value creation, that where if you have a product or if you have a software that specifically delivers a sort of tangible outcome, those outcomes, when it can be energy efficiency or it could be increased resilience or reductions in emissions, reductions in energy consumption, those inherently have value to the user. And that is something where when you build revenue off of it, maybe the multiples to revenue to enterprise value are changing a bit, but that is a much more sort of sticky proposition to create value off of than maybe something we've sort of seen grown over the past decade. But Iris, I'm not sure if that's sort of what you're seeing in sort of this retreat towards, okay, what's the actual sort of value creation side of things in venture?
No, for sure. I think that's more and more coming up, that, people actually seem to care about the value that something creates and not, obviously you should also create returns, but apart from returns, this whole sort of impact investing, I think that's what you're referring to. It's more and more what we're really seeing.
So just unpacking that a little bit further. So the number that I've read is 20 trillion to decarbonize the built environment, whether it's 20 trillion or 50 trillion.
Yeah,
it's a hell of a lot of money, whatever the number is. And it's a hell of a lot more than we're spending now or have spent historically. In fact, I've read it's the single greatest investment opportunity in history in terms of what the scale of the problem and the magnitude of the solutions that have to be built to address the problem. So where do you each sort of come, where are you thinking about where the smart money is going today in terms of what's your focus on, what are you looking to invest in? Iris, you said hardware. Peter, you talked about the built environment in cities and urban. Tell us a little bit about where you and your team are focused specifically on tech solutions in this marketplace.
Yeah, I can take the first stab at it. I think the way we go about it is trying to understand what are core urban sustainability challenges, and then from there we can build out an investment thesis. And I'll just give some examples of how we go about this, where we understand that in the built environment, we're going to have to be much more efficient with our energy systems. So two of our recent investments stemmed from what we call our deep dive research, probably actually something that's quite close to ear, so it might be what you do on your side, where we did deep dives into cooling and we did deep dives into windows. Cooling, obviously, when you look at the increased demand that's going to be needed, particularly sort of in the mid-latitude areas, India, if you consider it, is going to be an enormous uptake in air conditioning if temperatures increase in line with what's expected between now and 2050. We don't have enough electricity right now to actually meet that demand. So we need vastly more efficient ways of cooling our built environment. We also need to build sort of in a passive way that doesn't require as much cooling. But on that, on the active cooling side, we just invested in a company called Blue Frontier, which is reducing the energy consumption of commercial scale air conditioning by 80 to 90%. That came out of, again, this targeted research of what is sort of a core challenge. And second, on the Windows side, again, a lot of thermal gain that comes to there, a lot of thermal loss, depending on the specific time of year. There, we found another company called Luxwall that does incredibly efficient, what's called vacuum insulated glass. Importantly, though, it's highly applicable for retrofits and for new builds. So when you say 20 trillion, 50 trillion into the built environment, that's not just new construction. That is retrofits at a pace we've never seen before. It's like, I think like 200 times, or sorry, 2 times the pace that we have right now. So it's looking at these, I guess, specific core challenges that we see that are sort of driving adverse impact, and then finding the specific entry points where venture could scale up these solutions to be able to address them in a meaningful way.
Right. Iris, what, from your perspective, from the science perspective, what technologies are you looking at, have looked at, have invested in that you find have the most promising potential?
Yeah, so in terms of the technologies that we're currently looking into, I think the way we operate is indeed quite similar as what Peter is describing. So we would also do these deep dives. Like at the beginning of this year, we set for ourselves 6 specific topics that we were going to look into with the team. And that means that every deal in that deep dive that comes in that specific deep dive has priority over other inbound. So some of the topics that I focused on myself in the past year were green ammonia, as well as mining and raw materials. So green ammonia is maybe not that related to the built environment, but it's actually quite important to sustain the population. So ammonia is, without essentially synthetic ammonia, we would not have been able to sustain about half of the current global population that we have right now. And synthetic ammonia is used as fertilizer to create food for the people on the planet. So it's not maybe related to built environment directly, but quite related to the population that lives in cities, of course. So that's a topic we focused on. And then mining and raw materials is, I think, something that's also pretty critical to us surviving in our cities, especially in Europe. I think it's well known that in the coming decades, we'll have a shortage of at least lithium, cobalt, nickel, copper, and carbon materials that we need to actually build cars and the whole sort of urban environment that we're living in. And yeah, we would typically, so I'm mentioning all these sectors, but in terms of a fund perspective, we're actually sector agnostic, or we would call ourselves that. So we focus mostly on, addressing the big problems, so abating these emissions. So we first look at, okay, what are the biggest emitters? What kind of topics, what are the topics that we see opportunities to save emissions? And that's how we make our decisions where to do a deep dive. So similar to Peter, but also slightly different in some ways.
Great. So, as you both know incredibly well, as I mentioned, the climate crisis presents probably the greatest threat and risk ever to the built environment, right? What other industry is as exposed both financially and physically to the climate crisis than wherever we all live and work, right? I also believe it's the single greatest opportunity in history, probably, in terms from an investment point of view. But what stresses me the most, honestly, is the fact that adoption in, as you said, Iris, in prop tech has been woefully slow and inadequate. It's just hard to get adoption in tech in the built environment. Now we're bringing in sustainability as a theme, and we really want to drive this adoption. Peter, we'll start with you. What say you to how we're going to scale these investments that you're making in a market that underinvests historically and is probably under-resourced as well? So how do we get to scale in this mission?
Look, I mean,
I know it's the $20 trillion question.
Okay, so, I'll present the positive side of the coin and then sort of like the struggle that we see a little bit. So the positive side of the coin is that I think economics, sometimes boosted by policy recently, has really, really been in the favor of the sustainable solutions. When you look at things like simply like energy efficiency, you're saving energy, you're reducing your operating expenditures, great. There's a simple IRR on that. But more complex ideas like low embodied emissions materials are actually getting a lot of a boost from policy, both on the EU and the US side. In the EU, the ETS, which will start ramping up pretty seriously for the cement industry, for example, is going to create a real financial liability when it comes to the embedded emissions within cement production, which will force cement producers to start thinking about, how do I shift to low carbon cements? We have one company specifically in cement production, another in concrete production. Those are hopefully going to be sort of tailwinds for those companies. Same thing when you look at sort of the tax credits that are coming into the IRA. The challenge, though, on the other side is that there's a need for sometimes geographic specific adoption of these technologies that can stymie their sort of pace of uptake. And I mean, to be more specific, things like engineering testing, fire testing, safety testing, all of this is absolutely necessary. But the sort of pace at which we need the adoption of this tech and the same scale of, I guess, certification that we need is not sort of a good one-to-one fit. We need to start prioritizing these technologies to be able to be tested quickly, to be able to go through the rigorous amount of work that's needed to get them into the built environment, but don't create these risky situations for investments or for developers, particularly in the built environment, that they might not be able to use this material if it doesn't get to, I guess, the right spec timeline for them. But I don't know, I guess if I want to pass it over to you.
Yeah, so I heard you say many different things. So first of all, geographic adoption, and then also scaling certain technologies, and how that's actually quite related to policies, right? And to having like support schemes like the IRA, but also European Green Deal, of course. And I mean, I think that's interesting, because it's actually a good sign, both from the policy side, that there's support and that will help entrepreneurs a lot. But yeah, let's say mitigating the scale up risks, there's many different phases, right? So there's like the early risk stages where it's like a technology risk. And for us, it often means that the entrepreneurs are still doing their research in academic labs, for example, and then they need different kind of financing and different support. So policies are important, but I would say more often they will need grants to do that fundamental research. And then later on, where we come in as venture capital funds, you have the engineering risks. And that's when people can actually really start leveraging these policies for something positive, I would say. Then you get to the point where like, okay, where should we move? What kind of geographical adoption should we consider to scale up? And I think then the risks and the support and the challenges are not just about money, but especially with these hardware heavy technologies, it's also about finding the right support and finding the right people to help scaling up. And it often comes down, for example, to engineering and blue collar workers, or at least that's what we see at Extantia, that sometimes they can't even get the right engineers because there's just not enough engineers to really do the work. So I don't know how you see that, Peter, in terms of scaling up. Like, what other resources do you give to startups?
I love the way that you framed sort of the different scales of risk. And I think that actually, like, without answering your question directly, it's almost like there needs to be some coordination between like seed stage investors, Series A, and sort of like these later scale ups, where each of us are probably facing our own adoption challenges for the scale of tech that we're working with, and how do we coordinate and sort of churn the gears so that essentially create, like, there's so much that policy can do, but I guess across the different tiers of financing, we might be able to also sort of lubricate that system a little bit as well.
That's great. That's a great idea. Something we should unpack post this webinar, because I'm digging what you're talking about. That's absolutely. We do need more coordination. We do need more accessible information as well, and pathways, and we just need to figure out ways to help build and scale this community faster. But so just moving along, we're obviously Idris and team have, at Relevation, this is a focus on fundraising as a platform and as an event. So I'd love to just sort of jump into a little bit about how you each evaluate different technologies. So Iris, I know with you, it's hardware, very hardware focused, but I'd love to also understand both of your firms' perspective is, if I'm a startup and I've got a solution, how should I present, interact, interface, pitch, present to get on your radar screen, each of you? Iris, we'll start with you.
Yeah, I can take a stab at that. So right, I'll be quite specific for us. So really sort of give a peek under the hood for our fund. We're generally quite tech savvy at Extentia, I would say. So it's me as a chemist, but some of my colleagues are engineers, mathematicians. They used to be entrepreneurs themselves. So everybody is quite excited and savvy about technology. And we love measuring stuff. But we're also aware that sometimes, it's a very early stage startup, so you can't always measure everything. However, we do like using key performance indicators, or KPIs, when we're assessing potential investments. And some of the general common ones that we use are CO2 emission savings. So it's probably the first one that we will ask you, or that you should come with us. With us. So let's say, how many tons of CO2 can they save per year? But then also that very often comes down to energy input. So for example, when I was talking about green ammonia earlier, typically when they will save CO2 emissions, that means that they use less energy in the process, because energy typically has a carbon intensity. And I know that everybody's talking about renewable energy and assuming that we'll have 100% carbon-free energy, but we're just not there. So reducing the energy input is, in our opinion, still a very good sort of point to start. So first KPI, CO2 emission savings, second one, energy input, and then a third one, but this is very general, so TRL, technology readiness level. And that is, for example, if a company is under TRL 4, means they're still in the lab. If they're between 4 and 6, they're becoming commercial slowly. And then above 6 is when they're really ready to go to the market. And then, of course, as a venture capital fund, you also always have to ask about the money. So how much does it cost to do this? And Extentia specifically, we really don't want to bet on the green premium. So we think for now, it's maybe fine to pay a little bit more for a green product. But over time, we have to see how the startup, let's say, really weans off of that green premium, because we just believe that you have to be, in the end, financially competitive with the fossil-based alternative. Otherwise, it's going to be really difficult to be competitive in the market out there. But yeah, I'd love to hear, Peter, from you, how you see that and how you assess on your end.
Yeah, no, I think if we were to give like founders a couple pieces of advice, let's say for like sort of a first call with me in the room, because like there's a little bit of a difference between maybe just that first info call, but not really, to be honest. Like what we're looking for from the get-go is having impact and sustainability inherent in your pitch and your business model. That often what we love to see is sort of the problem or the sustainability challenge put first as sort of, this is an issue that we're trying to solve, and then pitch the product or the business, and this is how we solve it. Because if a founder is motivated to create a company to specifically solve a sustainability challenge, they're going to build value out of essentially impact and they're probably much more likely to stick with that as sort of their key business model moving forward. They might not shift into something that might not be technically as green. And so rather than like, eventually we'll get into sort of like an impact model if it's there, but I guess the first question is, what is the impact challenge you're specifically trying to create, and sort of what sustainability dimension are you going after? Is it carbon emissions? Is it increased resilience? Is it biodiversity? Is it pollution? And how are you going to be able to really tie your, I guess, your revenue generation to that? And once we get sort of beyond that initial sort of feel that a founder and its business is inherently will be able to create value out of sustainability, then I think we can get into much more deeper analyses, but it's that baseline that's really essential for us.
Terrific. We only have a few minutes left, so I'd love to just sort of get your closing thoughts, each of you, Iris and Peter. I love my job. I love what I do every day. I'm incredibly passionate about the work that myself and my team do. And I feel like, in a small way, we're making a small impact. It's sort of driving innovation and hopefully just increasingly sustainability adoption. When you think about your job and what you're doing on a daily basis, what gives you most hope, and what do you love about what you're doing?
I love this question.
Yeah.
It's why I don't script, man. Because
it's such a good question.
You are passionate, so let's go.
No, I mean, like, Iris, is this okay for me to say? I feel like we just are constantly working with nerds who are passionate about like what they're doing. Every single founder I speak to is so unbelievably intelligent in their work, and has their specific sector. The knowledge that they have is truly intimidating. And the fact that they're going after this space also to solve a specific sustainability challenge is just like unbelievably motivating from my side. That I mean, to be honest, I think we're horribly off pace when it comes to solving the climate crisis, but at least sort of the bubble that we work in, these are people that are really motivated to build value out of that. And it's just really cool to be able to think that we can play a small role in helping to ultimately build these enterprises.
That's great.
That's a really great way of saying it, Peter. I think I'm with you on that. My curiosity is just spiked every single day when I'm working, essentially, because I get to talk to all of these different founders, and everybody's doing completely different things, right? So I guess in my mind, on the one hand, it could be perceived as being very scattered, but the positive about it is that you're able to switch quickly between different things that you're looking into, and you kind of have to if you're an investor, because you need to set the ground for the entrepreneur to do their pitch. You need to ask the right questions, and the right questions are not the same for everybody, but that's what makes it very exciting for me, at least, because you get to be curious again and again every single meeting that you have with every different entrepreneur. And indeed, Peter, as you were saying, all of these entrepreneurs are so passionate about what they're doing, and it makes me feel so humbled sometimes, because I'm like, wow, they are actually moving the mountains for climate change, and we are just moving mountains of money. Essentially, it sounds a bit.
No, you're doing more than that.
we're trying to do a bit more than that, but it makes me feel really humbled. I'm like, wow, they're doing the real hard work.
Yeah. Well, listen, what gives me hope every day is that I get to interact with people like the two of you. I mean that sincerely, that you're doing the hard work, Iris and Peter. And, without your teams and your capital and your resources and your advice and what have you, we would just be talking to ourselves in terms of the startups, and we wouldn't be making an impact. So I get incredibly excited and hopeful, because it's just the incredible, like you said, Peter, just the extraordinary amount of talent that's coming into this ecosystem. The caliber of people. And as you said, so passionate about this, of all the things that they could do. This is clearly not an easy task. I mean, the rewards are potentially ginormous, but this is hard stuff, right? So it takes a very special person that wants to focus on this for their career. Then let me just end on this note. Give me a couple people that inspire each of you that I could follow, the audience could follow. Give us some people, give us some names to follow that inspire you, Peter.
Well, I mean, his language recently has been necessarily tough. He might be a little bit of a doomsayer, but UN Secretary General Antonio Guterres has been the way that he's been speaking about the climate crisis is so salient. I mean, it's an obvious choice, but it's the language that we need to see given the scale of true crisis that we have.
Okay, it's a good one.
Yeah.
Good one.
Thanks. I'm going to go for a venture capital classic that I really liked when I was first transitioning from my role in, let's say, academic chemistry to venture capital. It's John Doerr. He's been in venture capital for a very long time. He's done so many different investments, also probably lost a lot of money in Clean Tech 1.0, but I learned a lot from like reading about his previous work. And he now also has this book, Speed and Skill, which was also quite useful, I think, for many people that want to move into climate tech venture capital or climate tech in general. So yeah, he has been inspiring to me, and I think everybody, even if you're not an expert in climate or technology or whatever, can really learn from it. I would highly recommend.
If I can add, okay, it's a little bit, but still, me, the person I would like to follow is Michael Beckerman. Okay, thank you very much.
No, but seriously, give me some names, because you're such a thought leader out there, and you're so wired and connected into so many various communities. Who inspires you, Idris?
Wow, I really, it depends on which topic, but recently, Kevin Cardona, Chief Innovation Officer of BNP Paribas Real Estate, was always, in the recent contact I had, I would really mention him. His way to analyze things and his vision is, for me, like really in the future. So
Very cool.
I would mention him.
Very, very cool. Very cool. Well, how did we do? We do all right?
Yes, you're still live.
Thank you for spending time.
Thank you so much for this. Really appreciate it.
Yeah, thanks so much for having us.
Thanks,
very
Idris.
soon. Thank you all.
Best of luck for the rest of the event. Take care.
Thank you.
Thanks,
Cheers.
everybody.
Right, thanks. Bye.
Okay, we are ending up day one with another topic, which is related to the construction, so the beginning of the real estate value chain. So welcome, dear speakers. We are now live on air. We don't have 1, 2, but 4 panelists today to end up this session. So it will be for me a challenge to try to moderate this, because it's also brilliant people on board. So Meg from Procore, Alain from Bureau Appold, among other, Katzbu from Bricks and Mortar, and of course Hans from CFE. So it's an honor for me to welcome you to close this day one, and we will discuss where is the real disruption in construction going to come from. And we decided to pick this panel because, or this topic, because you know that it was 5 years ago, McKinsey was publishing this report saying that there is only hunting and agriculture less digitized than construction. So 5 years after, real disruption still didn't really happen, I have the feeling. So we will try to unpack this. But why don't we start maybe with the helicopter view of the challenges in the world of construction. There are many, many, many challenges, but since I have this group of experts in front of me today, I would like to understand from them what are, according to them, the biggest challenges that our sector is today confronted with, starting maybe with you, Meg, from Procore.
Hang on, can y'all hear me?
Yes, we can definitely hear you.
Sorry, we're in between different rooms today. Sure, yeah, and thanks again for having us all on today. It's always good to see you, Idris. A couple of things, I mean, I think we'll hear from the rest of the group. What certainly comes to mind for me, especially kind of closing out the quarter, is labor shortage. This has been consistent. I've been at Procore for 6-7 years now. And since I started, the numbers have been getting worse and not better. Where folks from all aspects of the value chain, I know this is largely a prop tech conference too. It's not just the laborers in the field on a construction project. It's also, you know, the folks with a 30-year career who understand the pumps and the heaters, you know, in given commercial building. Folks aren't entering the industry. And so this is putting a lot of pressure on construction in particular. whether it's commercial, residential infrastructure, it's definitely straining every project. But the good news from our perspective is that that shortage itself is a forcing function for technology and for innovation, whether that's coming from robotics in prefab, whether it's assembling your electrical panels offsite, shipping them in, and kind of reducing that workflow from a time and intensity perspective. Automated progress tracking, the use of drones. I think there's a lot that can come from it. I don't think we're out of the woods yet, though.
No, of course. When some see only challenges, others see opportunities, of course. But Alain, what are your biggest challenges you see?
Yeah, I like the word forcing function. I think fundamentally it's sustainability and equity. At the planetary scale, and hello from London, and we have a very wide panel. I think all over the world, we can see we do not have enough real estate and enough infrastructure to support the people we have on the planet. And we also have heard all this morning and this afternoon that the way we go about creating and instantiating the built environment we need as societies will burn the planet. So right now, there is a primary forcing function, which is you either go for revolution because the have-nots will kill the haves, or we go for equity and sustainability, and we completely reimagine how we intervene on the built environment, and I wouldn't call it construction.
Okay, I love it. Okay. Cosby, sorry, yeah. So go ahead.
Happy to share a little bit more, and let me know if you guys can hear me okay. So I'm coming at it from a little bit of a different angle, and I think your challenge was, why hasn't adoption taken place? I think we are an industry that is driven by slow and sticky growth. We need to prove at a project level ROI when you deliver a technology. So I think when I think about going from pilot to scale, for many of the companies, these are large customers, I think that still remains a challenge. And that's not necessarily a bad thing. I think it's harder to earn a dollar in construction technology overall. And that's actually proven even by, I would say, public reports, right? So you think about what public companies are trading at. Construction technology in the built world sector actually trades at a higher multiple than a lot of the built world technology, just because it is harder to prove yourself and go from one project to the next project. So I think part of the journey here is figuring out how do we accelerate that process, and not necessarily unrealistically, but more understanding from the customer standpoint, how do I take something that I've learned on a single project and scale it across the rest of the industry? I think we haven't still cracked the nut on that part.
Yeah, love it. Okay. And Hans, do you see other challenges?
Hey, Idris, thanks for having me to begin with. And first of all, congratulations on the event, which is really a great event, and it's successful so far, I think. So thank you. I confirm what the colleagues around the table have already said, of course. And for us, workforce is absolutely a key challenge still today. And I would like to say that for people who are on the workforce, or people who have to do the work, it's the weather, it's the rain, it's wind, it's the difficulties of doing construction is really a challenge, and remains a challenge to find the right people for that. And sadly, or luckily, we're moving into technology, but technology is not specifically a better environment with easily available workforce. So workforce will remain a challenge for everyone, and for all of our companies in the sector, I'm sure.
Yeah, clear. So I would like to discuss a little bit the problem of the fragmentation of construction of the value chain. So you have the architect, the engineers, the general contractors, subcontractors, etc., product suppliers. So it's a very fragmented ecosystem. And recently we were discussing with a developer that really wanted to implement a prefab offsite construction startup. And then they were saying, yeah, but we put this in the call for tenders, and then the general contractors say, okay, but if you want to work with this startup, it adds an additional layer of complexity for us, additional risks, and we already have a too small margin, like 3 to 6% at the company level, and sometimes negative at the project level. So if you want to do this with these startups, it will cost 30% more. If you want to do it with traditional materials, it will cost 30% less. And so my question is, if we really want to disrupt the construction and real estate value chain, shouldn't we sort of get rid of these silos find a way to have alignment of risks, alignment of benefits in all of the key players of the value chain. So maybe it could be we build an SPV. So every real estate project is an SPV. It's a special purpose vehicle where the general contractor, the architects, etc., everyone has shares. So this could be a way to align interest. So what do you think, Alain, if we start with you?
Yes, I mean, I put my hand up because this is a topic close to my heart, number one. And second, this is something that we've actually thought about very deeply in the UK with something called the Construction Innovation Hub, which landed on the idea of product FMA as a way to reaggregate demand and disaggregate demand into the ecosystem, in the UK construction ecosystem, and created a distributed manufacturing footprint. So a lot of words there. But so there is an existing value stream, and what people don't, I think, integrate enough is that it's a cottage industry, right? The 100th architect in size in the UK has 20 architects. Most of the firms that work in the UK in construction have less than 10 people. It is not possible to industrialize that value chain in the current state. It is impossible. So you will not get the benefit. So yes, you can try to reintegrate the contract. And there is an excellent paper by Daniel Hall and his team at TU Delft on what do you need to reintegrate. You need to reintegrate the contract, but we've done that with IPD and it's not enough. You need to reintegrate the workflow, and we've done that with BIM, but it's not enough. You need to reintegrate the value stream, and that is where it really gets really interesting, because you need to control the demand and match the industrialized construction processes to a completely different value stream. And so putting all these three together to reintegrate contracts, technology, workflow, and value stream.
Yeah, clear. Okay, thank you, Lovely. Passing the torch to you.
Yeah, I'll add a little bit to this. And as, again, we have many experts on this panel, so I'm sure we won't be able to get to the depth of it. But if I do a broad oversimplification of this, I think the 4 key skill sets that we see to make prefab modular kind of work is essentially developer, GC, technology, and logistics. Now, if you think about different startups or different solutions in our space, many of them try to approach it different ways, right? One of them has figured out a logistics partner. Some of them have gotten a GC partner. Some of them have even gotten investors from each of those stakeholders to be joined at the hip by investing in the startup themselves. So I think there is some level of, other ways to align the incentives, the financial incentives that you're talking about. And yet it's pretty hard to get to the end game, as Elaine was saying already. I think this is much more of a US-centric view. I don't think it's an easy enough, it's very hard to compete against a guy who's swinging a hammer in Arizona from a dollar per square foot standpoint to say, yes, this is going to make sense. I don't think it's actually a winning proposition. It's a much better winning proposition to say, here's a piece of land that is not developable by traditional means and methods because of, and maybe it's not even cost efficiency, it's just cost and schedule certainty that allows me to underwrite this project differently. And I'm now able to develop this piece of land that you cannot develop otherwise. And I'm an investor, so Hans is actually probably the one who's closest to this. If he wants to add anything or go for it, go for it. But yeah.
Thank you, Kupsta. I think I agree with what has been said so far. And first of all, and I think that's important to understand, it's a complex matter. This is not something that that is being solved easily. And as Alain just told us earlier, there's multiple facets that have to be looked into. To be honest, personally, from what we experience, SPVs is a potential way to deal with things and to make things better, but it's not a sacred grail either in order to be able to distribute the benefit across the value chain properly. What I think is very important is what I would call trust and partnerships in the different value chains. And there I know that with the right trust, with the right partners, you can make the right distribution of benefits. if I look just very simply at BIM models today, I know that in reality, sometimes BIM models are created not just once, but sometimes twice, if not 3 times on the same project, just because we are not aligned there. And that alignment is difficult, it's quite difficult. And that's where I think that in order to solve this, that also the government has to step up. And I know it has been discussed already earlier this morning, Idris, but the government has a role to play in the standardization across this very complex market, the very complex players and all of the different elements in construction. So that's where I think a step needs to be taken sooner or later with a lot more force in order to help us to align as companies.
Yeah, clear. And I would like also to ask to all of you a bit of vision to help me building a bit of vision. So there is this famous example of also ingredient-based industry, manual-based industry, hands-on work, which could create a very specific digital strategy and then enjoy the fruits of the digital transformation. And so this industry is the pizza industry, with the very famous example of Domino's Pizza, with the zero-click app, for instance. So you open your smartphone and then you order a pizza and you get your favorite pizza delivered at your location in 30 minutes. And thanks to this sort of strategy, the price of their stock exchange increased of more than 2,000%. So they were able to create more values than the asset-light tech giants. And so my question for you would be, can you give me some examples of what could be the digital strategy for construction? What could be the fruits? What could be the Domino's pizzas of construction? Starting maybe with you, Meg.
Sure. That's a really interesting question, just because right now, right, with all the buzz around ChatGPT and AI, I think there's a tendency to say, if we're going to jump straight into robotics, handling X percentage of manual workflows, we're going to, start automating processes. We're not just going to digitize a process. We're going to actually create efficiency gains there. But the reality is, at a lot of contractors, and Hans, you can keep us honest here, there is still a tremendous amount of work that is not digital, that is highly manual and difficult to manage. When you said pizza, it reminds me of labor, equipment, and materials management and construction. It makes the bulk of the spend, of course, on any given project. But there are very, very few technologies today to manage this in any digital way, let alone in some sort of an automated way. Pizza in particular. When I joined Procore, I was in New York, and it was a time when all the apps had just come out. So you could you didn't have to call a restaurant to place an order for your pizza and then walk over and pick it up. You could open up an app, plug in the quantity and say, I'd like this at this time, and you could track it down to the minute to when it would land on your doorstep. Contractors today, whether they're, if it's managing a workforce, if it's, particularly in ordering materials or managing an inventory of fleets or, heavy equipment or light equipment, folks literally call a guy, their supplier, maybe Jimmy, and say, hey, I need X, Y, Z, or this many more of that. And there are sometimes paper POs, or maybe there's an e-sig, but it's not necessarily managed well. So future state would love to talk about AI, but in current state, I think we're really, really excited to see more and more companies starting to solve this set of challenges, whether it's around the material side, equipment side, and building digital workflows there. From there, we can use a data set, right, to actually tie those back to automated takeoff, or whether it's ordering more based on progress tracking from LiDAR scans. There's a lot of things that we could do once we get these basic workflows in a much more streamlined fashion.
Perfect. This is super tangible the way I like it. Thank you. Hans, do you want to add anything? Because I see you smiling so big.
I can only confirm what Meg just said. I think she made a really good point and a very strong point. And I'm sure we all love a good pizza. I also think that some of us have probably ordered the pizza more than once a week, and it only takes like 30 minutes. Our products that we construct together is not something that you buy that often. It's far more complex than a pizza. If I compare to our last construction project, a very a big one in the center, in the heart of Brussels. There's over 1,000 people active on these construction sites. This is not just the one chef making the pizza, of course. So there's a very big difference between the environment of Pizza Domino's and the digitalization that they can do and the one that we have to do. And in that perspective, I completely agree with Meg that we have to work on those basics. That back office of all of our companies is something that we really have to automate, to streamline a lot better than what we have at the moment. And it's complex. There's a lot of parties and there's a lot of companies in the market, and we have to find ways to align that. And then I come back to that standardization, which I think is very important across the companies. And I know for sure that at this time, several general contractors in Belgium are reviewing and are updating their ERP software as well. So they're working on it. They know this. And this is required to go forward in that evolution that Meg referred to.
Yeah. And great. And I mean, before I move to the next question, Alain, if you want to say 2 words about this topic, very curious to hear.
Yeah, I mean, pizzas is B2C, right? And I think we can learn a lot about B2C. And we have an ecosystem, so in part, it behaves a little bit like B2C. So I'd like to see things like the city mapper. Hans talking about the data, but data trust, and then on top of it, city mappers type application coming for the foreman. The WhatsApp of construction. I mean, it is still the #1 collaboration tool. If you're in Asia, it's WeChat. If you're in Europe, it's WhatsApp. Don't tell me the industry is not digitalized. It is, but not by the people that claim to digitalize it.
Okay, I love it. So now that we understand what are the challenges of the sector, I would like to have your views on where the real disruption could happen. Is it in these challenges? Is it in something else? Like a quick win, like we see, like Meg started to say. So, if you have to pick 2 topics which you think is the low-hanging fruit of disruption in a way, which would it be and why? Starting with you, Meg.
Sure, just so we're at the 10-minute mark, so I'll pick one. Earlier, you talked about aligning benefits along the value chain. At Procore, we feel that one thing that is critical in that process is modernizing payments flows and making payments flows more transparent. So all of that is contingent on, digital workflows, some data standardization within companies around progress tracking and work completed. But we're really, really excited about the possibility of payments flows to alleviate those stakeholder dynamics. I think the challenge is when you've got everyone coming into a job, everyone wants to finish a project on time and on budget. Everybody wins. But along the way, the risk is actually varies very differently depending on who you are in a project. Case in point, subcontractors actually, not necessarily in every country. I think, especially when you look at Southeast Asia, a lot of it's verticalized. But for most of the world, subcontractors are fronting the bill for 90 days or more, up to 120 days, paying all the laborers, buying all the equipment, getting it to the site and installing it before they even see a check. There's got to be something we can do to improve that. And I think in that process, we actually bring people together aligned on, work completed and how far along we are and what are the issues slowing down a project.
Clear. Alain, you want to add?
Yeah, I think we have to focus on demand. And the largest demand is emerging markets. They need infrastructure, they need schools, they need real estate at an unprecedented scale. And the people don't have to be told to forget their bad habits that we have in the West and our complex atomized value chain. I think Meg just mentioned the verticalization in Southeast Asia. I mean, the way we build things in Asia, or even the way the metro in Dubai was built. I mean, look at the speed, look at the demand, and just go and reinvent something much better. Go there, it matters to the planet, and you will make a lot of profits.
Wow, I love it. Kaustubh, if you want to add anything.
I know we're off close on time, but I'll just say Meg and Elaine might have hacked our inboxes. Because that was probably right up the alley. I would say combining those two even more so. So if you think about procurement, fintech in emerging markets, the challenge you have in US is much more cash mismanagement to a degree versus just cash restrictions. You're just cash-strapped economy out there. So I think that's going to be even more of a called pressing matter in those places. So I'll just leave it at that.
Okay, and before I pass the torch to Hans, if you're available, I don't have any issue postponing of 10 minutes at the end of our conversation because I have still a lot of burning questions. But of course, I want to be respectful of your timing, so we will see. But okay, there is no super hard deadline. So Hans, what would be the 1 or 2 areas?
Very quickly, maybe. To be honest, I want to stop at the word disruption. I don't really believe in disruption, being a sudden interruption of the market. The market is far too complex to be able for that to happen. But one thing is for sure, and I have a good example of that. Just in Antwerp, early June, there was an agency which is called Impact who put a billboard on a wall, and they told them, "Hey, ChatGPT, finish this building." Which is obviously a very funny statement to state that finding the right workers and the right expertise and technology is not something that can be easily replaced by technology. But just to name one very quickly, I would say that modularization combined with offsite construction is an absolute element that we have from which we can expect quite some impact in the construction world. And I'm sure that we will move more from a project-oriented world to a product-based world. That will definitely happen, to be honest.
Crystal clear. I love it. I would like to maybe also deep dive into specific topics that I've been looking at during the past 4 or 5 years, where I had potentially big expectations, and then it didn't became a big thing, starting maybe with the 3D printing. So I can't understand why its usage is not already generalized. Why aren't we building every single foundation, for instance, in 3D printing or specific assets? So maybe starting with you, Gustav.
Yeah, happy to. So we've spent a lot of calories on this. We co-sponsored the NASA 3D Printed Habitat Challenge back in the day, $4 million in prize. And we learned a lot from material robotics and everything else in that space. I think the technology has come a long way. Delivering something consistent in different temperature, humidity, it was hard back then. And I think we made a lot of progress. But for in-situ printing, and this is what I think Idris meant, primarily in-situ printing, 3D printing, not in a factory, is still a long road. Perhaps more so from the code standpoint. I think wide adoption on code would definitely be the biggest reason why we as an investor would want to think about it differently with the velocity that a solution like that can be adopted in the industry. I think if I think about just today where we stand, I believe it's easier to go through a 3D printing solution that is in the factory, and we've invested in a couple of these, in a non-structured underwrites a VC model much easier, or go into a solution that is using adapted materials that are already established in the code. So this is where you might use CMU 3D print, CMU placement of blocks versus actually do 3D printing. So that's kind of the state of the art today. Plenty to be done, but I do believe it's going to be a bit of a challenge to scale today.
Yeah. Okay. Clear. Moving on, maybe if I can ask to you. No. Okay. No comment from me. That's pretty clear. Okay. Maybe one of the last few questions. I would like to ask you if you have any example of general contractor that is a real pioneer in innovation. So really the next generation, the prototype of general contractor of the next century, I would say, not science fiction, but something like a company which is really digital native and tech powered, which doesn't have maybe like all of the legacy of the past, of the pen and paper work, etc. So could you maybe share some names or some best practices, some use case of innovation? So maybe starting off with you, Meg, or maybe one of your customers.
Oh, it's really hard to pick just one.
Like choosing between your kids.
Yeah, we've got a lot of customers now. So shout out to all of our wonderful customers. We love you. Since I am in Austin, Rogers O'Brien comes to mind. They're a U.S. general contractor with a really tremendous team, tremendous leadership. I think they're one of the first companies to move off of pen and paper like plans onto iPads. The second iPads came out in 2012. They've been using drone technology since 2013, BIM models, not just to have it, but actually leveraging it in the field. And really, I mean, they're leveraging a fully integrated tech stack, not just, Procore's tools, but a variety of other solutions. What's different about them? Their CIO is incredible. He's very tech forward, a gentleman named Todd. And I mean, to the extent that I think this is accurate, I think it's been sold now, but their general contract, like as a business, they started a tech company, a startup within the GC, and spun that out, ultimately sold it as it was relevant to more than just Rogers O'Brien. I think more broadly, the other thing I think we're really excited about is not just GCs testing out new tech. We've got a J-Done project behind me. There's Brian companies around the corner. I'm seeing the robots in real time from my window. That's very cool. But also seeing contractors, especially the largest contractors in the US and in Europe and really worldwide, getting more involved in the ecosystem. Showing up to invest in companies directly, building accelerators, like really taking on technology, not just as, okay, I guess we should digitize now, but wanting to shape that narrative. So I think that's been super exciting for us.
Okay. Kaustubh, do you want to add anything?
Sure. I think it's been an interesting journey there, as Meg mentioned, right? We've seen tech-forward contractors appoint chief digital officers, innovation officers, meet a bunch of startups. I think that was a strategy for innovation. I think the interesting flip has happened where instead of strategy leading innovation, innovation starting to lead strategy. And that's where you see some of those unique business models come in, right? So similar to one of our close partners is Obayashi. And they just launched called it a solution called Ophorizon in Japan. And that's bringing technology to Japan. Basically, they met a bunch of startups. They realized to deploy in my home country, I need a go-to-market partner. No one else is doing it. I will go ahead and make that happen. That's a pretty, bold statement from a standpoint. And, I'd like to see more of that where you're not just doing things that's the standard old way. You're willing to innovate on not just picking the right horse, but a business model that is very unique.
Yeah. Okay. Clear. Thank you for this. And Hans, of course, if I invited you, it's because I'm impressed by what you do in innovation. So can you maybe share a little bit if there is one project or one tech?
Yes, of course. I absolutely am a humble person by nature, but I can only mention one of our projects that we created a while ago, already in 2020, where we used quite some digitalization in order to make it happen, and that's what we call that's the Gare Maritime project of some time ago, where we transformed a 1907 freight station into a completely new environment. With 12 wooden structures and wooden buildings inside of it, which we all did with a fully digital lean planning method, which was at the time at least quite amazing for us. It was also difficult. I can tell you that the execution was not that easy and the adoption was slow, but we managed it and I think the result can be there. So I absolutely invite you all, if you want to come and visit Brussels one day, please do have a look at Gare Maritime and see what a wonderful sustainable solution that was created there with quite some digital technologies in the background that you can't see anymore, of course.
It's definitely the most iconic building of Belgium, and it's also where we hold the real estate summit in September. So yeah, that's
amazing, great,
an opportunity to meet everyone. Great. Then, if I can maybe ask you just in 2 minutes' time to give me one word for the future of construction. One word. So that's a bit off script, but you're all brilliant minds. So we will see who is pessimistic, realistic, fatalist, optimist. So starting off with you, Alain?
My one word would be manufactured.
Okay, yeah, totally aligned. Meg? On the spot?
I get 2 words, building momentum.
Of course. Then Kaustubh?
excited, but I think maybe I'll think about the value chain pool shifts, which is forwards, I guess. Yeah.
Okay.
Maybe there.
Yeah, absolutely. Okay, I do agree. And Hans, what is your view?
I'll be so straightforward to take 3 words, Idris, but change is now.
I love it. Yeah, and that's also, of course, like the in your branding, right? But it was not a word; it was an ID. So in fact, it doesn't matter the number of words that you put behind. Thank you very much. I loved our conversation, and it's always good to see you. And thanks again.
Thanks, Idris.
Thank you, Idris. Thank you.
Congratulations, Idris. Fantastic.
Thanks again for having us.
Doing my best with the team.
Yeah.
Bye. So for the closing of today, we are struggling, trying to get the right slides. And Anna, you can stay here if you want. You're more than welcome. And I even don't see the he's leaving. That's fine. Okay, I will try to share my slides. Okay. Actually, you can be there. Huh?
Mm-hmm.
So I hope your session was good. Oh, another me. No, it's not me. It's Adri. Will support me with the slides. So it's the end of day 1, and we wanted to share with you a few metrics on what happened so far. So we will jump at some point into the slides. But I guess at this stage, we would like to thank everyone who was involved. We need feedback, and we also want to remind that there is the context. There is a contest of the selfie. So we hope that we will get some pictures. And here are my closing slides potentially. Yeah. Okay. So I will. Oh, and here are the slides. Great. So we can go to next slide. So this was the program of today, very intense, 10 sessions, and yeah, we will debrief internally after with the sessions that we think were the best ones, but yeah, there were a lot of super qualitative content. So thanks to all of the speakers. On the next slide, we will see an overview of what we had the chance to listen to today. A lot of content, very rich content, so very grateful. And on the next slide, we will see, because we are a transactional event, so the content is great, but the main purpose is to do the speed datings, the matchmakings, the introductions, reaching out to people. And so on the investor side, we have the #1 performer of the most meetings is Acontera. #2 is Next Day Capital Holding. #3, Media Heist. And we have EvoJam, and then we have Buildtex VC. And on the startup side, the startup that has the most meeting is Fractus. Then we have Bao Living, we have Aeromine, we have Excavate Robotics, and then Visuary. And moving on to the next slides, we had so far 81 meetings held between startups and VCs. We had 9 conferences and 22 speakers. We will look at the metrics tomorrow to see if we do better. My hope is that yes, we outperform this. But before we go to tomorrow, please don't forget your funny contest. Come on, this is our only sort of like a guilty pleasure during these 2 days. You know, we spend time speaking online. We didn't see anyone, so please share with us also if you enjoy. So take a picture, send it over to Idris at Relevation, and you might get a prize. And going to the next slides, this was the winner. So people really do it. So come on, do it. And next slide. This is the program of tomorrow. So it will be again a very intense day. We will have a session about the funding opportunities of the built world from the European Commission. So I'm super excited about tomorrow. And going to the next slide. Thanks to our partners, and most importantly, thanks to our sponsors. we're funding out of this project to have a positive impact and to increase the amount of capital invested in our sector. And going to the next slide. Thank you for your presence today. You can continue the networking and see you tomorrow.